All right, a very good morning, ladies and gentlemen. Welcome to day 3 of India's biggest BFSI summit called the Business Standard BFSI Insight Summit 2024. Thank you so much for joining us on day 3 consistently. I'm Ridhimavali, your moderator and companion on this exhilarating journey through the depths of insights and intellect. Ladies and gentlemen, it's incredible to see how far we've come in the past 2 days, exploring the transformative shifts which are redefining the financial sectors. Today, as we're entering into our final stretch, yet arguably, we are actually diving into the most persistent, pressing, relevant, and pertinent topics that will not only shape the future of banking, but also the way we actually think about finance, security, and digital transformation as a whole. Across every sessions for the past 2 days, one theme has been crystal clear, that innovation is no longer a choice, it's actually essential. Banks today are no longer limited to traditional transactions. They're hubs of digital transformation, adapting at an unprecedented pace to a world that's becoming more and more connected, data-driven, and customer-centric. The competitive landscape has expanded with agile fintechs and digital-first platforms, and this expansion is only fueling more creativity and urgency in tech adoption across every aspect of banking. Before we move on with the session, just a few gentle reminders. I hope in the last 2 days you have actually spent some time in the exhibition area, and if you've not, I'd encourage and urge you all to spend time in different booths because these different booths are doing some amazing work in the BFSI space. Take part in the Summit Circuit contest, visit as many expo booths as possible and win exciting prizes. You can submit your event passport at the Ignite Square for more details and actually win some exciting prizes. If your friends and colleagues couldn't make it today, they can watch the sessions live on businessstandard.com and Business Standard's YouTube channel and page. Ladies and gentlemen, this summit is also epitomizing 50 glorious and marvelous years of Business Standard, 50 years of sharing an opinion that shapes opinion, 50 years of steering conversations that shape the world of finance, 50 years of converting news into economic intelligence, 50 years of substance over sensation. At this point, ladies and gentlemen, I think we should get started with our set of conversations. Our first conversation is going to demystify the facet of life insurance sector. This panel discussion will be led by Mr. Tamal Bandyopadhyay, Consulting Editor at Business Standard, and the panel members who will be joining him on stage are going to be Mr. Anup Bagchi, MD and CEO at ICICI Prudential Life, Mr. Mahesh Balasubramaniam, MD Kotak Mahindra Life Insurance Company, Ms. Vibha Padalkar, CEO and MD at HDFC Life. Can I request you all to please make your way onto the stage? We all know that life insurance isn't just a financial tool, it's a safety net, it's a commitment to the future and foundation of financial security for millions. Yet, despite the critical role it plays, India's life insurance largely remains under-penetrated compared to global standard. India is foreseeing positive growth in this sector. However, this can only be steered by powerful awareness, building resonance, and ensuring that customers feel at ease as they let insurance companies deal with the most precious gift, the gift of life. To actually expound on this topic further, I'd leave the discussion to our panel members along with Mr. Tamal Bandyopadhyay. Over to you.
Thanks, Ridhima. A very good morning. Welcome to the first show of the day on life insurance. Just before we start conversation, after 2 minutes will be all yours. Just to give a perspective, where are we when it comes to insurance? And I'm just quoting from, which is, I think all of you know, is pretty credible, or probably the most credible thing, the Swiss Re Sigma report. Where do we, life insurance penetration in India actually came down from 3.2% from 3.2% in FY 2020 to 3% in FY 23. So overall insurance, both life and non-life, is about 4% in 23. Global premium values I'm talking about what are the stacking order. US 3 trillion, China very distant second 698 billion, UK third 663 billion, Japan fourth 338 billion, France fifth 261 billion. Where does India stand there? 131 billion. This is all numbers of FY22, and India's share is 1.9% in the global insurance premium. But that's not a very good story, but the good story is the commentary that Swiss Re has done, and you can get all this thing on the IRDA website, I guess. India from 10th is projected to be 6th by 2032, and it's the fastest growing insurance market. And it has given 6 reasons for this growing fast. One is strong economic growth, second is rising disposable income, third is young population, fourth is increasing risk awareness among us, fifth is digital penetration, and finally, I mean, I'm sure you'll agree this, the regulatory development. We have a very, very active, if I may say so, you might find him aggressive regulator. He's not yet in. He's on his way, so you can be frank about him till he comes. So first thing, let me start, is this, Biva, yes. Let me start with the pain point. Not the penetration, etc., but this surrender charges, which already took effect. It's good for us, those who want to be insured or insured, but not so good for your balance sheet. It's pretty old, but I understand that you still in private grudge about it. I mean, you're not very happy. So what's happening there? All of you can tell us.
Yeah, so thank you for having us here, Business Standard. On surrender charges, just more broadly, I think the regulator quite rightly is moving more and more towards customer-friendly solutions. And I do believe while there is immediate pain, it will go a long way towards increasing the pie. We saw this time and again. We saw this with unit-linked regulations in 2010, and thereafter many other regulations. And if I were to compare India versus some of the other countries in the region, we are the most customer-friendly products that are available today, one of the most transparent. Let me take the example of unit-linked. Unit-linked as in terms of charges, our closest large neighbor is almost 3x in terms of value extraction. Par versus the 90-10 rule, they are 70-30. So a shareholder makes 3x on a par product, and so on and so forth. Surrender charges are a lot higher. If I were to look at term rates, India is still one of the cheapest per 1 crore of sum assured, even versus some of the Nordic countries. So we are in a good place as far as overall what are we trying to solve for, insurance for all by 2047. Now let's talk about the pain. The pain is there, and little bit of also disconnect in terms of what is it that as insurers we were trying to do, because we're giving very long-term guaranteed products. So having an exit early on could potentially lead to an ALM mismatch, especially if interest rates move very sharply. But I think that is now history. When we look at the bigger picture, it is pro-customer, wherein at the end of first year, a customer gets a much larger amount than zero, and so on, at each increasing exit as an option. At the same time, we don't want customers to exit because these are long-term products. So we'll see how it evolves. I think I'm very proud of our sector that time and again, when we've had these large-scale regulatory changes or even COVID, we have come out only stronger. So these are all growth pangs in my view.
Sure. Mahesh, just your 2 bits. There is pain as far as balance sheet is concerned, your bottom line, and also the asset liability mismatches that she's talking about.
Yeah, so I think before I get into surrender value, let's understand where this whole thing came from. Please understand that we are the only sector probably which promises a guaranteed return on money which you have not even given me today. Because when we collect 10 premiums in a non-par product and tell a customer we will give you an IRR of, let's say, 6%, I'm giving it to you on the basis of just 1 premium that you have given it to me. No? So obviously this was done because we hedged our portfolios, we took FRAs and we took positions in the market in terms of interest rates. And obviously when such a contract is getting unwound, there is bound to be mismatch in terms of the cost of the unwind, right? Having said that, I think we are pretty happy that finally customers are going to get a higher return on the surrender when they come in for the first year. It does cause some short-term pain, but as Viva said, I think we're all beyond that now. What have we done to make sure that the pain is absorbed by us, right? First and foremost, we had to rework some of our commission structures with our partners in terms of deferring the commission or looking at a clawback in commission, etc. All of us have done that for various parts of our distribution. We're also looking at absorbing some of it as margins in the business. And thereafter, I think one will also have to look at the interest rates that are being offered, right? Right now, none of us have changed interest rates based on that. Interest rate changes have happened because of the 30-year and 10-year going down. But some point of time, I think we might have to look at the interest rates as well as an industry. I think by making sure that we press 2-3 levers, I think we should be able to absorb this and thereafter make sure that the customers feel more reassured with insurance as a sector and they feel far more confident about purchasing policies. And in the long term, we believe that it will only increase demand. 2014, surrender values went up in the industry, right? And I don't think we have had any negative impact because of that. So I think it's a long story. One more chapter is opening, and I'm sure the story will look good.
You know, the difference is this, a decade back, life insurance companies are not listed. Now they are all. So it's a different that you have to fend for your investors also.
I'll just have a comment here. Kotak Life Insurance is not listed, but we have the same obligation to our shareholders, customers, stakeholders as any other listed entity.
Okay, let's hear Bakshi sir, to banker turn insurance boss now. So tell us, what is your take?
No, so principally on the surrender value, last December, before the regulations came out, we had already come out with a product which had zero surrender charges. So last year itself.
So you started marketing even before, in the first
not
round
marketing,
itself,
we came out with a product in
on.
last December which had zero surrender charges. But to do that, you have to level the commission because you can't have upfront commission, otherwise you'll have other issues. And I also believe, and that is also, I think, borne out by the customer behavior everywhere across all the three of us, that people don't buy to surrender. People don't buy policies to surrender it immediately. The issue about surrender is that, what is the whole issue? Do you have a temporary liquidity issue or you have a permanent liquidity issue? If you have a temporary liquidity issue, all of us, we offer loan against policies, which are quite instant and quite easy. And if you have a permanent liquidity issue, that is where the issue could be, that if you have a permanent liquidity and you surrender, what is it that you get out? And you shouldn't lose too much money on that. There should be some penalty because it's a locked up product, but you shouldn't lose too much money. How much money is the penalty is a subject matter of discussion. I think that has got sorted out in the circular. If we look at equivalent products are NPS, there is zero liquidity, irrespective of surrender charges. You just cannot put. If you look at EPFO, so anything which is long-term corpus building does not have liquidity and has exists only at few points of your life stages. So if you're getting married or house, or there are 4 or 5 places where you can take the liquidity out. So actually there are no long precedences where you are building corpus as against building corpus for consumption where you have too much liquidity. So one should not, in life insurance, I believe one should not encourage that this gets into the liquidity mode. Having said that, there is a case where if there is a permanent liquidity requirement, the cost should be low. And all of us are mitigating it through deferred commission, clawback of commissions, and all of it. And I think, like many other cases, like in ULIP, like Viva mentioned earlier in the ULIP, it will all settle down. Little bit, we are all trying to protect the customers, and all of us, by and large, the industry has taken a stance that we are going to protect the customers. And between the channel partners and the shareholders, we will adjust, and some part also, efficiency will also, in some way, fund it. So I think it is okay. I don't think we should sort of get anything which increases trust in a sector is only good for the sector. I've seen it in mutual funds. I've seen it in banking. I've seen it in earlier avatar of capital markets. Anything which increases trust is good. And anything which changes the status quo is painful in the short run. Both are true.
Thank you. So you have seen banking, you have seen mutual fund, and you have seen now insurance. Now tell us, it's very, you may find it a very stupid question. Is this that we all know that insurance need to grow, industry need to grow, in kind of thing and all. But the intermediation part, and I'll start with you. Like I will do phone banking. We can invest stocks just through everything. But when it comes to insurance, it's just the agency driven. I mean, until using the, I'm not getting into the insure tech and all the other thing, but where is the use of technology to reach out to us to make it big, which in the equity markets, in banking, everywhere saying, but insurance is the same old stuff. What's happening? LIC is completely driven by agency, and you guys also too, most of you. Since you have seen all the three, just both the equity markets, now insurance, and of course banking. Just tell us, where are we in this intermediation part? And
no, so we will put in, no, I think it's a very, very sort of important point you are raising. If we were to break it up into two codes, there are products which are very liquid. Like bank FD is a very liquid product, mutual funds are very liquid products. And they're also very simple to understand. So anything which is simple to understand, anything which is very liquid, people do have courage also to invest because they can exit fast. And also they can understand because it is very simple. If you look at life insurance or any other products of locked up nature, because ours is a locked up nature, you will see either world over globally, that either it is mandated by government, like EPFO, like NPS, these are all largely mandated by government, because there is no normal method by which a person will get into an illiquid product. And also, I must also admit that because it is illiquid and the nature of the product, it is also complex. I think one of the things that industry has to do is to reduce the complexity. When we have to reduce the complexity, but because of the illiquidity, it is slightly tougher to sell. It's not a natural buy. You will see protection, which is fully liquid. Protection is fully liquid because till the time you pay premium, you get a cover. You can stop premium. You will just stop getting the cover. You will see that in protection, there is some pool which is coming from the market, automated. And you will see that large part of the protection also is being done through the proprietary sales force or direct channels. So it is in the nature of the product that we have to put it in context. What we have to do as an industry, we have to further simplify it. And all of us are working on claims, so that also increases trust. And we have to figure out that, how do you make the processes very smooth? Because if you make the process smooth, demand also generates if you make a smooth process. So there are things which we have to do. There are things which has product characteristics issue. So what are we doing on the tech? I believe that on the tech side, on the ops side, I think we are using tech reasonably well on the ops side. What we are not doing is, and we have to do more, I would say, is to simplify the processes even further. And we have to make it almost as instant as possible. ICICI Prudential, for example, on the savings side, almost 50% of the policies we are issuing same day, and we are giving commissions to the top advisors same day. No other industry that I know of gives commission the same day. So we have been able to do it. So I think it is possible to do it, and it increases trust of the intermediary. Intermediary is an important part of the industry. You cannot take intermediary out of any industry because it is also an issue of cost structure. And if you were to talk about banks or mutual funds, if you look at the cost structure over the life cycle of a policy, the cost structure of life insurance is quite competitive. If you look at the full life cycle, and you can compute it on cost by assets of the banks or total cost by assets of mutual fund, and you will see that it's quite comparable. It's the locked up nature which creates an issue.
Mahesh?
No, I think first, again, let's understand the category. This insurance category is probably forcing people to think long term. I would always say that if you're looking at short term, don't look at the insurance sector. It is like telling you to wake up every morning and lead a healthy lifestyle so that you can live up to 80, right? We are not in the instant gratification game, And today, unfortunately, the markets, the way they have behaved, I think there's a lot of interest in what you see as give and get and immediate gratification, whether it is FNOs, whether it is equity markets, etc. We're the only person who goes and sells a customer, look here, I want you to invest for 10 years. At the end of 15th year or 20th year, you will take care of yourself. So by nature, this conversation is a complicated conversation. It's not an easy conversation which says, okay, you'll make 20% return next year or you can pull out your money whenever you want. So that is why it's a consultative selling, advisory selling, and which is why it is still largely face-to-face. Pure term today is migrating more towards D2C or what we call direct-to-customer. Every other product is a consultative advisory selling where we are actually sitting with the customer, looking at bespoke requirements of the customer and structuring a policy for his requirement, right? So therefore, given the nature of face-to-face selling, it is bound to be phygital, as I would say. And I don't think globally also we have seen life insurance migrate into a completely digital platform. Non-life insurance, by virtue of its simplicity, where you pay a premium, if something happens, you get the sum assured, is easy to migrate.
Car,
right?
insuring our car, or
Yes.
which is on screen, we can do
Correct.
always.
So when I'm selling a 15-year product, 20-year product, when I'm selling an annuity, it's purely long-term, and therefore it requires consultative selling, which is why you have banks on one side, bank assurance, which is a major distribution channel for the industry, and secondly, the retail agency, which is basically another distribution channel, right? As far as digitization goes, I think Anup spoke about our front-end digitization. Increasingly, I think what we are looking forward to is on the underwriting space, using data analytics, using a lot of artificial intelligence, etc. Facial recognition, we are working with our reinsurers. Can I click a photograph of Tamalda and say how healthy he is, right? Can I do underwriting based on facial recognitions? Can we get data across the stream of morbidity and mortality together in one place where we are able to underwrite swifter and faster? I think those innovations will probably happen in this phase. COVID pushed all of us towards digitization of our processes for policy issuance, which worked brilliantly. For 2 years, we ran companies sitting at our home, and every claim was paid and every policy was issued. I think in this phase, you will see this happening over the next 2-3 years. Maybe our underwriting processes will become even more data-driven, AI-driven, human intervention-less underwriting process, which will lead to probably better customer experience.
Viva, you want to add anything?
No, I completely agree with my co-panelists that during COVID, if 60,000 crores of claims were paid without anyone coming in person, surely we've reached some level of digital maturity. I'm also of the view that there's a lot happening, like Anup said, behind the scenes on many of our other processes, AI, ML, facial recognition, Meditech, cloud, using various apps, API integration, and so on, voice recognition. Might not be as visible. I'm also of the school of thought that Mahesh mentioned, that I would rather that a potential policyholder takes a little bit of time, maybe an hour on a weekend, to think through, because it is bespoke, that I have 2 kids, my spouse is not earning, or I have aged parents to look after. Each one's situation and requirements vary. So this is not a fixed deposit. This is not, I just invest in, or a car insurance. So I think this kind of instant technology augurs better for those kind of products, but that's not to say we don't have that technology, we do. But I think a phygital model is here to stay and is here to stay worldwide as well, and nothing wrong with it. But right now we have instant claims, instant servicing, frictionless onboarding, and so on. And I think we can get better at that. We can get better, for example, a family view. So these are all the things that I'm sure all my colleagues and at HDFC Life that we are trying to solve for, on how to reduce friction, how to ask lesser questions. But that doesn't mean that we will do away with intermediaries. So the phygital process, I think, is a more evolved process that can be a bespoke solution provider.
You spoke about data, and then everybody's now, you remember the incident which happened about 2 weeks back. On the media headlines, it hit that one particular insurance company, the data leakage being sold and all. So how secured? I mean, all of us now, would think twice, thrice before actually buying an insurance cover, because it looks like that data is compromised. So how do you react to that?
Well, first, let me say that honestly, in the insurance sector, we are still scratching at the tip of the iceberg on our use of data. There's so much more that we can all do with data. Let me give you an example, for instance. I'm underwriting the mortality of a particular individual. If there is data available which gives me track record of his accidents, whether he's had any road accidents in terms of his driving behavior, if I know whether he's been hospitalized before or not, right, if he's had no claim, etc., just look at my ability to detect frauds and ability to actually offer a very, very customized insurance policy which may be absolutely apt for him. So today, I don't think we are using data effectively in the industry. I think IIB is working at it, and all of us need to start looking at publishing an insurance score. If you can have a credit score for a customer, why can't there be an insurance score for an individual? And if my insurance score is worse than Anup's, maybe he deserves a better premium than me,
yes.
right? So all this, I think, is the potential of data analytics, fraud detection, instant policy issuance, better underwriting, etc. But having said that, we are in the era of consistent watch over cyber attacks and cyber thefts. This is all pervading all industries, whether it is airlines, whether it is banking, whether it is insurance companies, etc. So this is something that is happening around us in the ecosystem, and all of us have to fortify our systems, take data seriously, take our purging policies seriously, take our file transfer protocols seriously, look at our VAPT and vulnerabilities extremely seriously. And I think all these incidents only keep on highlighting the need to do more. But I don't think there's anything specific happening in the insurance sector which is different from what's happening in the larger industry. But having said that, I think the fact that data is going to become more and more valuable to us and to the consumer, and the DPDP Act, etc., coming in, I think the level of investments, consciousness, and the commitment to make sure that data is secure and data is managed effectively is very important. I don't think there's any other choice but to use data effectively and secure it effectively.
All of you want to add something?
Yeah, so on the data side, it is a critical area, but again, life insurance, as different from banking and capital markets, it's not a high frequency business, it's a low frequency business first. So from that perspective, your surface area by which the attack can come also is lower, number one. Number two, on the banking and mutual fund side, actually your net worth can be taken out. Here, you can only take the PII. So there you can take the information out. You can also take money and net worth out. Here you can take the information out. You cannot take the money out. Anyway, you are accusing that policies are all illiquid. So, there is no question of anybody stealing and taking any money from us in any case. And anyway, they will come under surrender value then, as you're mentioning. So you cannot take net worth out, and that makes it very different. But we have to be careful because we may have health records. And health record is very sensitive. PII is very sensitive, health records even more so. And IITA now is also, pushing and nudging all of us to really up our game on cyber security. I think it is very critical, again, from a trust factor, that the trust must increase, and incidents like this, lesser it is always better. But these incidents have been there in banking, these incidents have been there elsewhere also. Of course, there was an unfortunate incident that we saw 2 weeks back.
Diva, you want to add anything, or we can shift to, yeah. Please.
Yeah, I think we are at a stage amongst, in the life insurance sector that we are aware and responsible as a sector on, especially on health records. So while we want to, your earlier question on technology, and we want to try out many things, maybe we want to try out on Meditech and so on, but containerization of those health records, purging, I think we do take it fairly responsibly. Also, many of us are part of other large financial services groups. So apart from what we do suo moto, but also overall as part of the larger financial group, there are many other restrictions and responsibilities that are enforced on us. Plus our regulator of late has also upped the ante in terms of requirements from all the regulated entities to look at many of these safeguards so that customer data is not compromised in any manner.
Just talking about data, just two follow-up questions. One is this, insurance is all about mortality and probability. Like life insurance is all about that. When I will die and how long I will live. These are the two sides of the same coin. So one of the key factors for your risk management and underwriting is the mortality table. Okay, correct me if I'm wrong. My understanding is the mortality table, which is prepared by IALM, Indian Assured Lives Mortality Table, this called, is a decade old. 2014, last time it was revised. So how will you price the risk? I mean, aren't you taking it up with the regulator, the government? I mean, you are working on the mortality table, which is a 10-year-old thing.
So I can start off.
You are talking about data, you are talking about the real-time transaction. How scientific would be your risk management and underwriting capability if the basic data, mortality data in India is 1 decade old?
So most of us have been around for 2 decades, if not longer. And so we have our own data and experience at a very sharply defined on a cohort basis. So the starting point would have been, like you said, IALM. But since then, we have built our own data analysis at a very, very granular level. So if you see a decision tree on geography-wise, on various kinds of profession-wise, on age-wise, on COVID survivors, for example, those who have been mortality of people who have been hospitalized during COVID. We ourselves have that experience, and each one of us has that experience. So we do build our own hypothesis in terms of where we think this is going to get to, and the pricing absolutely has to take that into account. The most dangerous part is that if we ignore the kind of data that is staring at you and say, no, but going forward I'm going to get better, without any reason why you want to believe that it's going to get better. At the same time, what are the trade-offs? Because mortality, most of us have family members who are now in middle class, comfortably living above 80. At the same time, there is lifestyle stress. So nuances like that. Another very useful source is reinsurers. All of us do regularly engage with reinsurers to say, what are you seeing in other parts of the world? So which way are the winds blowing on mortality at a very defined cohort level? And that's how you build it. The proof of the pudding finally is on your embedded value, what's your operating variance on mortality? That's the only version of truth, because that says that versus my assumptions, this is what I'm trending at. And if that's a positive, largely a positive, then you know that your pricing is more or less right.
Anup, I mean, she is saying that is not a handicap because you guys are doing your own work and analysis. It's fine. I mean, so the industry is working on a 10-year-old mortality table.
So first I would just want to, Tamanda, I would just want to put it in context as to what is the leverage of the life insurance industry. When you have PMJJY where you get 2 lakh of cover on 416 odd rupees, you're talking of 500 rupees. For every rupee that you put, you get a cover of 500.
That's the kind of leverage.
That's the kind of
500
leverage.
times leverage.
Even for normal retail, for 25,000 you get 1 crore of cover. That is 400 times cover. And mind you, this is without collateral. It is not like banking where the leverage is 5 or 6 or 7.
Yeah.
And large part of it has collateral. So here there is no collateral.
Yeah.
And the leverage is 400. I don't think in general, whatever, I am the freshest in the sector. And when I speak to other people, I don't think people get it, that it is 400 times and 500 times. And in group term, which is employer-employee, it is 1,000 times. 1 rupee, you get 1,000 times of cover. So it is that much. Now, if we want to, the case for increasing coverage, which is the basic topic. Now, if you want to increase coverage, certainly all of us are large institutions, we have our own data. It is true. But if we see the inflection point of retail in Indian economy, it essentially came after Credit Bureau came and CRILC came. Those were the foundational methods by which really the credit started to come up, because it gives you pricing power, more accurate pricing. It also gives you a sense of where it is, and not just your data, the overall industry data, and you get to pick and choose the thing that you get. The other thing in our industry which is very peculiar is, with 1:400, 1:500, it is a great area for fraudsters to operate, because the capital required for frauding is very, very low. Is very low. It is very high in savings product, but very low in any risk product, particularly in insurance. So I would say that there is certainly a need, and it is working. There is certainly a need for IIB to be even more active and put that foundation even stronger. Put the foundation of fraud management stronger. So put the foundational elements. Use reinsurers very well, which Vibha said, because reinsurers have across the full industry data, is to use the reinsurers, and maybe regulations or also force in some way or nudge them to also share the data, because you are using the Indian data to take the Indian risk.
Absolutely.
So you must share the data back into IIB. And you even in the DPTP Act, the regulator can mandate, and it will not come under DPTP Act. So I think there is enough provision made and enough enablement for it to do it. IDA is certainly pushing IIB. IIB is also doing decent job, but I think we need to come up the curve much, much more. On the ILM table, you are right, it is currently 1214, which is working, which is a decade back. I think updated tables will come.
You have such a agile regulator. You are not asking him. You are a
No. They are already working, is what I understand. No, it's not a question.
We'll
give you a perspective on.
Mahesh, just we'll take a few questions if you have any. No complaint, no grievance after this. Make it very brief and nothing about any particular.
Mahesh, over to you.
Mahesh, please, carry
No,
on.
I'm just telling you, just to
get
give
the microphone there.
give you and the audience a perspective of the kind of data. A company like Kotak Life manages 5.1 crore lives, right? And I'm sure Vibha and Anup manage definitely more as well, right? So this is not small data, right? There is enough data that we have at our disposal, and those data cuts are examined right from demographics, geography, PIN codes, age, etc., to look at what pricing is, right? At the same time, as I've said before, I think honestly speaking, if there's one thing this industry can do better is our usage of data. Together, we can pool data the way banks, and I, again, from a banker, 2007-8 was an inflection point in India when credit score-based lending happened. And today, as we stand 10 years later, one of the robust things which have happened in the banking industry is credit scores. I go back to the fact that insurance frauds and insurance credit scores are two very, very important critical success factors for the future of the industry. Coming to the ILM tables, we have been through COVID. I think it may be worthwhile to hit a refresh button and look at what happened during COVID, because COVID did two things. COVID resulted in accelerated mortality, right? Because what had happened was inferior lives passed away earlier compared to what they would have passed away because of the morbidity which hit them, right? So it may not be a bad idea now to refresh and go back and look at it, which I'm sure the regulator and the IIB will be looking at data so that we can have a 2025 version of how the mortality is going to look like, right? So that we're able to offer our products with more knowledge and more expertise.
Amalda, sorry.
Yeah, please add.
I want to use your platform to make an appeal.
Please.
And that is, we can significantly move the needle as a sector if, at least where subsidized hospitalization is given by the government, that Aadhaar is made compulsory. Once Aadhaar for any in-patient treatment is made compulsory, then a score can be built. Of course, there will be data protection. Of course, there will be customer consent or patient consent. But if somebody who's, say, in a small town tells me that even a Hubli kind of a place, who gives us the assurance that last 5 years I have not been hospitalized in any government hospital, especially slightly more disadvantaged society. That will give us as insurers a lot more comfort. Now, if NHS can do it, that you cannot get NHS treatment in the UK without your social security number. Like that, so I'm only talking about government hospitals.
Sure.
And I've said this to the government as well. It can help give us that data, of course tokenized, anonymized data, but give us something to hang our hat, like Anup mentioned, for giving credit.
Sure. I mean, till the time that credit score, etc., here, what would be the equivalent of credit score being built in the insurance sector? At least you need to have access to my health. I'll come to that. I have I think, interesting question on that. But before that, let's, anybody, yes, gentlemen? We'll come there. Yeah, please. Just make it very brief and introduce yourself. Yeah, mic is on, sir.
Good morning. My question is to all the panelists. Anybody can answer. I am Samir Kumar, an ex-banker and a corporate trainer. My question is with respect to unclaimed policies. I read somewhere that around 7 million policies are unclaimed, around 22,000 odd crores. What the insurance sector, nothing individually of any of the panelists, insurance sector as such, what are they doing to reach out to the families of such policy holders to settle those claims?
Thank you. Yeah, whoever wants to. Mahesh, you want to?
Thanks for the question. It's a topic which is on the mind of everybody these days, right?
Please.
So where does unclaimed come from? Let's understand first of all. It's coming from old policies where, unfortunately, we don't have current data about the customer in terms of the PII information, contactability data, and banking data. Otherwise, today, all of us are remitting funds into the customer's bank account on surrenders and maturities. Since these are policies which had matured 10 years back it was taken, 15 years back it was taken, we are finding it difficult to have current data about the customer because he's moved on, changed his house, or didn't have a mobile number at that point of time. So customer contactability is at the root of this entire problem of unclaimed, and all this pertains to policies which were issued in the past. For the last 4 or 5 years, or even maybe even a little bit earlier than that, all of us today have very good information. Today, before we onboard a customer, we do an IMPS check in terms of doing a penny drop on his bank account, even before we issue a policy, right? Now, what are we doing about it? I can say proudly at Kotak Life, we are one of the lowest in the industry in terms of unclaimed, and we use social media. We have an entire team tracking customers across LinkedIn, across Facebook, across Instagram, to see whether the customer is leaving any footprint in the social media. We have gone to people's houses, we have gone to people's villages and inquired about their current contacts, etc. And that is what has been helping us in keeping the unclaimed amount at a fairly low level. So I think from an industry perspective, we are all conscious about it. We really want to give back the customer's money, right? As a customer-oriented organization, we don't want customers' money. It's his money.
Thanks.
He should rightfully take it back. But there are issues and constraints because of the past data, which is not currently valid.
Thanks, Mahesh. Yeah, just the gentleman, yeah, please, give an, you're coming.
Good morning, ladies and gentlemen. This is Mahesh Bhatt from Kirti Corp, independent software vendor and business consultant. Simple question, a very vanilla flavor. In health insurance, we always find certain deduction happens once we submit a claim. Would like to extend this thought. In life insurance, if the claims are given, how much is 100% return? Whatever you commit, you give back to the so-called aggrieved
thanks.
person?
Thank you.
And how much is cut? Ratio, proportion, some
Thank
indicators.
You. Yeah, Viva,
As of gross.
do you also?
There is no question of a cut.
Okay, thank you.
You have to pay whatever is the claim. So if there is a claim of 1 crore sum assured, then you have to pay 1 crore. If there is a fraud, then typically after 3 years, first of all, after 3 years, we in the normal course of our investigation, we cannot deny a claim. Before 3 years, we will be, if there is a fraud, then typically we would return the premiums and not pay the claim. And the individual or the beneficiary has the right to go to the ombudsman, and there's a due process to be followed if they feel that they are aggrieved.
Thanks.
Just to
Viva.
clarify, please understand, health indemnity products are indemnity products, indemnifying a customer up to a value of X amount. Whereas life insurance policies are fixed benefit products where it's a 0 or 1. If you settle a claim, we settle fully. In health insurance, there are indemnity products. That's why you have a limit up to 5 lakhs, and therefore the deductions happen based on what the insurer sees as the right amount to pay.
Yeah, this gentleman, please, quickly.
I'm Nagesh Alai from Avananta Innovations. It's a Gen AI startup. My question is this, even today, why is there a dissonance in terms of selling the product? Premium to me is a cost. Insurance is a cost, but it's always sold as an investment product. So why is it continuing that way? Even when the agents talk to you, they talk about it as an investment product.
Okay. Anup? Yeah.
No, I think there are broadly sort of 3 categories of product. One is a pure protection product where there is no savings, but because it has medical and other things involved, you know, there are certain category of advisors who don't offer or don't sell those products or offer that product that much to the customers. Then largely you will have all corpus building product, accumulation product, where you are paying for some time and the corpus accumulates. And you will see large number of advisors are into corpus building products. And third are deaccumulation products, where corpus is already built, and then you have to convert it into income, which is annuity products. Now within corpus building products, you can have sort of what we call guaranteed products, or we have participating product where all the profits is sort of participated, 10% we keep, 90% we give. The fact of the matter is that you are right, that in India, as you know, Tamalda earlier said, the protection data and protection awareness is not that high, and on the younger categories where they require protection. Younger categories where they require protection, and as you age, you require more corpus. And that is where bulk of the advisors sort of focus on. But we are seeing the trend that the younger guys, they are coming more online and they are taking protection largely, so the demand is self-generated. On the other side, the demand is getting generated. So predominantly you will see from an AUM perspective, you will see it is larger savings and investment, corpus building products or deaccumulation products like annuity.
Thanks, Anup. I have many more questions, but unfortunately we don't have much of a time. But one thing I want to ask each of you, yesterday cyber crime, fraud, etc. dominated discussion in the second half of the day. Now in insurance, I understand there's a fraud, it's happening, continuously been happening. Nothing to do with cyber crime, it's a very different thing. I'm talking about the path labs. Now, if I'm giving you my reports, etc., in major metros or big towns and cities, etc., everything is fine. But I understand that particularly in rural India, mofussil towns, etc., path labs is a big racket. What they have given the health checkup, etc., it's all rubbish. It's just always in the favor of things. So it's a very large-scale fraud. So in that context, and IRDA chairman is not here, so do you think there should be a health regulator separately? Others, how do you tackle this? Mahesh, you are smiling. First, do you agree what I am saying? Is it my observation correct? And if it is correct, then how do you address it? Is the separate health regulator, which does not exist in India as of now? I don't know globally what happens. Just quickly, we don't have much of a time, but...
No, India definitely is underserved in terms of number of the path labs. We have about 80,000 path labs. I think that number can definitely go up multiple times to cater to the growing demand of what you call testing and diagnostics by customers and insurance companies. Now, coming to health authority, I think that has been one of the biggest requests from the industry, saying that it's time we set up a health authority, only because the variance in the value of the treatment across the country is enormous. There has been huge amount of medical inflation hitting companies, hitting insurance companies, because of the fact that there is variance and there is also escalation in the costs, right? So the industry has been requesting for a national health authority, which can probably help bring in some amount of stability in the medical costs. As far as path labs are concerned, I think accreditation of path labs will definitely help, because there are frauds happening there. In fact, what I would like to have is probably biometric-based authentication at the path lab, because today implants or impersonation is a big problem that we face. No? X buys a policy, Y goes and actually does the testing, right? And we are unable to detect it. So I think if we can have a biometric-based network, which can also help the path labs, and we get data assurance that, look here, the right person has gone. And of course, the quality of path labs in terms of accreditation. Other countries have had this accreditation. Will it help? It will help. But today, is it such a big problem for us? I don't think it's such a big problem. But impersonation is something that we would like to control.
Thanks, Anup. IRDA chairman is here. For your information, what I asked him is this. We understand that path lab is a big racket in rural India. They're not very credible reports, and it's actually amounts to a fraud. So should we have a health, some regulation, kind of health regulator or whatever you call it? I know this erodes your your empire, IRDA empires. I don't know how frank they will be now. You have come. So he's listening. Anup sir, tell us.
No, I think it is...
I mean, you must be meeting at various fora and closed-door meetings, so you're not scared
it is
of
about solving the issue at hand. I mean, whether A regulator does, B regulator does, whoever does is not the issue. The core issue is that certainly if there is any fraud that happens, in general the cost of the industry goes up, in general the trust of the industry goes down, so accreditation method is a very useful method, and fraud registry is a very useful method, because if you have fraud registry, then you avoid, and that's how the market also develops, that only to the good guys if you go, then you can have straight through processing. If you don't go to a accredited person, then there will be, other issues, or the prices will go up. Because the market also has to kick in addition to the support system of accreditation. Who does it is a subject matter of a larger debate. But this is a requirement.
Sure.
Because 1:400, 1:500 is a risk that we run.
the highly leveraged,
Highly leveraged. Because for 416 rupees, when you get 2 lakh of cover, it is 400 times, 500 times cover.
PMGGO
fraud,
you're talking about.
So fraud is an important element to be curtailed.
Biva, quickly you want to add anything?
Yeah, both in terms of path labs and claims investigators, both ends. So this collusion, and like Anup said, the cost goes up for the honest policy holder and brings, the trust deficit that you will never pay the claim, because it is possible that the intermediary is colluding, not the end customer. And the family thinks that the person has, their loved one has adequate insurance, and we're denying the claim. We are in the business of paying the claim, not denying the claim. So if the ecosystem also behaves, then the cost of insurance can certainly come down. And that is important through IIB certainly, but also they mushroom. So if you blacklist one, they mushroom as something else through another set of people, the same guys.
Thanks.
So this is a menace, and regulating in some manner, some method in all of this will bring down the cost.
Yeah,
and
I'm sure
trust.
regulator is listening. So we have just almost 20 seconds left. So just 10 seconds each, you can say that. There are lots of interesting products, etc., happening in the general insurance. Priyanka Chopra insured her smile. Rajinikanth insured his voice. Okay. all kind of things. Even the wedding events are insured if some natural calamity or something happens that it get cancelled. So is there anything happening in the life insurance sector when it comes to products? And one more on the adjacent thing, we can just have 2 sentences each and we'll close that. Yesterday again, we for the first 2 days discussed that this mutual fund sahi hai. Then it comes to spills over to bank deposit sahi hai. So that's the kind of new approach to to make it more awareness, creating awareness and all. Insurance, again, I was telling you, agent driven. So if I ask you to create a slogan which will be, every household will talk about that, and what would be that for life insurance?
Insurance zaruri hai.
Okay. And the first one, insurance zaruri hai. And the first thing, any products, anything we can expect?
No, let me say that honestly speaking, between life insurance and general
Say for
insurance.
Kotak, it's a marketing platform. You can. Or for each
yeah.
of you,
If you
tell
want me
us
to
that
say
this is
specifically,
something
we were
coming
the
up.
first company to launch a cover for the next generation. You buy a policy, Tamalda, right? You live till 60, right? Normally, you don't need term insurance beyond 60 because your earning years are almost over, right? So we return the premium to you, and in the same policy, we cover your child, right? Till up to 60. It's called Gen to Gen, generation to generation. We have launched this product a couple of months back. So that's an example of innovation.
Any unique product and a slogan?
Now, I think in general, we have to move towards simpler and simpler products, more complex and more unique products.
No slogan?
No, more slogan is this only.
Achha.
Slogan is this only.
Viva, last word is yours, and that's the end.
Yeah, on a lighter note, you said somebody insures somebody's smile. I think we insure somebody's sleep. That they can sleep well
Somebody's
at night.
sleep.
Yeah.
Achha.
So by buying life insurance in any form and pension, we are trying to ensure people's sleep.
Okay.
That you don't have to worry about things.
Okay. So don't sell it now because I don't want people falling asleep when regulator is talking. Okay. Give them a big hand, and that's the end of our thing. Thank you.
Thank you so much for that incredible discussion. Can I request Mr. Tamal Bandyopadhyay to present our panel members with a memento? I think incredibly insightful session with pertinent learnings like policies are typically purchased for long-term security rather than short-term liquidity. Surrender generally occurs in cases of serious permanent liquidity needs. Overall, the industry needs to aim to build customer confidence in the life insurance as long-term investment tool, reassuring them about policy stability and in evolving regulatory environment. An appeal that was made was that if we can significantly move the needle as a sector, at least where subsidized hospitalization is given by the government, then Aadhaar is made compulsory. Once Aadhaar for any inpatient treatment is made compulsory, then a score can be built. We also spoke about the potential risk of impersonation and how biometric system by Path Labs can actually be a cope-up mechanism. So I think again a very pragmatic panel. Can we give them a huge round of applause, ladies and gentlemen? All right, ladies and gentlemen, as stated before, the Business Standard BFSI Summit not only brings to you the C-suite from the BFSI world, it also brings to fore policy makers, decision makers, the regulators who play a significant role in creation of enabling ecosystem, giving the boundaries in which BFSI can really conduct itself. And it's very important to hear firsthand from them about how they visualize the future and the trends. So today, we have the privilege of having with us the chairman of IRDAI, Shri Devashish Panda. Can we give him a huge round of applause, ladies and gentlemen? Mr. Panda, can I request you to please join us on the dais? He's a distinguished leader from the Insurance Regulatory and Development Authority of India, an organization that stands as the backbone of trust and stability within India's BFSI sector. IRDAI, ladies and gentlemen, plays a pivotal role in ensuring that our insurance industry is not just robust and resilient, but also innovative and inclusive. As our world evolves, so does the need for insurance solutions that cater the diverse needs, from protecting individual aspirations to securing massive institutional investment. At this juncture, to render the introductory remarks, can I call on stage Mr. Shailesh Dobhal, Editor, Business Standard.
Thank you, Ridhima, and good morning, everybody. On behalf of Business Standard, let me extend a very warm welcome to Mr. Devashish Panda, Chairman of the Insurance Regulatory Development Authority of India, to this third and the final day of Business Standard's BFSI Insight Summit 2024. Mr. Panda needs no introduction, but I'll still do it for form's sake. Ms. Panda is a 1987 batch IS officer of the Uttar Pradesh cadre. He joined as chairman IRDAI on 14th March 2022. Mr. Panda, before that, has served as Secretary, Department of Financial Services, Ministry of Finance, Government of India. Mr. Panda is a postgraduate in physics and has also done Masters in Development Management. He has also got an MPhil degree in Environmental Sciences. He has undergone foreign training in public administration from USA and the Philippines. Under Mr. Panda as chairman, IRDAI has effected many changes aimed at improving existing players' ease of doing business and attracting fresh capital into the sector. In just 2 years under his leadership, 6 new entrants have joined the industry, marking the first additions in the life insurance segment in over a decade, and the first in the general and health insurance segments in nearly 5 years. Mr. Panda has consistently emphasized that 70 insurance companies are insufficient to meet the needs of India's 1.4 billion people. He has encouraged a diverse range of investors, including private equity firms, venture capitalists, domestic institutional investors, and conglomerates to invest in the insurance sector. Mr. Panda and IRDAI under him has committed to increasing insurance penetration, and the aim is to have every citizen have an appropriate life, health, and property insurance cover, and every enterprise should be supported by an appropriate insurance solution by 2047, when we are aiming at becoming Viksit. And in order to help the industry move towards this target, the regulator has taken a series of steps aimed at reducing regulatory and compliance burdens. IRDAI, under Mr. Panda's leadership, has also floated the concept of Bima Trinity, which includes Bima Sugam as a marketplace, Bima Wahak as a women-centric agency force in rural areas, and Bima Vistar, a comprehensive product that combines personal, life, and property insurance. Many thanks, Mr. Panda, for agreeing to be with us here and the trouble you took to travel from Hyderabad to join us at the BFSI Summit. May I now invite and request my colleague, Tamal Mandopadhyay, Consulting Editor of Business Standard, to please come up on stage and start the fireside chat with Mr. Panda. Thank you so much.
Good morning and fireside chat. We are just in the beginning. I don't want to repeat, but I was talking about a Swiss Re report, and it's talking about how India is emerging as the fastest growing insurance market, and giving the 6 reasons behind. One of the reasons is the regulatory developments. So thanks to you, that's what's happening. In our private conversation, once I used that is a Panda Express, because you are so fast doing, and people got upset. No, he's not an express, he's a bullet train. So that's it. That's what I mean, you are playing a test match with the temperament of T20, but not the India team, which you got defeated by New Zealand recently, whitewash completely. Not that kind of thing, but in the right spirit. That's what I'm saying. So first thing I want to ask you, Panda sir, is this. When you talk about banking and capital markets, in banking, what happened since banking nationalization in 1969 and now, I think the last 10 years have been far more interesting, which gives a kind of real architecture of banking, the credit bureaus, UPI, everything. For capital markets, we have NSDL, CDSL and all. But for insurance, we don't see that kind of infrastructure as yet. It's primarily agency driven, that's it. I mean, is there any plan? We have been doing so many things. For the real architecture, what can we expect from you?
Thank you for having me here this morning with a very august audience. And insurance certainly has to reach every household, has to touch every citizen, has to touch the enterprises. And that is for sure something we would all like to see that happen in our lifetime. And when we are talking of Viksit Bharat by 2047, it is definitely imperative that we need to have a fully insured society, a fully pensioned society, a fully banked society. That goes without saying. Having said that, in the last couple of years that I have been assigned this responsibility, we have understood what is the system, what was the system that existed, and also looked at whether the regulatory system provides ample opportunity to what the policyholders or the prospects would expect. For IRDI, the policyholders and the prospects remain at the core. And keeping them central, everything is focused towards policyholders first. We looked at the agility of the framework, we looked at the progressive nature of the framework, we looked at whether it is adaptable, whether it gives enough of flexibility, operational flexibility to the insurers, and similarly for the intermediaries. So that at the end of the day, what we are looking at is how insurance should be made, first and foremost, available, then accessible, affordable, and over and above, how do we build trust insurance as a product amongst our countrymen? That's the biggest challenge, the trust factor. Now, in order to do that, the first and foremost was to, completely revamp the regulatory system, looking at whether it provides for all the 4 components that I mentioned. So we did it through a multiple review by constituting several committees comprising of the stakeholders as well as the regulator, and found what are the gaps and what are the necessary ingredients that should be brought into that system to make it more agile, more adaptable, more progressive, more vibrant, more forward-looking, and to cater to the customer needs. In terms of, typically India, it's not a one-size-fits-all approach will be possible. What I can buy, my driver cannot afford to buy that, and what the others can buy, I cannot buy that. So you need to have products, multiple products for different income sizes, for different pocket sizes, for different occupational categories, and so on and so forth. So the first and foremost was to revamp the regulatory architecture, which it is possible today. What has happened with a very progressive one, moving away from a rule-based to a principle-based approach, could happen, and I would give full credit to my team at IRDI who took up this challenge and gave their 100% to create this framework today, which is actually evincing a lot of interest amongst international investors as well. Number 2, nothing can happen without the help of technology. For a 1.4 billion population, you just can't physically reach out to each and everyone, no matter how hard you may try. You cannot bring in those efficiencies which are required into a system. So technology was something which was the topmost of our mind after the regulatory revamping or creating a new architecture. Then apart from technology, what you need is data and digitization. Typically, all of us understand very well the power of data in the insurance sector. When we talk of insurance affordability, we also talk of the law of large numbers, which is typically the suits to the insurance sector. Insurance sector is also different from the banking sector because banking sector looks at individual pricing or entity-wise pricing, but here it is pooling of the risks. So therefore, it becomes slightly different as far as the capital requirements are also concerned. So the pricing part, the reforms also has taken note of how do we make it affordable. Now, but we don't want to do the micromanagement. The market should determine the price. And typically, I believe in that philosophy very clearly that the regulator should not be getting into pricing. But what we have tried to do is build safeguards to protect the policyholders, and therefore all those multiple cap, segmental, sectoral limits, everything removed but there is a limit on the overall expenses of management expenses at the company level, thereby allowing within that range, you decide what you need to remunerate to your distributors, what you need to spend on advertisement, what you need to spend on your management. Now, that's the first year, and now we are getting into the second year of that regime, and so we are also engaging with the, the insurers to see where they stand. So, data. Going forward, you see, there will be more and more of personalized pricing possible. And with the millennial population, they will demand products which we call DIY, do it yourself. The millennial will say, I want a payout after 5 years, X amount. After 7 years, Y amount. After 10 years, that amount, you tell me what is the premium that I'm supposed to pay to you. So these kind of personalized and hyper-personalized offerings, better risk pricing so that what you need to pay, I need not pay the same amount. Or what I need to pay, he need not pay the same amount. So that is the modern trend, and it has to go, and that will be possible with the help of data, digitization, and technology. Then the moment of truth comes, that is when the claims payment happen. And that is the challenge again. As one of the speakers said that we are not here to deny claims, but to pay claims. Now, how does that happen? How does that actually translate into being? So there are challenges. It's not that we are not, but what is that moment, as you said, for the UPI and the credit bureaus did for the banking, the demat accounts and the CSDL, NSDL did for the markets. So here, the Bima Sugam, which I think you raised a question. The Bima Sugam is going to be a public digital infrastructure, keeping the policyholder at the core to offer an end-to-end journey of the life cycle of the product and even beyond. Buying, selling, payment, getting the policy both in a digitized form as well as a physical copy if he or she so desires, servicing requests, claim processing requests, and then the choice that he will get a product. Today, there is a limited choice of products available to the customers because obviously an agent or an intermediary will not be an agent to all the companies because there's some kind of architectural constraint also that you cannot go beyond the numbers of tie-ups. What is within our realm, we are trying to open it up in a gradual manner so that ultimately the policyholders or the prospect gets more and more choice. And I think typically if you ask young people, they'll look at all the products that are available on the shelf. So the Bima Sugam will be the electronic marketplace where products of every company will be displayed on that marketplace, on that platform. So it will help customers exercising their choice. The distributors will benefit immensely because they are able to complete a transaction at a much lesser cost and price and in a much lesser time. So where they are able to sell one policy a day, they'll be able to sell 20 policies a day because they are going with the marketplace to the doorstep of the customer. So Bima Sugam will be the game changer, number one. Then the data analytics, advanced data analytics that we are trying to develop at the Insurance Information Bureau, which is also getting a new look and a revamped look, will help in providing all the analytical information, insights, and data for the insurance companies to do the personalized risk pricing. The third will be the data and the digitization. So data, digitization, and the Bima Sugam will be the game changer as far as insurance is concerned.
That's the new architecture. That's the new architecture for your inclusive growth, which, I mean, many of the things that you are doing now, which the banking system had seen probably early this century, this inclusive growth, that SLBC model, which the banks follow, that you are following. It's a phenomenal work you are doing. And what you rightly said is this affordability, accessibility, availability, and trust. Now, talking about the data, one key question is this, and in my interaction with the industry, we find is there's this, that insurance is far more leverage business than banks. Banks, you're talking about normally maybe 10 times, maybe 7 times small finance bank, they are 15% capital adequacy ratio, etc. But here it's a 500 times. For a 416 rupee premium at PMJDY, one can get up to 2 lakh. So, but then we find that the insurance mortality table, it's 1 decade old. I'm sorry about saying this, you may not like that. Insurance Information Bureau also finding it's very difficult. My understanding is this: a very large player, I would not like to name that entity, is not cooperating because that particular entity probably thinking that why would I share the data to get the to the industry will get the benefit. So it's not happening the way it should happen. Am I correct in saying this? Because data is the key for risk management in this hugely leveraged business. I'm through, sir.
Okay. So possibly, if I've heard you correctly, you have asked 3 questions. So to answer the first with regard to the leveraging, banking and insurance, I think I made an initial hint.
No,
but
that's
let
a
me,
context. That's not a question. Huh?
So typically, I would say that they are quite different from each other. Where I said there is a pooling of risk, whereas here it is an individual pricing. Moreover, insurance, we should all note that insurance pricing is calculated on a very scientific footing based on the actuarial principles. So there is a method and there is a science behind it which the pricing and the calculations are done. So therefore, it does take care of the risk part, and accordingly the pricing is made. But yes, going forward, if we have more data, then we'll be able to price it better. Now, the second aspect of I think you asked about the capital requirement with regard to JJBY or FSBY. See, these are low-ticket items, and these low-ticket items have been priced just for the keeping in mind the affordability also. And secondly, also to initiate people who are new to insurance into insurance. The flagship programs have done an excellent job in terms of providing the security or the protection that was required. And I'm happy to share that I have gone through some of the testimonials and also the interaction which has been held at the highest level with the beneficiaries. People have used that money to pay off their debt because the breadwinner passed away. Part of the money that they got as insurance, they kept it for the education of the children. So even this 2 lakhs of rupees have come in very, very handy at critical times. And secondly, there is a built-in mechanism that every 3 years the price will be reviewed and it will be suitably priced. And that has happened, although after a little longer gap. Now, secondly, for more efficient utilization of capital, we are moving from the factor-based solvency to a risk-based solvency. Work is in progress.
2028 FY, something like that?
We in fact, we are having a Bima Manthan only next week to work out all those details, because we are doing it in close consultations or collaboration with the industry, so that they also don't get, there's a major disruption. We want it a smooth transition, but to happen because it is in the larger interest of the ecosystem that the capital is utilized more efficiently. So that work is in progress. And hopefully 2025 we'll see that happening before the end of 2025. Now, IIB is a sector's data repository, right? But we want it only not to be a repository, but go much beyond it in terms of, as I said, advanced analytics, insightful data sharing, information sharing, which will be utilized by the industry for pricing, for underwriting, for claim processing, for fraud prevention, etc., etc. A large number of tools have been developed. If I can name some of them, then, you would have seen that the Quest, the Prism, the Inkling, and so on and so forth, the Prowess, the Caution Repository, all of this is providing critical insights to the insurers. And if I'm not wrong, there is one tool where more than 300,000 cases of life insurance frauds have been, that could be avoided, and that could have led, and the sum assured was more than 1 lakh crore of rupees. So But having said that, we are trying to make it even more vibrant, more dynamic, and also, today the industry is very, very closely participating. All the life insurance companies are participating, all the general insurance, all the health insurance are participating. The flow of information for life, for the savings and annuity product is coming smoothly. Gradually, the other set of data is also going to flow. The systems are being built at the back end. Every company is getting integrated with the IIB through a unique API interface. There's a single point of contact today available with who will interact with the IIB. Periodic meetings are being taken both by the IRDA as well as by the IIB themselves. The industry does understand the importance and the power that the IIB has in it, which will be helpful for the industry. So I'm pretty much sure that the IIB going forward will become a more robust and a more advanced data analytical center, which will help the industry in prevention of frauds and also facilitate them in pricing, underwriting, and other stuff. What was the third? I think 2 questions I have answered. Third one was
okay. Now tell me, this Bima Sugam that will change the entire architecture of the distribution and all. So what happens to how would this 30 lakh odd agents, how would the insurance sector handle them? And one unique factor in insurance is this: in anywhere you see, in banking, a mutual fund, everywhere, the agent's commission is staggered over a period of time, it's amortized. But in insurance, continue to be upfront. And it sounds very, 30% odd. So on the beginning itself, first installment, this guy's pockets it. Can't it be in a different way, staggered thing, which happens in the banking and other places?
You see, you talked of the Bima Sugam, how it will help the distributors. So what does Bima Sugam do? It facilitates easy access to insurance for the consumers, and also it will enhance distribution opportunities. Today we need perhaps 3 times the number of distributors that are there in on the ground to cater to 1.4 billion. Now, how do you expect them to be more efficient? And I fully recognize that an agent or a foot soldier who is going to the market to buy or to sell insurance, obviously at the end of the day, he needs to have some income to feed his family. Now, the Bima Sugam, supposing I go to a customer, I go with one product, the customer doesn't buy, he says, sorry, I want a choice. Then I come back home empty-handed. With the Bima Sugam, I'm sure I will be able to sell one product, not one product within the same time frame. I may be able to sell to 10 other people also, because the transactions are everything happening online. The customer need not give a the ID requirement, because it gets auto-populated through the Aadhaar authentication. Because the Bima Sugam eventually is going to get connected to the India stack. So the KYC happens on the system itself. The payment happens through the UPI on the system itself. The underwriting machine of the concerned company, the product I am buying, works immediately to generate my policy. The policy comes to me as a customer to my mobile phone in a digitized form, and if I need a physical form, I have physical copy, I can go and get a printout from the CSC or some other, wherever I wish to. So the distributors become much more efficient, and the remuneration would grow, the opportunities would grow, and therefore the remuneration structure will automatically even out in a manner that more and more people buy insurance, the base gets expanded, more agents get employed, and they sell more policies, they earn more.
No, but still,
that is how it will work.
That means that I cannot access Bima Sugam on my own. It has to be through the agents.
It will be.
Will the Bima Sugam, that agents will carry Bima Sugam in his hand on his mobile and sells it to me. I cannot access it on my own.
You are carrying it in your mobile phone, you can carry it on your laptop, you can carry it on your tablet, or you can open the computer desk.
So then where do the agents come? How can, they're not there anymore, right?
Who?
The agents?
The agents will do it through their smartphone.
No, my question is very simple. If I am directly accessing it, why do I need the agents?
Still, you see, insurance is still a product. For example, a life insurance product. It's a complex product. You need to understand the features of that
So they
product.
will, the
So
agents...
you will still require assistance.
Okay. Okay, that's what I want.
So, and secondly, the suitability, the need, what is the income level, how periodically I have to make the payment, when will I get, all these questions will automatically not get answered. So I may still require an advisor to help me buy the right product which suits my pocket size.
So they are not on the streets, they will
Certainly
continue to
not.
get it.
I am saying that they will earn more and more people will get employed.
Okay. Talking about this, the productive use of capital, banks, if I am overloaded on the asset side, I can go and sell off, securitize and all. The equivalent of that in insurance should be reinsurance. But somehow in India, I don't see that reinsurance market the way it should have been. I mean, is it IRDA's focus now also to help the reinsurance market to grow?
We have also made a series of changes as far as the reinsurance regulations are concerned. And opening the door for more domestic reinsurers also to set up shops. We have got one application which is under process, a domestic reinsurer. We are looking at, the other big investors to also get into the reinsurance space, who are already in the primary insurance space. We are looking at cross-border reinsurers who are operating from their jurisdiction also to come to India, either become a FRB, that is a foreign reinsurer branch, or become a domestic investor, or set up a shop in Gift City so that our reinsurance capacity in the market grows. Insurers are also at their end. There's a typical year also to retain very little risk with them and give away more risk to the reinsurers. So that rationalization is also happening. But at the same time, creation of reinsurance capacity is definitely a priority. The new regulations is moving towards that. And hopefully, in the near future, we'll see more reinsurance players entering into the domestic market as well.
I'll come to the regulations part later, but before that, one question I'm asking you to tax related, not on GST. That's a lot discussed and all. So, insurance is a long-term product. And insurance is, the money is a key to, it's a cliche, but just say that our infrastructure building and all. For home loan, we get tax benefits. For pension fund, etc., national pension scheme, we get tax benefit. Why not IRDA push for something for this long-term insurance, some kind of tax benefit for the customers? Because at the end of the day, for the nation building, infrastructure building, that's the key. I mean, now it's, of course, from last year, it happened that up to 5 lakh, there is some kind of tax benefit is there. But for the long-term investment, like the national pension scheme, like home loans, shouldn't there be a tax benefit, you think?
No, I fully agree that if there's a tax concession, it definitely be more attractive. Having said that, you're right that in a long term will provide more financial stability, financial protection to the household. It will also contribute to the economic stability. All of that are well taken. But at the moment, also I think quite a bit of tax concessions are available, like Section 80C. Deduction for premiums paid in life insurance for up to 1.5 lakhs is available. Section 10D, where the maturity proceeds of life insurance policies are tax-free. Section 80D, deductions available for health insurance premiums, that is for encouraging health coverage. NPS, you have the, the eligible for tax deduction under CCD, and also reinforcing the promotion for long-term policy. So these are available.
That's all within the overall limit.
Correct.
There's no special
Beyond that, if something comes, then it will be most welcome.
Okay. PM, and a very simple thing, that PMJGY, now you only allow the banks to sell. Why can't others sell PMJGY?
See, the government is actively considering also opening up to the insurance companies. See, typically why the PMJGBY was suitable to banks, because of the convenience. Number one, already the customer is a bank account holder, so no KYC required. Number two, there is already a customer established relationship with the policyholder. Third, there is a authorization through a auto debit mechanism that this money which is towards premium can be drawn from my account and the policy issued. So and of course, it is a low cost. The administrative costs are much lower if the bank does it, because everything is available with them. So with a very nominal amount, they could underwrite and issue those policies. So to begin with, that has happened and it has gained a lot of traction. Now the government is considering also opening up to the insurance companies. So we have also offered our comments. So hopefully that will happen.
That's in favor of them. Your comment is in favor of them. They are just rapt attention. They are listening. Okay. I have many more questions, but time is running out actually. But with your permission, with the of the House, we can continue for a few minutes. No question. Regulator, no question. Just you have to listen to him. That's all. Sir, you have any questions that I'm asking? Okay. You have any question? One or two. This gentleman raised the first one. Just one. Just give them thing, and then we'll get back. Very brief. Huh? And no grievance redressal. Just anything. Okay. Quickly.
Sir, my name is Sachin Deshpande, and this is a very important kind of a thing. This is regarding to the like children with special needs. Children with special needs. So parents with
children's
special needs, basically special needs.
Okay.
So we are in touch with a lot of NGOs, and the parents are very much concerned is that they are actually helping the children with special needs, then they go to the...
Okay.
Is there any special kind of insurance schemes or anything which you can think about, which will probably help? Because it's a great... lot of NGOs are working towards that, but this is one thing which is suggestion and probably also...
Special children, do you have any kind of...
if you look at the health insurance circular, which was issued just about a couple of months ago, there clearly, persons with disability, persons with mental health issues, special needs, even surrogacy, all of that now has been covered, which means every insurance company should provide those kind of covers for all ages, irrespective. If you live 100 years also old, then also, if I demand a cover, then the insurance companies are obliged to provide you with the cover. So kindly read that. It completely takes care of the entire ecosystem. Nobody is left out of the system. So that is what the new set of rules, and companies are adapting to those new standards, new changes. Even the turnaround times have also been now reduced significantly in the interest of the policyholders.
Thank you, Panda Sahab. Yeah, this gentleman, please. Very quick, introduce yourself.
Hi, sir. Kiran Belsekar here. So we have seen the vision of Viksit Bharat by 2047 for insurance for all. So quickly, so that is, I think the more of the insurance awareness is required. The way mutual fund MFI has done for mutual fund sahi hai. Mahesh has already given a tagline for insurance zaruri. I think we need more of awareness. Any plans around it from the regulator side?
Please. Let me tell you that we are working along with the councils, the GI Council and LI Council, to come up with a long-term multimedia campaign. IRDA, on our own, we are going to address the more thematic issues, whereas so there will be a synergy between the insurance councils and IRDA. What we do, they did not repeat, and what they do, that may not be required also as far as we are concerned. So we are almost at the end of that journey of getting the empanelment done of the creative agencies and also the agencies who will actually launch those campaigns through multimedia, which is digital, electronic, print, television, social, everything. So you will soon, that will be unveiled. I don't want to say what will be the tagline and who will run the campaign, who will be the celebrity or stuff like that. But all of those are under works, and very soon you will see that campaign being launched. So that is something which is on the cards.
Thank you. Thank you. Two quick questions. It won't take much time to this thing. Both on the regulation and the entire industry and industry observers, all of us are waiting for. When do we see the composite insurance? Like one can have both life, general, and health, everything. That's on your table. How soon can we expect that?
You see, what we have, I mean, during the course of our review, during the course with our interaction with various stakeholders.
And is there any taker for that? Do you think too many
So,
takers? Because right now we have, in the banking segment, the banks have life insurance and general insurance completely separate.
So as per the statute currently, it recognizes 3 lines. One is the life, the non-life, and standalone health.
LIC, I think, is in talks to buy one
So
health
for
insurance.
composite insurance, there is a need for an amendment in the Act. In other words, if I have a composite insurance, then I can write all kinds of business, irrespective of whether it is life, non-life, or
Yes.
health.
Yes.
So that entails an amendment. And also to inform that the Government of India has also taken up some of the recommendations which we had made, and composite also is one of them. And as and when the Act gets amended, that should happen, and it should open the way for a composite license.
Other thing is this 100% FDI. That's also you have been pushing for, you have been talking about. When do we see that?
See, when we are talking of insurance for all by 2047, obviously we need a lot of capital. This is a capital-intensive sector. So we need a lot of capital, which means we need a lot of new entities to come in. There may be some consolidation also happening. So all of that churning will happen. And if FDI route is also opened, that will only augment to the domestic investment as well. Otherwise, the domestic investment may get crowded out. So we should perhaps it's time to open up for 100% FDI. So more players who want to come and operate on their own terms without trying to look for an Indian partner, that may also help. But if somebody comes with 74-26 or some other proportion, also it's fine. But opening it up to 100% will attract more investments to come into the country is what I believe.
Thank you, Panda Sahab. We have almost come to the end. I have one, not a question, a request. And you can't say no to it. Okay? But before that, anything I have not asked, anything you want to convey to the industry? Not been asked for, anything you want to say? Then I'll come to my request.
No, I would only tell the industry and other stakeholders who are here, now look, with the new regulatory mechanism that has been provided now, where ease of doing business has been one of the major pillars. A reduced compliance burden is another major pillar which we have worked on. Third is also trying to create a more robust and resilient and an enhanced risk management framework to the risk-based capital regime, through the risk-based supervision framework, and through the IFRS, alignment with the IFRS, is going to actually provide whatever you are looking for. And therefore, now you must go to the hinterland. You must come up with a number of products depending on the requirement of the different states, different regions, different geographies. You should cater to their requirements. You should adopt technology in a big way. When we say technology, you have to put the cyber security measures in place, which IRD has been, guiding from time to time. You have to remain in close contact with the certain also if an incident happens. You have to reduce the vulnerabilities. You have to carry out periodic audits. All of them are mentioned. Then the last but not the least is the claims experience of the customers has to be a delightful journey. That is something you need to focus on. So these are the few things that I would like to tell the industry.
That's the message from the regulator. Those who do not know, as a Principal Secretary of Uttar Pradesh, Panda Sahab actually changed the entire emergency management. I think that one number, that UP 112, that was the police emergency management system that used to, and there are many more Indian states adopted that. So you are known for innovations. What I call is this, under you, just 2 years, what till that time before you came, what was in insurance industry, that was the periodika, and now we are seeing glasnost. So be it inclusion, be it from rule-based to principle-based product processes, everything you are changing. So thank you. Give him a big hand, and a request on behalf of everybody, those who do not know, Panda sir also a good singer. So today I want you to have little bit. I mean, choice is yours. Kishore Kumar or Mukesh, Mohammad Rafi and Kishore Kumar. These are the two favorite. Your two favorite. So this part is yours. You choose between Rafi and Kishore Kumar, but don't say no to this, please.
So let me also tell the entire audience that I'm very happy and delighted to share that today in this journey towards insurance for all, the entire ecosystem, be it insurers, be it distributors, be it agents, be it the service providers, people, everybody is with us wholeheartedly to, even if there are certain pain points, they keep it behind and everybody is coming forward to join hands in this great vision for our people, for our citizens, for our countrymen, that everybody should have insurance. Nobody should die without a life insurance.
Absolutely.
No household should live without a health insurance. No, every enterprise should have a insurance solution for protection of its business and assets. So that is something we are dreaming for, and it will be a reality. So very soon we will meet up some evening and have a singing session. Thank you very much, Tamalda, and goodbye, and thank you very much.
No?
Some other day, we'll do it. Of course, we'll do that.
Can I request
some other day, one evening.
Can I request Mr.
Thank you.
Bhattacharya, Editorial Director at Business Standard, to present Mr. Panda with a memento. Can we give him a huge round of applause, ladies and gentlemen? I think supremely insightful session, big takeaways that we are looking at how insurance should be first and foremost made available, then accessible and affordable. And over and above, how do we build trust as an insurance product amongst our consumers? Going forward, if there will be more and more of personalized pricing possible, with the millennial population, they'll be demanding products which will be do-it-yourself.
So एक line में हम होंगे कामयाब. Everybody should sing. हम होंगे कामयाब. हम होंगे कामयाब. हम होंगे कामयाब एक दिन. And let that day come tomorrow. So let's dream for that. Thank you very much and have a great day.
Ladies and gentlemen, a big round of applause for Mr. Devashish Panda, Chairman at IRDAI. Thank you so much, sir. Thank you, sir. All right, ladies and gentlemen, can I request you all to settle down? One important announcement at this point. For those of you who are interested in public markets puzzle for private equity as a topic, there is a panel discussion happening in Narayana Vagul Hall, starting in a few minutes from now. We're going to have a general insurance sector panel discussion in a few moments from now. As we dive into the world of general insurance, this session is set to explore the intense landscape of challenges and opportunities that actually define this vital sector. General insurance, ladies and gentlemen, is a safeguard across industries, homes, health and businesses, and yet it's a field where balancing risk, regulatory demands, customer needs and digital transformation is no small feat. Today, we have with us industry veterans, virtuosos who are going to shed and render light on the complexities from managing diverse risks to meeting evolving customer expectations and innovating with consistent agility This panel will be actually construing and unpacking what does it take to thrive in a field that underpins so many facets in our lives and business continuity. To navigate this conversation, our moderator, who is going to be joining us on stage, is going to be Mr. Manojit Saha, banking editor for Business Standard. And joining him on stage, I'd like to invite our following panel members, beginning with Mr. Animesh Das, MD and CEO at ECHO, Mr. Anuj Tyagi, MD and CEO, HDFC Ergo General Insurance, Mr. Anup Rao, MD and CEO at Future Generali India Insurance Companies. Ladies and gentlemen, can I request you all to get settled down? We are going to get started with this panel discussion, which is based on the topic, General Insurance, Too Many Challenges. Rao will be joining us in a few moments from now on stage. I think we can get started and we'll accost him onto the stage.
A very good morning to all the listeners here and the guests, and a very good morning to all the panelists here. Mr. Rao is joining us. Yes, sir, please. No, it's okay. So, the general insurance sector, I mean, as the regulator said, the vision of the IRDA is insurance for all by 2047, where every citizen has an appropriate life, health, and a property insurance cover. The regulator, the insurance regulator, has been extremely proactive in supporting growth of the sector. His objective is ease of doing business, and as a result, he has simplified a lot of regulations, which is extremely conducive and creating a conducive environment for the general insurance sector. At the same time, on the issue of penetration, the needle has not moved much. So, as an opening remarks, I would like to request all the panelists to share their views, what needs to be done to increase the penetration, move the needle on penetration. So, Mr. Tyagi, if you can start.
Thank you very much for calling us here. It's obviously a great show as I see it outside, and the topics that you are touching on are very, very relevant. So, coming to the penetration issue, the general insurance, or rather the insurance penetration issue that the country faces. So, if you see, there's a lot which has happened in the past few years. Starting from the regulator giving freedom to the insurance industry to design products which are bespoke. Now, what were we doing previously? The products that we will sell in the urban market, those are the products we would also try and sell in the rural market also. We couldn't have designed bespoke products, so regulator has kind of freed up, given the elbow room to the industry. In these past few years, the distribution framework is also changing, and all the insurance companies, most of the insurance companies have also, now also have very, very advanced digital distribution tools. You already have regulators, under the 2047 Insurance for All by 2047 vision, you already have regulator allocating various states to the insurance companies. Now, what it does is that in a particular state, for me, say Tamil Nadu and Puducherry, that state is led by HDFC Ergo. As far as the creating awareness, bringing in affordable products, and making the products more accessible to the state citizens is concerned. So we kind of take the lead. Now imagine all insurance companies between life and non-life adopting all the states in the country. So suddenly you've kind of created these small units where an insurance company can go and focus target, right? Now, all of this has happened in past few years. So from a stage where we were very, very limited in terms of what we could have done in product designing and how you reach and how you go to the customers, to a stage where we can now design very specific products, and we now have a very specific area, which is the state in which we will work. So I think each one of these will start showing the green shoots very, very soon. And last but not the least, when you heard, Mr. Chairman speaking about Bima Sugam, what he couldn't speak, I think, in the conversation was Bima Vahak.
Right.
I think the entire Bima Trinity is going to change the landscape of insurance. Now, imagine our, women selling small ticket insurance, very relevant insurance, comprehensive insurance, right? You have life, non-life, you have life, asset, health, everything in one, using digital tools. So they will, instead of me trying to find out where to buy insurance from, they will come to me and tell me these are the products, and I could conclude the transaction there and then. So I think have patience, wait for some more time. The groundwork has been done. We see the green shoots, and I'm very, very sure very soon the distribution, the penetration, insurance penetration landscape will look different.
So you're hopeful that the green shoots will be visible soon?
Of course. In my opinion, the green shoots are already visible. You look at the insurance companies in every state, every insurance company has started to invest. Every insurance company has started to open up physical offices. Insurance companies have started to recruit Bima Vahaks, or at least, identify
the process has started.
Of course, it has started.
Mr. Rao, what's your take on this?
So I think Anuj has, covered all the initiatives. But, I just wanted to, ask, pick some first principle points or raise some first principle questions. So look at the period between, say, FY14 to FY23. Right? In that period, our population grew by about less than 11%, around 10%, 10 point something.
Population, okay.
Yeah. In that same period, the number of new policies tripled.
Okay.
All right. Now, if I look at data for the last 7 years, and unfortunately I don't have data, rich enough data to go back, but in the last 7 years, the average ticket size per policy has gone up by just 1.3%.
Okay.
Right? So if you look at, penetration as premium as a percentage of GDP, the numbers don't tell you the entire story, because I think the more relevant number is cover. And I suspect cover has gone up significantly. Now look, I mean, if you have tripled the number of new customers in the same period where population has gone up by just 10%, and the CAGR on insurance premium is just 1.3%. I mean, motor insurance, all of us in the audience are familiar with, but then those rates have stayed stagnant for the longest time. I mean, they have not gone up. You look at crop, for example, the rates have actually dropped, if I look at the recent past. So I would actually ask that fundamental question, that is it right to look at insurance penetration only as premium as a percentage of GDP? Because that clearly doesn't tell you the entire story, because what should we be concerned with is the quantum of cover. And I think that's not really getting reflected in the way we look at measuring the metrics of penetration. If I have to use another example, you look at telecom in India. Indian tariffs are among the lowest in the world, right? It is the lowest in the world. It's cheaper than even Afghanistan and Bangladesh, right? But in case you were to compare penetration in this country while looking at telecom revenues as a percentage of GDP, you'll probably say India is underpenetrated, but that's far from true, because our penetration levels in telecom are good. I mean, and if you look at the data, consumption is growing at a CAGR of over 40%.
But don't you think on penetration we have a long way to go?
Of course, you have a long way to go, but I'm just saying that to believe that the penetration is low because we look at a metric, I think that metric is limited.
Okay.
So that is the point I'm making. And obviously, Anuj spoke about a lot of things, and a lot of initiatives which the government has taken, which the regulator has taken. I mean, the Bima Trinity and, state level insurance plan, all that is great. Obviously, reduction of compliance burden, letting us innovate, quicker product approvals. Actually, I joke that, it's quicker getting, and it's not a joke, it's a fact. We take longer than the regulator does when it comes to product. I mean, our IT development takes longer than it takes for us to, get going with the regulator in most cases.
Right.
So, I mean, honestly, especially under this regime, the changes have been far-reaching. I mean, there's been a lot of momentum put behind growth. All that has definitely happened. But I just want all of us to sit down and question, is penetration really as bad as we make it out to be? I don't think, in case you look at it from the dynamic of cover, it's true.
Right, right, right. Yes, Mr. Das.
So first of all, truly honored to be part of the panel and participating in this summit. I think Anuj and Anup have covered what are the initiatives regulator has taken, Chairman sir touched upon on those points. I'll add, I think one aspect, we discussed this in a couple of other forums also. We are imagining, I think the question is in the line of that as an ecosystem, we are imagining to cover whole Indian population by 2047, right?
Correct.
Insurance for
Correct.
all by 2047. If you think about this journey of next 23, 24 years, and we take a milestone of another 12 years, which is halfway down the line.
Correct.
Most of the decision makers at home will be people who are born after internet.
Right.
So I think one leg where there's a catch up going on, I think insurance industry is anyways catching up. Maybe banking world, telecom world has taken a lead when we compare different ecosystems. But I think the digital innovation, which the industry has to do, there are a lot of companies who are doing a great job. We can still catch up, but I think the lens which we apply here is that usually technology or digital distribution is seen as efficiency, and instead of efficiency, somewhere it has to be in the core as well, right? So this is an additional point. I think Anuj, Anu both covered that there are great initiatives, and this is something which we appreciated, Chairman sir, also that there's something which was not happening at least in the insurance ecosystem. Where the whole focus of state-level insurance plan, or be it the ease of the convenience of doing business with product approval timelines, I think these things are very, very useful, and these are the fundamental pillars to kind of build on top of it. But on top of it, I think creating sharp digital framework on how to kind of reach out to the new audience, the millennial audience, which is coming up, I think that's an additional point.
Technology and digital, that will push the needle. But Mr. Rao, the chairman has also said, recently, that the non-life insurance industry, the premium is about 2.9 lakh crore FY24. He wanted it to go up to 11 lakh crore. By when you think that's possible?
So look, if you look at the insurance industry, if you look at the last decade, it's grown by about 12.5%. So, sorry, those numbers were 2.9 lakh crores and 11 lakh crores. So basically, in case you got to double it twice, in case you were to compound at say 14%, 15% a year, which I think is possible, you're talking about under a decade that we should get to that number. In case we do nothing, dramatic, I mean, and we continue to do slightly better than how we've been doing historically, I think we should get there in about a decade. But with the initiatives that which have been taken, and I'm especially optimistic about the Trinity, the Bima Sogam, the we have the Bima Bhag, and the state-level insurance. I mean, we have the state of Sikkim, for instance, and I must confess that we didn't have presence there until we were allocated the state, right? So it's obviously significantly, moved the needle for us as a company also. So I think that you can easily crash that by a few years. So, I mean, if you do nothing at all, you're just talking about a decade. But if you I think hard to hazard a guess, but then I would say that we can crash it by about 3 years at least, maybe about 7 years. But I can't put numbers behind it, but then it would mean that, we got to grow at about 20% CAGR.
Right.
It's not going to happen in linear terms, but then I do expect that, maybe in a couple of years, you will see a exponential jump once, as Chairman pointed out, that once all this is linked to the digital stack, people get used to it, there's greater acceptance, the ecosystem is built and starts delivering. I think, you'll see a kicker maybe 2 years from now massively. But yeah, but I think that number is not very far-fetched.
Right, right. Mr. Tyagi, the Bima Trinity, will it help in reducing the distribution cost?
By design, it should help in reduction of distribution cost, but more than the distribution cost, and that's that was not never the prime objective of Bima Sugam. The prime objective was to make insurance accessible very easily. It was to make insurance very, very transparent. and to bring in, imagine a platform, it's the, and I don't know if I'm allowed to use the brand names here, but it's the Amazon of insurance, right? It's the, you will have buyer, seller, service provider, distributor, customer, all on one platform. Where else in the world have you seen a transparency of this degree? Now, when you have a transparency of this degree, I would suspect, Manojit, the reduction in distribution cost should automatically come, because customer will know what he or she is paying for, and distributors will have the benefit of law of large numbers. Right. So I think that's a very natural phenomenon arising out of Bima Sugam, but that was never the prime objective in, as I said.
Right. Now I will briefly touch upon the health insurance angle. Post-COVID, we have seen significant growth in the health insurance policies and premiums, but affordability remains a pressing concern. Mr. Das, what is your view on that? What are the strategies we can make that health insurance become more affordable, accessible?
No, I think the point which Anuj also mentioned, I think few of these initiatives, once we bring that transparency, and I think one more outcome will be the efficiency of distribution, right? So once you have efficiency of distribution, there's a cost saving, there's a economic viability of the company and the ecosystem altogether, and that allows you to pass on more benefit to the consumers, which creates the affordability of the product, right? So it's a global thing which will happen once you open up more distribution, more efficient way of reaching out to the consumers. That'll happen. I think on the core markets, where the insurance penetration is decent, the presence is already out there, I think the focus should be, and I still believe that from a health insurance point of view or few of the other product line as well, I think market is still setting up how things will work out. There's still distribution growth possibility. So efficiency is still catching up, and that will help insurance companies to create products affordable way. One of the things which is, I'm just sharing across our own experience, we are a relatively new player in terms of retail health world. We have seen that when we are distributing product directly to the users in some sense, that efficiency helps us to create products which are more, if I can use, not simple. And when you create those simple product out to the user and not add any complexity to the product, there are ways to price them in a sharper way and make it more affordable. At the same time, I think there's more focus in terms of creating products which are as per the needs, instead of creating just one single product and fit all. I think that's a lens the whole industry applies. There are a few industry leaders who are already doing that job. So customized product, how can you create product which are more data driven? I think that also aids to affordability altogether. So there have been focus both ways. I think like we discussed, there are first principle thought process from a regulatory point of view also, that you have to create products which are very convenient for the users at the time of buying as well, at the time of claims as well. There has to be very sharp underwriting. When you have very sharp underwriting, you obviously save on the leakages, you save on the frauds, and then you have an overall saving of the pool, and that helps you to pass on the benefit to the genuine user. I think all these efficiency areas is where everyone has to focus on and pass on the benefit to the genuine end users.
Right. Mr. Tyagi, there's a lot of discussion going on the GST rates, whether that should come. GST.
Yeah.
Do you think reduction in GST will make the products more affordable? Will the insurers pass on the benefit to the customers?
And I assume you're specifically talking through the lens of health insurance.
Yes,
right?
yes.
So I think you're right. Obviously, as the tax on health insurance policies will go down, suddenly the policies start to look more lucrative. But that's just one element of it. And if I may just also kind of breach into the question that you asked, Animesh, and mine is a build up on that. The affordability of health insurance in the country, there are, in my opinion, 3 or 4 fundamental aspects. One is, if you ask in this room how many people have their own individual policy, I can challenge very few raise of hands you will see. So the issue is, at what age do the customers want to come and buy a health insurance policy? right? So today, what I have as an insurance ecosystem is a aging population in health insurance. And it is no-brainer that as we all age, the probability to fall sick increases. And obviously then so what you have, what we call in insurance parlance is the anti-selected lot. The moment you have the denominator increasing, when more and more young people come into the insurance space, the premiums are automatically bound to fall. The fact is medical inflation is increasing. Now for an insurance company to give that peace of mind to the customer that I am insured, I can sleep easy, the insurance company will take care of me, it has to be appropriately priced. So that's one part of it. On top of it, you have the GST. Right. Now the moment you say, okay, this part you can't obviously, flag the entire country in one day and say, go buy insurance. It'll take its own time. And we also have to create awareness, bring in simple products, so on and so forth. But at least at the moment you say the GST has come down on insurance policy, suddenly the perceived affordability of the product starts looking better. So I'm sure it'll do better. And as I'm sure you would have noticed at least for the senior citizen, there has been an amendment as far as the tax is concerned. It will certainly have an impact on making the health insurance more affordable.
Right. Mr. Rao, what is your prescription? How to make health insurance more accessible?
I think accessibility, the question has been addressed, with a bunch of initiatives. Again, the second, which the regulator has taken. But again, on affordability, I just want to touch upon this. Have we compared health insurance premiums in India to the rest of the world? We make a sweeping generalization that, should it be made affordable, more affordable? Of course it should be. But, I don't understand where this comes from that, insurance premiums in India are not affordable. If anything, they're among the cheapest in the world again. And I think a lot of us don't celebrate that enough or understand that enough. So my question, first of all, is that on what basis are we saying that health insurance premiums are high? Because I think implied in that question when you say when it can be made affordable is that it's unaffordable today. Now, if your question it can be made more affordable, yes. I think the way it can be made affordable is obviously a bunch of factors. But I just want to draw attention to one thing on GST, which you asked earlier. Look, the thing about GST is that eventually, what is GST being used for? It's being used for by the government to provide insurance, right? And, that money is being used because, there are state-level insurance plans, by state governments and the central government to provide cover. Great. I think the question to be answered here is that, would you rather have GST taken off and improve penetration through the private sector? Or would you rather use the GST collection to in turn give insurance as a state to people? My hypothesis is that in case you were to let the existing players, private and public, suppose you were to help enable their penetration by removing GST and thereby making it more affordable, I think that's a more effective way of dealing with penetration.
Okay.
Right? Because eventually that's going to be a more effective mechanism. The government obviously, should set the framework, set the playing field, and be on side of the consumer, as always, to make sure that the consumers are taken care of. If there's a claim and they're treated fairly, appropriately. But I don't. I would rather have the GST benefit. By benefit, I mean being taken off and insurance being made more affordable, rather than the government using that to provide insurance themselves. It's a classic story of state versus private enterprise. I think that's the lens we should wear while looking at this.
But reduction in GST, will it make more affordable?
It is significant. It is 18%. It's not a small number. It'll have a significant impact on the affordability.
So you pass on the benefits?
Look, at the end of the day, I'm not taking the benefit today, right? The fact is there's no benefit we are getting. There's a premium plus 18% the customer pays. I don't charge at 18%. It's that simple as that. We are just a pass-through mechanism.
Right.
It's not that we keep that. But the benefit will obviously go to the customer.
Right. That's great to hear. You want to add something on this?
No, I'm just saying a simple thing. For first look for the consumer will go down, right? So if there's I'm just taking an example, a 25,000 rupees insurance premium, the landing cost, because that's the money which is going to get deducted, right? It's come down to 23,000 something because the GST being reduced from, let's say, an 18 to 12 or 5 or something. First look for the consumer will go down, right? So it'll make affordable, right? It'll look affordable to the user that the price has gone down, right? So if that's couple of thousand difference which customer sees, makes a lot of sense.
Right. The other issue which has been discussed, and I think insurance companies have also made representations on the issue, is that value-added services. So what are your thoughts on that, Mr. Tyagi? How important are value-added services for the insurance companies?
I think the next wave of insurance expansion, in my personal opinion, will certainly come when the value-added services have, become an integral part of insurance offering. Now, look at it, at least through my lens for a moment. Home insurance. Now, what value-added services do, and with due respect to the purist, insurance purist, it will commoditize insurance. And you look across the industries go through a different expansion curve the moment it is commoditized. Now, what it does today, home insurance is a huge, area of concern for insurance industry because it is underpenetrated.
Right.
It's more than underpenetrated. That still is an understatement because there is no home insurance practically in the country. Now, supposing you say, the moment you say that there is value-added services, what can I do? What is my approach today? I'll come to you and say, Manojit, please buy a home insurance. You'll say, yeah, okay, I'll look at it some other day. Tomorrow, I can actually come and create a complete ecosystem of home services around you, and will say, along with home insurance, Manojit, I'll also possibly can take care of your home automation security. I can possibly take care of your, home electrical devices maintenance. Imagine all this. So suddenly the insurance, you buy health insurance. I can do very little in terms of managing your wellness ecosystem today. I could do it all tomorrow. I could ensure that Manojit goes to the gym every day because I will start weaving in the benefits to give him, weaving in those benefits so that I can pass on those benefits to you in insurance premium. I could create a complete web of services for you around your motor insurance. So suddenly you are saying that insurance, which today is seen as a push product, from a push product, I think it's a transformation where it will start becoming a pull product. For all you know, there will be a set of customers who will not buy insurance because they're buying insurance, but they'll start buying insurance because they will get value-added services along with it, right? So I think and industry today has reached at the maturity where it can handle value-added services without compromising on the risk, because ultimately we are the risk carriers. So it is just the right time for the entire ecosystem to talk about value-added services, and I am personally very excitingly waiting for value-added services to come in the insurance space.
Yes, please.
So I just wanted to add, look, the thing is that generally as a rule, there are exceptions, but generally as a rule, high-frequency claim products are sold more easily than low-frequency ones, generally as a rule. Okay. Yeah, it's a different matter that low-frequency claim products probably are more for the distributor and therefore they're pushed harder, but generally that's the principle. What's the problem with low-frequency products such as home insurance is that, you experience it, if at all, once in 20, 30 years. So there is no stickiness to that product. What VAS does, or value-added services does, is that it helps you experience the product every single day, instead of waiting for that claim to happen. So in that sense, it ensures that the person stays covered for a long period of time. So it improves retention of the customer, which is extremely important. I mean, you've acquired the customer, you got him or her on board. Now, whether she stays or not is going to be a function of, a lot of factors, and one factor is frequency of claim, and and after 3-4 years, the guy might, or the lady might just say that, to hell with this, I don't want this product anymore. So I think VAS helps that customer experience that product on a more frequent basis, and therefore the stickiness improves. I think that's a very important factor, which is going to do, which is something which the insurance industry requires.
So, Manoj, I'm sorry, on a lighter note, insurance is a product where the seller doesn't want buyer to use this product, experience this product. And at the same time, even buyer does not want to experience this product. So I think the point that Anup has made is very relevant. Neither the buyer nor the seller want to use this product, and value-added services will at least start bringing in that user experience there. Who wants to have his car knocked down, and also at the same time, the insurance company does not want anybody's car to get knocked down. So VAS will certainly bring in that experience.
So Mr. Das, value-added services need of the hour?
No, 100%. I think the lens which Anup shared is very relevant. The engagement with the consumer, and specifically so for insurance product, home insurance, health insurance, you'll interact with the insurance company once in 5 years, once in 10 years, or maybe never in a lifetime also possibly, right? So that makes a lot of sense. I think there are very good examples anyway, right? The banking world, if you see the bank products, credit card coming up with any of, like, let's say lounge, and these are successful example. I'm saying lounge access of credit card or anything else, right? These were built on top of the original financial products, right? So there are successful example in Indian market. 100% makes sense.
Right, right. Again, I briefly come to the health insurance aspect. There was an idea mooted that common empanelment with hospitals, which has not really taken off. What's exactly the issue, Mr. Tyagi, on that?
I think, Manoj, see, this is one initiative which I'm extremely proud of as an industry. Because here is a perfect example where every player in the general insurance industry and health insurance industry comes together and says, let's create, irrespective of where the customer goes, which hospital the customer goes, we will provide cashless. And this also kind of ties in with the larger industry vision of 100% cashless to customers. We created the network, we launched it. We obviously, if a particular hospital is not on the cashless network of an insurance company, the user give 48 hours advance notice, and we bring in the customers. I think where we have slightly faltered again is in creating awareness about it. Awareness. We have not propagated it the way we ought to have done, other than the initial. And frankly, I think even media has not captured it the way it should have been captured, to be very honest. I mean, it's one noble initiative which brings the financial load on an insured on day one. Why go to a reimbursement route? Go to cashless across the country, anywhere. So I think we will need to continue to follow up on that. We continue to answer the question in one sentence, the issue is still awareness. The customer still does not know that they can go to any hospital and get themselves treated. So we continue to, and I'm sure all the other insurance companies continue to make their channel aware, make the customer aware. And I think, in my opinion, the media should also continue to bring in those bites in whichever form and fashion that go and make use of the cashless everywhere. It's a very noble initiative. There is absolutely no other problem.
Mr. Rao, what do you think?
I think, yeah, obviously, I mean, I think awareness is one factor from a consumer point of view. The second is that these initiatives take time. I think there's a lot of communication which needs to flow with greater frequency, and then, look, some of these initiatives take their own time. I mean, you do have the hockey stick, right? I mean, things start slowly and then they pick up. I think it's also, look, anything very revolutionary, very new, very unprecedented takes its own time. So I think that's another factor, but I think Anuj has addressed those points. I think it's also a question of how much time it takes, besides the fact that there's a consumer awareness issue.
Right. The other consumer issue is the issue of claim settlement. IRDA has also raised this issue. There's a big grievance on claim settlement from general insurers. So, Mr. Das, how can insurers address the concern?
No, I think this is the core of our job. And there should not be any leeway, there should not be any discount to any of the insurance company not giving the benefit to the users. So I think there's no doubt that how should we be very sharp on these things. One piece is where chairman sir also discussed that this is the moment of truth, and there's a lot of regulation where how do we keep a track of the claims and the benefits which are supposed to be passed to the consumers are being followed. So that's from a regulatory point of view, I think there's sharpness in terms of how these things should be followed. And second, from an insurance company point of view also, I think this is my personal view, maybe not representing industry comprehensively, but it's very important to sharply underwrite and have very efficient process to onboard the users. You should end up asking most of the question at the time of onboarding itself, so that there is no corner cutting at the time of claim, and the claim process is pretty much smooth. So again, maybe I'm saying a slightly controversial point, but I think it's the other way around today. So you create the sales process very smooth, you get people in, but at the time of claim there's a lot of checking, right? So it has to be flipped altogether. You should onboard the users correctly. very sharply and make sure that when you are giving the claims, it is very smooth and no question asked sort of, right? So that's one principle. I think industry is anyways evolving. What we have learned, I'll just give one important point. I think the way, the one thing which has helped us is if the onboarding is very data driven and you are able to pick and choose the right segment at a right price, it is comfortable to kind of give the claim easily, right? And that has helped us a lot. But apart from that, I think in general, there's been overhauling in terms of how the claim process works. I think this industry is doing a decent job. I think most of that. See, one very important thing to understand is insurance as a sector. We touched upon on multiple other issues which we face as a sector. But insurance as a sector, whenever there's a claim, the consumer is not in a happy state. Someone who has met accident will claim. Someone who has lost something will claim, right? So that state itself is not very happy for anyone. So there'll always be, I'll not say artificial, there'll always be an organic grievance, right, out there. Because in that case, even a slight mistake from the insurance company will just compound to the sadness in some sense, right? So the by default state of mind when the insurance company and the customers are interacting is not happy, right? So somewhere that further pushes the insurance sector to do a greater job. And kind of cover that gap and try to give back to the user in a sharp manner. So that's what we face as an insurance sector, but I think we can do a way better job.
Mr. Tagi, tell us two things which insurance companies, general insurance companies do to address this grievance on claim settlement.
So let's just look at what, first of all, I think we haven't, I again come back to this, we haven't done a good job of promoting the right information to the customer set. And I'll just take you to the unfortunate COVID days. The industry paid 25,000 crores of claims. Maybe one claim, 100 claim wrongly handled creates that noise in the ecosystem. We haven't gone and propagated that industry at the same time as has also saved millions of lives of families from going into bankruptcy. So that's clearly one. Look at the crop claims in the country today. The smoothness, the ease with which the crop claims are paid, it is unprecedented. We don't go and propagate. So we haven't also done a good job of telling the customer and bringing and getting them confident that don't worry, the insurance companies do play. What are the rejection rates today? It's very early single percentage point rejection rates. That can happen. What we also forget, and everybody forgets that, and I'm not saying, I mean, ideally, not even one claim should get stuck, due to process delays. But we also forget, Manojit, the fraud in the ecosystem.
Correct.
Right? Now, I don't want to even give those numbers because those percentages are scary. The fraud in health insurance and the fraud in motor insurance, the percentages are scary. I also have to manage that because if I start paying every fraud claim, you can't imagine what will happen. I'll price everything end of the day. You can't imagine what will happen to the premiums, right? So the insurance company, before settling a claim, also has to establish whether it's a fraud claim, whether it's not a fraud claim. And in the entire value chain, I don't know who can be the fraudster. It can be A, B, C, D. I have to assess every participant of the value chain to then find out that it's a genuine claim, pay. The good thing is, industry is using technology to do it in a seamless manner. In spite of assessing all these A, B, C, D across the country, across the zone, across the pin code, my cashless turnaround time is 34 minutes. My reimbursement payment times is a couple of days, right? There would still be some claim. Now, what happens is if I smell some fraud in some claim, I will do investigation, that gets delayed. So I think the industry, look, I go back to, I take a few steps back. The industry has a very genuine intent to ensure that every customer gets their dues in time, right? We have to address some of these nuisance factors. The people, every citizen of the country gets extremely scared if the check bounces, right? Nobody gets scared lodging a previous 2 years back dent claim in motor along with a new claim. That's fraud. Nobody gets scared if a pre-existing disease is covered in a policy and then going to the hospital, because we don't have any legal mechanism, legal protection for an insurance company against this fraud.
No, I understand fraud is an issue, but do you think it's a valid concern, claim settlement, the grievances on claim settlement?
Of course it will be. I am not saying that 100% of the customers are being serviced with the... I was trying to explain why in times it happens. Insurance companies also have to improve their processes. The level of technology in claim assessment as it should have been there, it's not there in all the insurance companies. It will certainly, there is a lot that we have to also do.
Right.
But we will also get our processes, our efforts also get a fillip. Then when we also get support in accessing this big nuisance factor across it.
Right.
Sometimes, and last point, and my colleagues should also speak, most of the time, a lot of times when a so-called delay in hospital discharge, which is the end of the claim chain, when it comes to the blame of insurance company, that the insurance companies take a lot of time to approve and the hospital discharge gets delayed. You go to the root of it. Hospitals' own processes take 3 hours for discharge. Insurance companies would have approved, the discharge in less than that, but their own process will take that time. It comes to the blame of insurance company because obviously nobody can go and find it out. So it's not as simple, but to answer the point, 100% every customer's claim should be paid in a jiffy without any delay. And more technology, as more technology come into fore, things will become more and more simpler. We already have come a long way.
Mr. Rao, you want to add?
No, not really. I think, look, in case you were to look at industry level data, I just want to make one point. If you look at, the loss ratios, they're in excess of 100%. So for every 100 rupees of premium we collect, we pay close to 105 in claims. Okay, this includes private sector. I think the private sector is slightly better, but that's also in excess of 95%. So obviously, we do whatever we can to make sure that the customer is paid. And I think Anuj has been very eloquent. I think he's raised a lot of points. But that's one thing which I just wanted to add. I think from a product demand point of view, I think despite all that the regulator has done to enable that, I don't think we have done enough in terms of innovation as an industry. Of course, some of us are modular products wherein people can pick and choose what they want and, or gender specific or covering comprehensive. But I think we also need to, besides, better communication, making a case for the industry, I think we also need to better communicate with the customer in terms of what the offerings are. I'm not directly dealing with your question on claims. But I think, basically more suitable products, more customized could be one way to approach deepening and widening the market both.
Right.
For the customer. And but then I think in case you want to look at I think I would encourage everyone to just look at the kind of, if people say that we're taking premiums and not paying, that's not true, because, it's almost like sometimes shareholders ask that question that, basically the question is that how much loss making is this business? Is it less or more?
Right. Yeah. We have few minutes, so we can take a couple of questions. Is anyone there? Yes, gentlemen. Kindly introduce yourself and please keep the question brief.
Thank you everyone for such an insightful session. Thank you to Business Standard as well. I am Gajendra Singh. My question is that, we are talking about customizing the solution based on the, individual's lifestyle as well as habits. Okay, this is I believe that now everything is data driven. So how the companies are, by looking at the lifestyle of a person, like, if somebody is going to a gymnasium or if it's a marathon runner or, some cycler, so his lifestyle is very healthy. So he should be given some benefit. Similarly, if somebody's office is nearby and he goes to car to 2 to 3 kilometers and somebody is traveling 50 kilometers by car and somebody is a rash driver, can be a rash driver as well. So how, you're tracking something like to differentiate the premium for these two kind of set of people as far as health insurance is concerned and as far as
what is the
motor
question?
insurance.
Yeah.
So question is very specific that, based on the lifestyle and the kind of risk one person is having, so are you planning to customize the premium in the time to come?
Yeah.
Or have you initiated anything so far?
there are already products in the market, and in the times to come, you will see more and more such propositions to come out. So there are already products where the premium discounts are given based on, how do you lead a lifestyle. So data comes through the variables to insurance company, and there are products on motor which are called pay as you drive. So that kind of addresses the need that you're talking about. You will see more and more these products to come in the market, and that's where, also when the value-added services come, these products will become more. But even today, these products are there in the market.
Yes, please.
Igar Doshi. Sir, we need to introduce some product for senior citizen because it is a very used market, and nowadays most of private companies, they are denying to give insurance for a senior citizen after 70. So we need to think for that also. Is there a feedback or a question?
Yeah.
Yeah, it is a feedback also, and it is for this
Okay,
improvement also.
Fair enough. Ladies and gentlemen, we have completed. You want to address something?
No, that's it. But I mean, I believe all of us have products for senior citizens, including us. So we do have those products, at least today. I mean, I can speak about today. I'm sorry. So there are products available for senior citizens, but if your feedback is that there should be more comprehensive, wider coverage, so on and so forth, I mean, we can't speak for the industry as a whole, but then I know that a lot of companies do offer products for the senior citizens.
Yeah, I think a couple of points. Chairman sir also covered that. There are certain segments on which there is a new circular come up, which where the industry is kind of coming up with newer products for specific segments. And I think there is a new initiative also from government side where anyone more than 70 age is covered under Ayushman Bharat. So I think few of these initiatives are already under plan. You will see more products for these cohorts or these segments going forward.
Thank you so much. With that, we come to the end of this discussion. Please, big round of applause for the panelists.
Thank you so much,
Thank you.
panel members. Can I request Mr. Saha to present panel members with a memento? Again, incredibly pragmatic conversation we witnessed here. The goal of insurance for all by 2047 really emphasizes making life, health and property insurance accessible to every Indian citizen. And this vision is supported by proactive regulatory efforts focused on ease of doing business and a very simplified, conducive regulatory framework. The Bima Sugam platform, described as the Amazon of insurance, aims to revolutionize insurance accessibility by providing a transparent all-in-one digital marketplace. Value-added services is truly the need of the hour, and 100% of every customer claim should be played in a jiffy without any play. I think incredible conversation. Ladies and gentlemen, we will start the next session, which will be chaired by respected Chief Economic Advisor to Government of India, Mr. V. Anant Nageswaran, at sharp 1:30 p.m. So I request you all to please assemble inside this hall, which is called the Chintaman Deshmukh Hall, at sharp 1:30 p.m. I'll see you on the other side. Check, check. All right, ladies and gentlemen, requesting you all to once again make your way inside the Chintaman Hall, where we will be very shortly joined by a very revered economist, Dr. V. Anant Nageswaran, who is the Chief Economic Advisor for the Government of India. The topic that he will be actually talking about and construing today is India's economy in the evolving geopolitical environment. Again, it's coming not from the world of academics, but from the world of a practitioner. So we would want more and more people in rapt attention inside this hall. So requesting all the delegates, all the guests to please make their way inside the Chintaman Hall. We are going to get started in a few moments from now. शैलेश सर ने क्या बोला कब तक लोग है किधर यहाँ से check, check. Check, check. All right, ladies and gentlemen, we are at the day 3 of India's biggest BFSI summit called the BFSI Insight Summit. Over the past 2 days, we have amassed many interesting, pragmatic, and incisive insights from the world of public sector banks, private sector banks, small finance banks, to the aspect of foreign banks who are trying to make it big in India. I think we covered an entire host of facets and aspects of BFSI. Some key takeaways that have been rendered over the past 2 days range from the aspect that India is definitely pacing towards the 100 trillion mark in the mutual funds industry, and that number is touted to be reached in the next 3 to 4 years. And considering India is in its blinked generation, inundated with Gen Zs, people want things quickly and are eager to take up bigger challenges and risks to attain an agile speed. India is also moving towards a more financially aware stage, with over 23 lakh crore being invested by people in bank deposits. People want to really take charge of their finances, and they have translated from savers to active investors. India is a market that overall offers sustainability and growth confidence like no other for any financial institution to grow and thrive. Our banking and finance industry is presently at an excellent health for any investment and opportunities, and a whopping 53.5 crore UPI transactions have been done per day, which indicates massive growth, showcasing affinity towards digital payment mediums. Every Indian, this is the aspiration of all our BFSI movers and shakers, that every Indian should be able to make a UPI payment anywhere in the world, from offline to feature phones, and should have great accessibility. Tech innovations are here to stay and are going to revolutionize and change the way we are actually perceiving finances altogether. And banking as a sector has moved from a product and service-based industry to an embedded finance and a lifestyle kind of a change for our customer. The lucrative digital industry, ladies and gentlemen, has been also engulfed with many fears of digital fraud. People are increasingly falling victim to fraud calls, often manipulated by the use of family members' voices to increase emotional manipulation. And at the same time, to counter it, people would need to be more vigilant and acutely aware of their transactions before entering into any. While the world is increasingly driven by technology, many individuals still don't understand it, yet they place trust in digital systems and platforms, and that can be precarious situations for digital crimes to happen. And companies are increasingly transitioning from traditional business models to actually the business of technology, hiring talent which is based on tech expertise to create in-house solutions which are very core to their customers. Compliance is seen by the business owners and the entrepreneurs not as a constraining factor, but rather as an enabling factor, because it's good for customer and investor protection, and also acts as an intangible competitive advantage, with organizations actually customizing products to meet regulators' demands. And one of the things that stood out yesterday conspicuously throughout the conversation was the fact that India's UPI stands out globally, and the country is actually now transitioning into account aggregation, further enhancing financial transactions ease, seamlessness, and a sense of security. And I think one of the biggest takeaway from the conversation today we had that there should be insurance for all by the target time is 2047, but I'm sure we're going to achieve this much quicker. So if you see, for the last 3 days, we have covered very pertinent, relevant, and compelling topic. And the topic which we will be covering today is also impacting anyone and everyone, whether in BFSI sector or whether you're an Indian citizen, it's going to be relevant to you and pertinent to you. So ladies and gentlemen, the topic that we will be demystifying today is India's economy in the evolving geopolitical environment. Ladies and gentlemen, it's an absolute honor for me to introduce on this dais a visionary economist whose insights have been instrumental in shaping India's financial and economic strategies. He is the Chief Economic Advisor to the Government of India, with deep-rooted understanding of both global and local economic dynamics. He brings a nuanced perspective that combines data-driven rigor with a profound grasp of India's unique economic landscape. He's had an illustrious background as a writer, educator, and economist, and he has contributed extensively to both academia and economic policy. So without further ado, can I call on dais the 18th Chief Economic Advisor to the Government of India, Dr. V. Anant Nageswaran, ladies and gentlemen. Welcome, sir. And at this point, can I request Mr. Shailesh Dobhal, Editor, Business Standard, to render introductory remarks.
Thank you, Ridhima, and good afternoon, everybody. On behalf of Business Standard, let me extend a very warm welcome to the Chief Economic Advisor for the Government of India, Dr. V. Anant Nageswaran, on this third and final day of the Business Standards BFSI Insight Summit, which has become the main destination and platform for the entire Indian financial sector to come together and discuss, debate, and deliberate on issues that India and the world faces at this crucial time. Dr. Nageswaran, who took charge as CA in 2022, has an MBA degree from the Indian Institute of Management, Ahmedabad, and holds a doctorate from the Eisenberg School of Management. He has taught at several business schools and institutes of management in India and in Singapore, and has published extensively. He was a dean at the Institute of Financial Management and Research, Graduate School of Business, and a distinguished visiting professor of economics at the Kriya University. He has been a part-time member of the Economic Advisory Council to the Prime Minister of India from 2019 to 21. For those not aware, as a Chief Economic Advisor under Mr. Nageswaran, sets the macroeconomic backdrop, domestic and global, under which the budget targets are set and the budget speed is written. The CA, with his team of economists, authors the economic survey, which is presented a day before the budget. Analysts often try to guess the likely mood of the budget from the survey. Dr. Nageswaran also has been at the forefront of finance track discussions representing India during the G20 presidency last year. Before embarking on his academic career, Dr. Nageswaran worked in the private sector for nearly 17 years. He was currency economist at the Union Bank of Switzerland, head of research and investment consulting in Credit Suisse, private banking in Asia, head of Asia Research and Global Chief Investment Officer at Bank Julius Baer. He has co-authored books, Economics of Derivatives and Derivatives, that were published by Cambridge University. Another co-authored work, Can India Grow?, was published by Carnegie Endowment for International Peace in November 2016. Dr. Nageswaran has brought realism and database discourse to the economic narrative coming out of the finance ministry and is well regarded by fellow economists. Many thanks, Dr. Nageswaran, for agreeing to be with us and the trouble you took to travel from Delhi to be with us here in Mumbai at the BFSI Summit. May I please request you to address this audience and thousands who are watching the summit proceedings online and deliver a keynote address on India's economy in the evolving geopolitical environment. Thank you very much. To you, Dr. Nageswaran, please.
Mr. A.K. Bhattacharya, Mr. Shailesh Dobhal, and my conversation partner, Mr. Tamal Bandyopadhyaya, other journalists, senior editors, officials working for Business Standard, ladies and gentlemen. For me, it's a case of being third time lucky, because in the last 2 years, Tamal has been inviting me regularly to attend this BFSI conclave. Somehow it is my misfortune that I was not able to attend. But maybe Providence wanted me to be there on a landmark occasion of Business Standard at 50 to be physically present here. I didn't realize that. I think it is a remarkable achievement, especially in this age of social media and people consuming news of that, for a newspaper to be able to hold its ground and still command a wide audience and respect from not only policy makers but also the public, business leaders, etc. And I hope, whether or not I'm there at BS at 100, I wish the newspaper much more success in the next half century as well. let me first, let me share my remarks with you on this topic that I had chosen, which is to speak about the Indian economy in the context of the evolving geopolitical environment. As many of us know, this was a year of elections, of course, in India, the United States, Indonesia. We also had elections in the UK, surprisingly in France and Poland. Maybe I'm not listing them all, but the import of many of these election outcomes will take time to understand and be felt. The repercussions and effects will be felt for years, if not decades. In particular, the recently concluded elections in the United States matter a lot to the world, unsurprisingly, of course. While there are many commentators to unpack its effects on the political and social and cultural aspects in that country and elsewhere, I will focus today on what it means for energy prices, climate, energy transition, and trade agendas. These are my personal views, and I'm not speaking on behalf of my employer. Let me start with energy prices. I think the outcome is positive for energy prices to remain reasonable and affordable. That's important for India and several other developing economies. Fossil fuel prices, barring major supply disruption, should be well behaved and stay within recent ranges, in fact, tending towards the lower end of such ranges. The possibility that the Red Sea passage becoming likely safer and smoother will also mean lower transportation costs and overall lower landed prices of imports, apart from easing the passage for even export shipments from India. That too is a positive. Energy, with its all-pervasive impact on the economy, matters a great deal. We are on the cusp of transitioning to becoming a middle-income economy. We are already a lower middle-income economy, but we will soon become a middle-income economy. Therefore, we not only need reliable energy supplies, but also one that is affordably priced. The incipient uncompetitiveness of some leading advanced economies can be traced to the fact that in recent years, their energy input costs have risen significantly. We should remember that voters, even in strongly blue states in the United States in recent elections, have rejected ballot propositions that would have raised the price of natural gas. They have rejected these propositions. Second, concerning climate change and energy transition too, India is likely to benefit from higher degrees of freedom that might follow in the wake of these election results. Make no mistake, India does need to diversify its energy sources, both geographically and in terms of their underlying nature, that is fossil and non-fossil. India has been doing that. It is well ahead of the target it has set for itself as per its nationally determined contributions by 2030. In its report on blended finance, released in September 2023, the International Finance Corporation has acknowledged that in line with its NDC, India is the only G20 country that is on target to reach its, in line with 2 °C warming above pre-industrial levels by 2030. That said, it's always desirable and necessary even to have the freedom and the autonomy to determine the pace of such transition ourselves. That is crucial for countries to own the energy transition. If countries don't own it, the resistance from the governing and the governed towards external pressure on energy transition will ensure that the target remains elusive. Parenthetically, I should add that, as I wrote in a long piece in Business Standard earlier this week, energy transition is a fundamentally incorrect concept because there is really no transition. Societies have not sequentially progressed from one source of energy to another. The earlier forms of energy are not abandoned or shrunk in usage when newer forms of energy are embraced. If anything, their usage actually goes up. That's empirical record for us. I don't wish to repeat the arguments I had made in that article. I urge you to read it in its entirety. Renewable energy, while desirable for many reasons, is challenging, is capital intensive, needs much more land, and also makes us dependent on external sources for many inputs that facilitate the generation of power from renewable sources. There are also issues of dealing with current thermal energy assets, labor displacement issues, and so on. That is why the full macroeconomic impact and consequences of energy transition have to be understood, particularly from a developing country perspective. So while developed countries have accumulated carbon debt that they need to repay, their refusal to take cognizance of that, let alone make efforts to reduce their debt, makes a mockery of the so-called carbon budget that remains for developing countries to use in the next 3 to 4 decades. To add insult to injury, Europe is on course to impose the carbon border adjustment tax in 2026, making light of the Paris Agreement. The climate ambassador of the United States, Mr. John Podesta, some months ago, had also hinted at the United States considering a similar tax. That would have been concerning. It appears now reasonable to say that the prospect of some of these things materializing has become cloudier. And that's a good thing for India and other developing nations. Lastly, on trade, just as in climate, there is a near religious belief in free trade. Free trade works well in theory, but never as well in practice. For starters, historically, free trade has been episodic in the world. Today's developed countries, while they were in their early stage of economic development, adopted restrictive trade practices, protected their domestic industry, and even stole intellectual property from one another. After they had developed their manufacturing capabilities and confidence in their competitiveness, they adopted the rhetoric, logic, and ideology of free trade to price open other markets. In other words, after they reached a certain development status, they kicked away the ladder of restrictive trade policies that they followed so that others would not be able to use them to climb to the top, as Ha-Joon Chang, a professor at Cambridge University, put it in his eponymous book, Kicking the Ladder. Many economists today wring their hands at the emerging geo-economic fragmentation. However, the time they dedicate to hand-wringing would be better utilized if they used it to reflect on why geo-economic fragmentation arose in the first place. That is because geo-economic integration did not deliver goods for the ordinary people. The admission of that failure would set them on course to repairing the flaws and reversing the fragmentation that is gaining ground, but such a prospect appears remote. Similarly, lamenting the fading commitment to free trade can be abandoned in favor of examining why free trade did not deliver the goods for the working class men and women in developed countries, forcing them to turn their backs on it. With rare and occasional exceptions, economists have not proven themselves capable of reflection and admission of the follies of their ways. That is why practical men and women choose to ignore them often, as did the American electorate, faced with the non-endorsement of the winning candidate by 28 economists who had won the Swedish Riksbank Prize for Economics over the years. Therefore, we do not need to partake in the hyperventilation about oncoming trade battles. For starters, political parties on either side of the aisle in advanced economies in any case have long ago abandoned their commitment to free trade, and climate policies have already become extensions of trade protectionism. Developing countries should evaluate economic policy prescriptions from the prisms of competitiveness, capacity, maintenance of economic and social stability, and increasingly national security. Balancing these goals necessarily involves trade-offs and requires pragmatism rather than an ideological commitment to any particular economic policy prescription. Specifically with respect to India in the coming months, there is no need to panic. External trade growth in any case is subject to vagaries of global growth more than it is subject to restrictive trade policies elsewhere. Global growth is steeped in uncertainty, and policy stances and decisions that may be adopted by the incoming administration in America may open newer doors for the country. We should do our homework, of course, at several levels. Be prepared, but preemptive pessimism is premature and unwarranted. Let me now turn to the domestic economy. Concerns about a slight slowdown in growth have been expressed in many quarters. Causes are speculative at this stage. It is variously attributed to the election and monsoon calendars, slower growth of capital expenditure on the part of the public sector, and macroprudential actions of regulatory authorities, but no one knows yet whether it is temporary or slightly longer than that. Wherever it is possible to reverse or change course upon achievement of pursued objectives, that should be done. Macroprudential policies are rightly counter-cyclical in nature. Therefore, they must lean against the wind in either direction. Of course, wherever it is possible to accelerate capital expenditure in line with budget commitments, that should be done as well, and that is being done as we speak. When we get the data for October, we will see that the capital expenditure from the public sector, which includes the union government, has indeed caught up and accelerated the pace that we saw in the first 5 months of the financial year. But one possible cause that is not widely debated or discussed is whether the Indian private sector itself may be unwittingly or otherwise responsible for it, even as it worries about the economic growth slowdown. Household spending is, of course, dependent on household income, which in turn is dependent on employment and to a lesser extent on entrepreneurship. Post-COVID, Indian corporates may have adopted hiring and compensation practices that could be detrimental to the growth of household income and spending power. Flexible work contracts and incentive-based compensation may have undermined job and income security for many. There is possibly a creeping informalization of the workforce in the Indian formal corporate sector, even as profitability growth has surged by a multiplicative factor in the last 4 years. Compounding this is the deployment of technologies such as artificial intelligence. As far as possible, they should be labor complementing rather than labor displacing. It is not easy to lay down mechanical rules or laws around these things. Even if one can do so, they may have unintended or unpleasant consequences. While the private sector may correctly argue that there is a trade-off between competitiveness and labor share of output, that trade-off exists in the short run. And in the medium run, there is no such trade-off, as we say in the case of growth and inflation. If labor incomes and purchasing power do not rise, eventually, that will have adverse effects on corporate top line and bottom line growth, not to mention the implications for social stability and peace on which economic activity and the pursuit of commerce depend. To conclude, India is well positioned in the world today, politically and economically. The foundations of economic growth are strong. Macroeconomic and fiscal stability and prudence are the core pillars of this foundation. The government's record on inflation has been exemplary, and it is due in large part to the substantial improvement made to the country's physical infrastructure that has brought down logistics cost, and also the digital infrastructure that has improved transaction efficiency and, of course, expert monetary management in the last several years. To build on this foundation and to ensure that the next phase of growth covers broader swaths of society, governments around the country, I mean state governments and local governments, have to deregulate and let small and medium businesses thrive. Much remains to be done to let businesses, especially small and medium ones, get on with legitimate economic activity. But policies can be effective more so if the private sector too recognizes the role it has to play. India's strength is in its demography, and it is incumbent on the private sector to play its part in keeping it that way. If all stakeholders recognize their roles and obligations and join hands together and put their heads down and let our achievements evolve and speak for themselves, the future indeed is bright for the country. Thank you very much.
Can we give Dr. Nageswaran a huge round of applause? I think it was very astute, original, and based on his experiences. Can I invite now Mr. Shailesh Dobal to actually render a summarization of his keynote?
Thank you, Ridhima, and it's a very difficult job to summarize such an incisive and a high-quality keynote address, but I'll try nonetheless. First of all, many thanks, Dr. Nageswaran, for your encouragement and wishes for BS at 50 and BS at 100. Hope we are able to live to those expectations. The many takeaways from the CA's lecture today, the 3 or 4 that come to my mind is how he elucidated that we are on the cusp of becoming a middle-income economy. And not just that, but its relation to energy costs and availability, and the policies that we need to follow, the strategies of freedom and autonomy to determine our own energy transition. Closely linked to that is the duplicity of the developed world on both carbon emissions, carbon debt, and trade, and how we need to keep our own counsel, need not hyperventilate on the coming trade barriers. And we need to look at trade environment from the prism of our own competitiveness, capacity as national security. And then he elucidated a lot on the domestic slowdown, the reasons, the perception of that slowdown, how private sector investment may or may not be coming, and how next phase of growth and the policies that we need to follow has to focus on our strength, which is demography, and we need to let 1,000+ boom in terms of SME, along SMEs to function. You know, I'm sure this audience has many more. Thank you so much, Dr. Nageswaran. Thank you so much for such a lecture. And I would invite my colleague, Mr. Tamal Bandyopadhyay, Consulting Editor of Business Standard, to please come up on stage and start the fireside chat tour with the CA. Thank you so much. Thank you.
Thanks, Anand. We are third time lucky, not you. I said we are third time lucky, not you. Because, yeah, on the past 2 occasions, 2 years, we could not get you. Thank you for this time making it. So, yeah, actually, you answered many of my questions, but a few things still left. You spoke about geopolitics and impact on energy prices, climate, trade, and all. But the first obvious question is this: Donald Trump or Dollar Trump, whatever you say. I mean, already you have seen what happened to Indian rupee. Dollar index is going up. FII outflow had already started, continuing. FDI also, not to talk about much. So what's happening on the financial sector, and how do you see the post-US elections result? Post-US results, how do you see that?
No, I think...
I mean, poll results, that's
understand.
what I meant.
I think whatever is happening on in the financial sector, I think it will be still early days to attribute it entirely to the election results. Some of these trends were already in motion before the election outcome happened. And also, we should not over-interpret the first few days of market reaction to the election outcome. I think we need to allow time to settle down. So whether it is with respect to FDI or the currency movement, etc., I don't see any reason to be overly concerned or alarmed about what has happened in the Indian markets in the last few days, or for that matter, in the last few weeks, even predating the elections.
talking about growth, you are pretty conservative about growth. Your is 6.5 to 7%. Day before yesterday, RBI governor was here, and he stuck to 7.2% growth. I don't think in December, Monetary Policy Committee meeting, which is happening, I think 6, 7. 10th is governor's current term ends, so he will be, I mean, that's another story whether he will continue or not, getting another term, but he seems to be more bullish than you. And he was giving all this new high-frequency data, some of them, to support why he is thinking that growth should be 7.2. You just now spoke about government spending, which was not there in first quarter because of elections and all, already started happening. So from this platform, can you tell us that, is there any, are you thinking of revising your growth estimate upwards?
No, I think in the latest monthly economic report that we bring out, we maintain that we are comfortable with this current range as our possible projection for the current financial year.
That's 6.5 to 7%.
6.5 to 7. Where we end up in this range is, I think there is no point in pretending to be extremely accurate, because whether we hit 6.7 or 6.9 or even 7. But let me tell you, I would be very happy if we are wrong and the Reserve Bank of India's estimate turns out to be more accurate than ours. I think that is quite possible. And we don't rule out that possibility, because I think forecasts are, more importantly, a guidepost to where we are heading. Because I don't think any forecaster anywhere in the world gets these numbers by design. It's by accident to be able to get the numbers accurately realized in practice. But I think we all know that the first 5 months of the year, capital expenditure was lower than the previous year, and therefore there is a need to catch up with these numbers. But I'm confident that in the 7 months of the financial year that are remaining, from October I'm counting, I think it will catch up quite briskly in and it may end up being slightly higher than the actual capex spend we had in the last financial year as far as the union government is concerned.
But as of now, you'll be happy if it gets closer to 7%.
I'm sorry?
As of now, you'll be happy if the growth number gets closer to 7%. That's what you're saying.
Of course, who will not be happy if it gets closer to 7 or 7.2 or even higher? So, okay. I mean, the more the merrier.
Okay.
Yeah.
That one related question is this, and you seem to have a very strong opinion about on inflation. On inflation. And what I mean that you smile that keeping food inflation out of when RBI considers, the MPC meets and all. So, but I don't think there are too many takers of your theory. Even Raghuram Rajan also, many, including Dr. Rajan, said no, in Indian context, you can't do that. Food is about 47% of the inflation in terms of the inflation basket and all. So you can't afford to. But your idea, or you had said that is a time to take a look at it to keep food out of it. And when RBI takes a call on the interest rate and all. So can you tell us, after hearing all others, you sort of change your mind, or?
No, I think I had in an article I wrote for one of your competitor dailies, Mint, sometime in September. I had spelled out the logic of why I felt
tell us more, that everybody has not read it, so tell us more.
Why the central bank should not be burdened with a target for one particular sizable component of inflation that is not directly in their control. And I had also given other reasons as to why that will militate against other objectives. It is not my point to say that we should be unconcerned about food inflation, but there are other instruments to deal with it, subject to the fact that we also are interested in enhancing farmers' terms of trade and their incomes, etc. But be that as it may, it was good to surface that discussion, and as you correctly said, there were not too many takers for that hypothesis, and it's just
trust as well, because sometimes having set ourselves on a particular path, even if we agree that there are reasonable grounds to take an opposite point of view, sometimes reversing a framework that has been set in place may have its own costs as well. But maybe we have to wait and see how the evolution happens. Maybe at some point, when the share of food expenditure in the overall expenditure comes down, it has already come down to below 40% in the latest household consumption expenditure survey. Then when the food expenditure becomes somewhat an insignificant portion of our monthly household budgets, then it becomes probably that much easier to talk about changes. But right now, I think I don't have anything more to add or stick to what I wrote, because it was good to surface an hypothesis for discussion, and it was widely debated, and I think we have considered all points of view, and we should let the matter rest there.
So your purpose is, you wanted a debate on that, right? Yeah. Now tell us, all of us are talking about in financial sector that the financialization, now the savers are turned, investors. Banking sector is seeing deposit growth is a challenge. Finance minister, every meeting with bankers talking about to focus on deposit liabilities, which never happened before. Reserve Bank of India is hinting at it and all. So sitting in your chair, I mean, how do you see the so-called financialization or the savers turns investors in Indian context?
I think it is obviously a welcome development. If savers turn investors, that's a good development. What we don't want is savers turn only speculators. Speculation is necessary, but all within all in balance or all in moderation, etc. And it is not in their own interest to be excessively dedicating their savings to futures and options or extremely short horizons, etc. If savers become investors, eventually that money will find its way back into the banking system. So that is not a problem. Financialization is a term that became extremely prominent even in global finance, when most of the economic activity is dictated to by what happens in the financial sector. And that was a challenge even for developed countries, as the 2007-8 financial crisis demonstrated. It will be even more detrimental for developing countries if real economic outcomes are outpaced by financial sector outcomes or market valuations, etc. And we do need real assets to grow, because we have still continuous investments requirements in infrastructure, in housing, to manage energy transition, etc. So to some extent, securitization and financial products do serve that purpose. It's all about ensuring that the tail doesn't wag the dog.
Anand, I know it's not your remit as such, but since you have the years of PMO, let me ask you this question. Do you think there's a time now to relook at import duties? It's too high. I'm just giving you one example. iPhone is being produced in India, but because of that high import duty, iPhone 16 is far, far higher the cost in India than anywhere else. US, UK, Dubai, China, Vietnam, Thailand, Canada. I'll go on my overseas visit anywhere, I'll pick up there. Even though iPhone is produced in India, I will not pick up here because it's higher cost. And the reason is being import duty. So is this the time to, this is only one example, time to take a relook at all this kind of stuff?
As you correctly said, it is not my remit. But this issue has been again surfaced on many occasions, and I think the government is seized of that. And you saw that reflected in some of the import duty reductions that were brought about in the budget. Because it is one thing to have high import duties as one of the means of developing domestic capabilities, but if one wants to be plugged into the global supply chain, then one has to be competitive as well. So there are two different approaches to import duties that one can take depending on what one's objective is. So to be able to provide time for domestic industry to grow, there can be a case for import duties. However, if one wants to be plugged in, in the global supply chain, then at least early stage components of production, the duties have to be on the lower side. And I think an effort, a beginning has been made in the budget. But let's also not forget that India's import duties are nowhere near where they were 20, 30 years ago. And other countries may be practicing trade protectionism in other ways. So I think we need to, again, keep the global context in mind when we talk about where we want to go. But regardless of the global context, I agree with you that if we have to be globally competitive and want to be an exporting player as well, formidably so, then there is a case for import duties to gradually come down in several areas.
Recently, either you spoke somewhere or you have written somewhere talking about capital market reforms. Capital market reforms. Remember that?
Go ahead.
Yeah, no, that's what we always claim that whether it's settlement system or whatever is thing, we are the best, the most advanced in India.
I didn't write it.
Huh?
It must be Anant Narayan, not
No.
me.
Acha.
Okay.
Okay, you don't want to give it a pass and all. But this what you spoke about, agriculture as a growth engine, right? That was the time when this State of Rural Youth Employment Report 2024, this thing and all. And you said that this is the time we must. And you also mentioned that Brazil, where the youth are participating in agriculture and farming activities, etc. And we need to follow the Brazil example. That's what you said.
Right. Absolutely. I think the reason why we said that as in the economic survey, and we're given the logic as well for it, while we do want to see manufacturing become an important component of our GDP, and we are on track to achieve that, and about a couple of weeks ago, I even wrote a long piece again in Mint, where I've been a long-standing columnist before I took up this job. The second decade, our efforts to grow manufacturing were stymied by the fact that corporates and banking system had balance sheet issues. But now with the improvements in physical infrastructure and the ease of doing business and corporates beginning to undertake capital formation, the manufacturing share of GDP should rise. But that is why I mentioned in my remarks as well that the importance of having a Mittelstand, the small and medium enterprises, is critical to become a manufacturing player in the world. But that said, it is not going to be easy. It will take time. And services sector will also face competition from the inroads artificial intelligence will be making, etc. Therefore, we cannot afford to relegate agriculture as a sector, a primary sector that we embrace at an early stage of development. It is possible to have agriculture still contribute substantially to economic growth, provided we can use value-added activities, food processing, cold chain storage, etc. And agriculture has to become fashionable rather than simply a matter of cereal production. And to that extent, policies both at the union and the state government level have to encourage participation of the youth as agriculture as a viable economic activity.
Anant, you actually launched that report, State of Rural Youth Employment Report 2024 by Global Development Incubator, right? Now, that report, I was going through it, it's about 5,000 samples youth they interviewed, and it spoke about 80% of them, they are looking for jobs in small industries, in retail, in businesses and all. So on the one hand, you are talking about that take a relook and go back to agriculture, but the rural India youth is actually looking for jobs.
No, it's absolutely. Huh? I think we need to basically, we don't have the luxury of choosing in the sense that as a policy option, we need all sectors, all the three sectors, primary, secondary, and tertiary, to be significant contributors to economic growth. Because I don't think it is possible for any country or any observer or any economist to understand what it means to move forward a country of 140 crore people. We cannot be exclusive. We cannot choose that this is the only path, services or manufacturing. I feel that individual states can choose specific sectors, but collectively as a country, we have to be sector agnostic.
Today's newspaper talks about rural demand lifting FMCG growth. Till recently, I've been talking about the rural indebtedness and unemployment. And in fact, a lot of things what is happening in the unsecured loan space, bankers in private or NBFCs and all the lenders, they blame is the rural indebtedness is growing, and that's actually encouraging them, what RBI talking about, the push loans. So do you think this our concern about rural indebtedness and the other part, unemployment, etc., now you are seeing that no growth is coming back?
Yeah, definitely. I think we are seeing that in the indicators as well. For example, in all categories of automobile sales, rural India has seen a growth rate in the first 6 months of the financial year compared to the last financial year. If anything, urban consumption indicators have trailed behind, and that is why I spoke about the importance of ensuring that hiring and compensation practices are growing in line with, if not exactly to the full extent of profitability growth, but in line with profitability growth. That's equally important.
In one of your writings in the newspaper, you spoke about interesting thing. You just said that no Make in India, people are not very excited about it, but actually you are seeing the results of Make in India. You are talking about how the number of smaller units are going up, how the employment opportunities, etc., are going up and all. Can you tell us what exactly you are seeing?
No. I mean, basically, what I wrote was in the decade of Make in India, we were in the early part hampered by the fact that we had balance sheet issues, and those are now behind us. And we are seeing a revival in investment, particularly in machinery and equipment, which is critical. At the same time, if you look at the annual survey of industries also, for which we now we have data for 22-23, the growth in number of factories or the growth in number of people employed in factories which have more than 100 workers, which by Indian standards, they are small to medium size other than micro. Those factories and employment in those factories has grown at a faster rate than in those factories which are below 100 workers. And similarly, the number of factory units which have 5,000 or more workers, that has grown in the last 4 years at a faster rate than those factories which have units which have less than 5,000 workers. So there is clearly evidence in the factories data on the progress achieved in formalization and also in the growth rate of factories which are slightly larger in size than those which are smaller in size. I think that augurs well for us to be able to realize our Make in India goals. It is not as if we have achieved our milestones. I'm just saying that these indicators are promising.
I have many more questions, but we ran out of time. But one thing I want to understand that typically we talk about public-private partnership, but in one of your articles you are talking about center, state, and private sector. It's something interesting, something different. Can you tell us what exactly you have in your mind?
I think what I meant was, again, I elaborated on it in my initial remarks as well. So the union government focuses on financial sector reforms, taxation, creating nationwide infrastructure, scale and efficiencies. But when it comes to land, labor, education, electricity sector, and ease of doing business at the ground level, much action has to take place at the state government level. And when it comes to the private sector, it is equally important to ensure trust between capital and labor, ensure quality of products, investment in R&D, and partnership with academia when it comes to skilling education, and also an awareness of the fact that this country is a labor surplus country and that there is a good balance needs to be struck between technology deployment and labor deployment as well. These are all the obligations or expectations or requirements from the private sector. So each one of them have their respective roles to play in making us a developed nation by 2047.
Anand, last question, seriously, is this March your current tenure ends. So this is the last economic survey, whether you continue to hold the portfolio, we do not know. Just presume that the last economic survey, you will be full-fledged before the budget and all. 3 years, and you are living in Singapore and seeing India from Singapore before that. Coming back 3 years, what are the new things that you did not know about Indian economy, and sitting there in North Block, you had seen? Just tell us.
No, I think it was not as if I was a stranger, because if you look at my arrival and departure entries in my passport, I used to make 10 to 12 or even 15 visits to India every year before. So it was not as though I was a relative stranger suddenly parachuted into this role in North Block. But that said, it is one thing to vicariously appreciate the progress that is happening in this country, but it's another thing to be observing it firsthand and being part of it. I don't think there is any other place that is as fascinating and interesting as India is on its development journey. As I said, there is no other country, there is no template for us. We are 140 crores and we are in a democratic framework and trying to become an economically developed nation while having adopted political openness even before becoming economically prosperous and open. Other countries did that in a different sequence. So I think this is extremely unique and extraordinary, and the energy that you observe being here is very different than what one can perceive from being outside. So in that sense, it has been an amazing learning experience in the last almost nearly 3 years.
Thank you, Anand. So that brings us to the end of it. Give him a big hand, and thank you for making it on the third time. Thank you.
Thank you so much, Dr. Nageswaran. At this point, can I request Mr. A.K. Bhattacharya, Editorial Director at Business Standard, to present Dr. Nageswaran with a memento. I think exceedingly discerning and astute discourse, clearly talking about the fact that if savers turn investors, that's a good development. What we don't want is savers turning into only speculators, and financialization being an important aspect of our growth, and speculation is necessary, but all in balance or in moderation. And the fact that central banks should not be burdened with a target for one particular cyclical component of inflation that is not directly in their control, but maybe we'll have to wait and see how the evolution happens. So there were insights based on his hindsight as well as forward-looking perspective. So thank you once again, Dr. Nageswaran, for being with us. Ladies and gentlemen, next up, we'll be again demystifying an interesting and a very intriguing and a highly relevant topic for all of us. This panel discussion is going to be taking place with country's most revered economists. As we continue to navigate the complexities of a rapidly changing global economy, the choices we face are becoming increasingly difficult to balance. In this session, which will be unfolding on stage in a few moments from now, we actually delve into one of the most pressing debates of our times. The topic being Fed or Food, a thought-provoking and reflective exploration of how global financial policies, particularly those which are led by the Federal Reserve, impact essential sectors such as agriculture and food security. With pressures from inflation and supply chain disruptions, the intersections of monetary policy and food security has never been more relevant as ever as it is today. As economists, policymakers, and global leaders grapple with the effects of interest rate hikes, global commodity price fluctuations, and economic instability, the real question emerges: how do we sustain the economic growth while ensuring food security for billions? Today, we are privileged to have with us an esteemed panel of economists who not only bring their expertise, but also their insight into this very complex and relevant narrative. Without further ado, can I call on stage our moderator for this part, Mr. Tamal Bandyopadhyay, Consulting Editor at Business Standard, and joining him on stage are going to be the following panel members. Beginning with Aditi Nair, Chief Economist at ICRA, Ela Patnaik, Chief Economist at Aditya Birla Group, Sachidanand Shukla, Group Chief Economist at L&T, Samiran Chakraborty, MD and Chief Economist, Citibank, Soumya Kanti Ghosh, Group Chief Economic Advisor at State Bank of India. So ladies and gentlemen, please fasten your seatbelts and get ready for this exhilarating conversation.
Ridhima, and hello and welcome to the show. We'll have a chat with 5 economists. Fate of food. Ridhima was saying a lot of complicated things, but let me put it very simply. What we want to understand is this is local versus global. That's what, and it's what do we expect from monetary policies and all. What to should we walk the path following Federal Reserve, not only Federal Reserve, Bank of England and others, what's happening and all, we need to respond. I'm not getting into all the technicalities, the difference between Fed rates and our rates, and the 10-year yield in India and US. Of course, this is a very critical for money flow, both outflow and inflow. But we want to hear from you. I don't want to talk about that. So what do you say? Have we actually decoupled ourselves, or no, we continue to follow? Our governor, Shaktikanta Das, has been continuously saying that, well, Fed is cutting the rate, but how does this matter to us? Our priorities are different. Our realities are different. Our priorities are different. There is an echo you can't hear, right? I mean, he is also, Sachin also saying, CA also saying the same thing. So, yeah, I don't know. So, our governor has clearly said that we are decoupled. That's what he said. Maybe decoupled is my word, but probably he also used it. So we don't need to follow the Fed's footsteps. But there are people in your community believe that no, I mean, we can put up a show that we are decoupled, but actually we cannot. We need to follow sometimes. Now, why, when, how, or is there any merit in the talk, or no, we are actually decoupled and we go by what our ground reality says, like food inflation is staring at us, which is a thing governor again had said day before yesterday that the October number would be far higher than September. So where is the question of any rate cut, even though Fed has cut the rate? That's putting it very bluntly. So we'll hear from you. We'll start with one of the two between Aditi. We'll go by alphabetically. So Aditi, you said. First, some preliminary remarks, then we'll get into all the things.
Sure. Thank you so much for inviting me back for this panel. I'm going to keep it short. Between Fed or food, I think we need to first focus on food. If we take your other parlance, local versus global, then I think local is paramount. Many times you've heard the RBI governor say as well that our domestic growth inflation dynamics are going to supersede what's happening globally. 2 points from my side. One, if we look at our households and how inflationary expectations are created, definitely food itself within our entire inflation basket is what really dominates the household's own perception of inflation. It's the stuff that they buy every week and the stuff they pay every month. In my view, food and rent are the two defining factors of inflationary expectations, and these are inherently driven by local factors. So that's a vote for food and for local. The other thing that I just want to say to kick off is that if we look at our own forecasts for growth and inflation and how much rate cuts can be supported by the medium term or the next 12 to 18 months, we think that only 50 basis points of rate cuts appear feasible in the Indian context. Whereas from the Fed, the amount of rate cuts will be far sharper than that. So in any case, it's not like we're going to be able to do a matching. We're not going to be able to do a one-to-one. So the timing of the rate cuts, therefore, should be very much more centered on what is appropriate given our own local context rather than, upfronting it and front-loading it to line it up with the Fed, and then having a long time after that where the Fed continues to cut, but we're at the end of our ammunition per se.
Dr. Soumyakanti Ghosh.
Thank you, BS, for inviting me back to this, and it has been always wonderful to speak at this event. The topic is very interesting, Fed or food. If I want to sum up in one word, I think we are following, we are definitely looking at food, but also following Fed in a different sense. So the first thing is to note is that I think if I want to make an assessment of the current scenario, there has been a lot of geopolitical uncertainty in the last few years. If I take 20 as a starting point when the pandemic started, then there was the war. It has continued. Recently, there has been an election in the US. There has been a lot of noise regarding the elections. But if I take all these factors together, I think there are a couple of things which is clearly discernible from the data if we look into it a little more profusely. The first thing is that, contrary to the popular perception, is that trade or interest rate or inflation could be a casualty in case and relating it to the US election results doesn't seems to hold ground if you look into the historical data. If you just look into the example from 2016 onwards till 2014 on the dollar rates, the US interest rates, and also on the other trade movements, you will actually find that this, apart from a brief period of disruptions, the trends are actually continued to favor. For example, if you look into the value of the rupee, it has been largely in consonance with the domestic fundamentals. So has been the interest rate. In this point, I would like to recollect that India had we faced the worst pandemic with the lowest borrowing cost. So I think most of these numbers are now, I think, agnostic to the global developments. I'll not say agnostic, but mostly immune to most of the global developments because they have evolved over a time. So that's my first point. So I don't see too much of a disruptions to the Indian macro in terms of global disruptions. If there is some impact on the global economy, that could obviously impact, but that's not going to be too much. Coming to the inflation part, I think there has been a lot of rising, but I think food inflation has always remained an enigma in the Indian context. And it will continue to remain an enigma given the fact that climate disturbances are now a huge part of our day-to-day life. You will see that the last couple of years has seen that the unseasonal rains, other things taking center stage, temperatures taking center stage. So in my sense, I think it will continue, the food inflation will continue to be an important factor. The only way you can look into this, you can have a debate on whether, what could be the trend in it, but I think that you can't ignore that part of the food inflation component. And finally, if I sum up in terms of the rate decisions, I think it's best left to the discretion of the central bank. But past experience suggests from 2008 onwards that whenever central banks increase rates, that's always a coordinated action, and whenever they cut rates, that's specific to the country. So that has been the example of 2008 after that. So if I take that factor into account, I think Indian rate cuts will be specific to India and not to Fed as such.
Thanks so much. It's pretty interesting. I was not aware of this, what you said, that the rate rise happens in sync, but rate cut country specific, and for you it's not Fed food. Right, Sachidananda, you represent a little different sector because they are all bank economists, these two gentlemen. You are with another entity from corporate India, you see. Just tell us Fed or food.
Let me add one word to this, and
Please.
This is not a play on the alphabet F. Let me say, instead of Fed or food, which my co-panelists have spoken about, let me add a word called friction.
Friction.
in terms of trade policies. And if you look at what the US has done, it has championed a concoction of industrial policy, which is very muscular, combined it with trade policy, energy security, and geopolitics. And if you add the dollar, which is the reserve currency of the world, to this concoction becomes explosive. And markets, policymakers should be cognizant of rate of change. Something has really changed with the US elections, and this has to be a part of the reaction function of central banks around the world. I don't think that the RBI can really ignore it. Yes, food is important, has been important. Within the CPI basket, I mean, we've just seen the CA speak about the relative importance of food, etc., in monetary policy. But the point I'm making is simply this, that the underlying has changed, and some of this must go into the reaction function of even the RBI.
So it's Fed, not food, in other words. So 2:1, Samiran. And you will have a casting vote if it's 2-all. Ila, I'm talking about you later. I said you will have a casting vote if it's 2-all. MPC has 6, like if it's 3-all, then governor has a casting vote. So anyway, yeah, Samiran.
Good afternoon, everyone, and thanks for inviting me here. So I'm going to couch this more in your language of global versus local rather than Fed versus food, and I will tell you why. I guess first we have to understand that monetary policy is a cyclical tool and not a structural tool. So the point that Satyananda was mentioning, in my view, that has to be addressed by different policy instruments. We can also be very muscular with our industrial policy, but I don't think industrial policy can be challenged by monetary policy. Having said that, if you believe in this cyclical part, then what we need to understand is that globally, what are the cyclical factors which are common for most of the countries? So something like commodity prices affects almost all the countries similarly, and to that extent, the monetary policy response also could be similar. Or, for example, Anand was mentioning about the trade routes and sways and cost of transportation. That also could be a factor which is common across the board. So when central banks are responding to those common factors, you could see some commonality in the policy actions as well. But I think the bigger challenge is that what we are observing in another context is, and connecting to what Shomola was saying, is that emerging markets typically have an asymmetric policy response. When the Fed is hiking, they need to hike because of worries of currency depreciation. But when Fed is cutting, there is no immediate need for a cut because currency appreciation is, in an odd way, a good problem to have. So what we are witnessing today, the reason why there is divergence in central bank action vis-a-vis Fed is that dollar is not appreciated very significantly, which would cause any damage for EM. So I think these are the
that was till recently. Now we don't know.
I mean, this is not a monetary policy. That's a fiscal, trade, industrial policy issue which is driving dollar today. So this is, to me, the two important directions, the commonality of the cycle and this particular factor. But why I avoided the Fed versus food thing is that within local, there's a big debate on how much emphasis central banks should put on inflation versus growth, and within inflation, how much emphasis should be put on headline versus core. That, I think, is a very different debate, so I've covered the debate in my way.
We'll get that, yeah. Ila, we'll discuss that.
Thanks, Tamal. Let me begin by thanking Business Standard for inviting me here. early in my career, I was a columnist for the Business Standard for 5 years, and I see familiar faces and friends here, so it's a delight to be here. What determines monetary policy, and in particular RBI's monetary policy, are three things. The first, of course, is inflation. We've been debating about whether food should be part of that basket or not. One of the reasons why food was chosen to be part of the basket when RBI was given the mandate of targeting inflation, and it was given the mandate of targeting the headline inflation, was because that's what consumers relate to. And when it was studied at the time, it was found that almost every one of the 30 countries that had moved to inflation targeting was looking at CPI. So I think, as Anand correctly pointed out, it is a question to debate. We have debated it. Earlier, when the mandate to the RBI was being given, and for many, many years, RBI's position used to be keep it out. And exactly for the reasons that Anand mentioned, which is that it is not something that RBI has direct control over. So maybe the non-food part, and that's what some of the research on monetary policy showed, that it is the non-food part where the impact goes, and that's how the overall comes down. And that is an issue that will continue to be debated. And we know that at this moment, food prices are high and putting pressure on the overall CPI. The second thing is RBI's mandate of being mindful of growth. And I think here earlier we heard this very interesting question that Tamal you asked, Anand, which is that the RBI governor seems to be saying 7.2, and you are saying Ministry of Finance is more between 6.5 to 7, which is a little lower than 7. I think it's very, very interesting that RBI should be viewing this at this time and looking at the signals of mixed growth. So, I mean, I think everybody in this room who follows high-frequency indicators would agree that the signals are mixed. You're seeing some indicators showing an improvement and some showing a decline, and we're all trying to make up our minds and take
improvement is GST, both manufacturing and service sector PMI, vehicle sales, petrol, diesel consumption, international passengers arrival. These are the positives. That's what they were talking about.
Yeah.
Please carry on.
So the fact that the governor sees the economy as doing well, which in other words, as Samiran pointed out, monetary policy is a counter-cyclical tool. So you look at where you are on the business cycle and not growth as something in isolation. And there, okay.
Yeah.
There the governor is indicating that he's seeing the economy as on the high part of the cycle. So that's the first one is inflation, which is food. The second is the growth situation. And the third is the Fed, which let me call it the INR USD. And we know that RBI has had looks at the INR USD, tries to keep volatility down, avoid sharp fluctuations in the INR USD. And this is something that, you know, old Mandal Fleming models all tell us that you cannot have an independent monetary policy in a situation where you target the exchange rate and have an open capital account. So what does it mean for the INR USD if the Fed starts cutting rates now? If the RBI were to cut rates now. And I think that would increase the pressure to depreciate on the INR, which, as Soumya Kanti pointed out, is not a nice problem to have. I mean, he said, you're saying, guys, are saying the opposite thing, which is that an appreciation pressure is a nice thing, but a depreciation pressure is not that nice a thing. If you start defending the rupee, you start losing reserves. After a point, you get panicky. So even that indicates keep rates higher. So it's food and growth and Fed, and all of them are at the moment indicating that
we have to wait.
We need to wait.
Yeah, because if we cut the rate, then for the investors, US market becomes more lucrative than India, and the outflow which already started, we have been seeing FII, will intensify.
So that is one reason. At the same time, if food inflation is high and if the growth is also good, then why cut? So at least that's the scenario now. Just before I finish, I'll just want to mention how does Trump's Trump's victory impact what we think about what RBI may do, may not do? If, as many people are speculating, tariffs come in, tariffs on China, whether it's 60% or it's 10% on everybody, we don't know what exactly will come in, but if there are higher tariffs in the US, if there is inflationary pressure in the US, and if there is expansionary fiscal policy through tax cuts that he's been suggesting, he's been indicating, then that really means that the Fed may slow down on its rate cuts.
Cutting cycle,
on its cutting rates. So we may actually see a longer period of cautiously wait, see, and go ahead on that.
Till recently, the dot plot was suggesting many more cuts, but Trump returning to power, you think it will be delayed, right?
It will be delayed.
Will not be as aggressive as, because the fiscal situation will be different.
Fiscal as well as inflation, both may be different.
You spoke about the core inflation versus food inflation. Just the number is this: in CPI, inflation in August was 3.65. September went up to 5.5, 5.49 actually. September is anybody's guess. It could be even beyond 6% or 5.9 or just about 6. Food inflation, which was 9.24 in September, actually went up to 5.6 in August. And vegetable prices up 36% in September versus 10.71% in August. Tomato, onion, and potato, top, people call them, they are all the spoilers and all. And core inflation continues to be pretty benign. So, Samina, you started the debate, and our CA just left. So do you see, I mean, which part of that on this debate that let get out of food, RBI does not need to bother about food inflation when it comes to monetary policy, because at the end of the day, central bank does not have anything to do with food, and interest rate can't contain food inflation.
So I would say that it's a very complicated debate, but let me just put my fingers on two things where. And for the moment, I'm arguing in favor of the RBI view. I know that we can all switch our hats and start arguing Anand's view as well, because there's merit in his argument as well. So one aspect is that to what extent the food inflation can get transmitted through inflation expectations and wage behavior into actual core inflation as well. Indian data seems to suggest an asymmetric behavior here. So our analysis shows that this food inflation getting passed on to core inflation, higher wages, happens more through urban wages, but does not happen through rural wages. In rural wages, it's the opposite. When rural wages go up, rural inflation goes up. But when rural inflation goes up, rural wages do not always go up. So in an odd sense, if you do not look at this headline inflation, you will affect the income inequality also, because rural wages will not go up, meaning the rural-urban wage gap will worsen even further. Also, what's happened is that despite core inflation staying low, if you look at the cumulative inflation post-COVID, that's 30–40% for most of the commodities. And cumulative income growth has not been as high. So there has been a persistent decline in purchasing power, which one could point out as one of the reasons why consumption growth has been relatively weak. So for one to have this purchasing power back, we need an extended period where income growth exceeds inflation. And for that inflation, headline inflation, it doesn't matter whether it is coming from X item or Y item, headline inflation needs to be much below wage growth
Yes.
for a sustained period, which is where I have sympathy with RBI's view. And the second point is very simple. That's just saying it's much easier to communicate policy in terms of headline inflation than in terms of core inflation. We all have our own preferred core indices. Which one would RBI prefer? It will become nightmarish. Some people even prefer to exclude gold prices from inflation. Should we even go to that point? So, or should we just stick to only vegetable prices? So it's a complicated thing to communicate monetary policy with respect to core. And the absolute last thing, what Anant also mentioned, if it ain't broke, why fix it? This is working well for almost every country that I know of, except for, to some extent, Japan and Thailand. I think every other country just follows headline inflation. Why should we move to a core inflation matrix?
Thanks,
That's
Sridhar.
what my argument is.
We have a very literate audience, but core inflation is just, if anybody is not aware of this, it's non-food, non-oil. That's the core inflation. Sachidananda?
So the very first thing I want to say is some clarification in terms of what Somiran pointed out.
Please.
When I said friction, what it does is it will lead to some bit of devaluation or depreciating pressures on especially the countries that are not really in sync with the US, which is the Chinese neighbor.
Which
And-
Ila also hinted at.
Exactly.
Yeah.
So I
Ila
think
hinted
I just wanted to clear that misunderstanding because it will have implications for monetary policy. The last time around, the yuan fell 5% when Trump came in, and when he started announcing another 1.5% depreciation. And all the neighbors, so we don't really compete with the Chinese directly in many aspects, but what it does is that competitive devaluation will have to be part of the RBI's reaction function. So your rate cuts may get delayed, your currency depreciates and things like that. So that is just one part. I think the more important thing in this whole debate is why should you cut rates? Once you answer that, and you have your arguments for that, it's much clearer by how much and when and all of that. If you look at the growth part, just taking RBI numbers, for the second half, their numbers Q3, Q4 are 7.4. The potential growth rate that they've calculated, and many people have, is 7%, right? So if there is no output gap, and you yourself are saying 7.5 and that sort of a number, so yes, there is some loss of momentum when you look at some of these high frequency indicators, but at best, it is mixed any given point in time, right? But looking at the projections, there is no growth scare. Is growth tanking? No. Then we come to the inflation argument.
Yeah, Sachidananda, we'll talk about the rate cut in another round, given a choice, and we'll take a few questions after this thing. So right now we are talking about what the CEA floated the idea that let's not discuss the food. RBI should only focus on core inflation because RBI has no control over food inflation. Interest rates has nothing to do with food. On that, where are you with the side with CEA or the other side?
I think that's very much settled, at least within the economist community that I know.
Yeah.
What is very much settled, which is you should not really tinker around with that. You have 8 years of evidence of the Monetary Policy Committee. It's done a fair bit in terms of containing volatility. What it does is gives you, irons out volatility in terms of your exchange rate, inflation differential, interest rate differential, and so much more certainty on growth. So in terms of the objectives and achievements, yes, there was this COVID period. I would say it's done a good job. Let's persist with it for time being.
Ila?
I've been part of not just the debate on this for the last 15 years, long before we did this. And I've always had this view that we should include food, and being part of the debates when the ministry and the RBI were deciding this. I just want to add from that.
Please,
go ahead. One of the points that was discussed was that the reason to have core is because that is what demand conditions is what RBI can impact through the interest rate channel. and therefore they said core. And by the way, core also, various exercises were done. One was to make it non-food or non-oil. One was to cut out the most volatile, the top 5% most volatile, and so on. Many exercises were done. Now, while that was true, I think Samiran pointed this out very clearly, that the reason to go with food, even though there is an acceptance that the RBI cannot impact seasonal onion prices, but the one big reason to go with food, included food, which is that headline CPI, was because that is the only measure that has legitimacy with the public. So when Parliament is going in, and when MPs are saying we are passing a law saying that we, as the state, which includes government and RBI, will bring inflation down, are giving a mandate for inflation down. If you say that to households who are saying, "Daam badh rahe hain,"
correct. Yes.
You have no legitimacy.
Yes.
So it is that which was the most important and deciding factor, and till today remains the most important and deciding.
And barring a few exceptions, that's the global trend.
Absolutely. In that we saw Thailand go to core and then go back to CPI, and at least we studied 30 countries and everybody was doing headline.
Aditi?
I'm very much at headline for the same reasons, and as you also said, there are parts of core which are very volatile and sensitive to what's happening globally. So if we start stripping off lots of stuff, we'll probably end up with a very small component left where we feel that the RBI has a greater amount of control. And again, I completely agree with the argument that for a household, the two biggest expenses that are going to drive their thinking every week and every month in terms of how they feel about their incomes, how they feel about their prosperity, is going to be food prices. And to my mind, the second most important thing is rent, particularly in the urban areas. And going back to something that Samiran was saying, this is anecdotal, I don't have any data for it, but where we find that food inflation transfers most quickly into the rest of the inflation basket in urban areas probably is through rents and lower end rents. And that's where the whole sentiment channel gets affected very quickly as well. So headline for me, at best, maybe just taking vegetables out, because vegetables have taken on a volatility that is really quite difficult to predict as well in the Indian context. So headline, or at best headline X vegetables.
Okay, thanks, Soumya. And after Soumya speaks, anybody wants to ask any question from the audience, just get the microphone ready. Soumya, over to you.
I also share the same opinion, but I have just two different points I'll make. I also take on Ila's point a little bit, which he mentioned in terms of the demand. The first thing is that if you look into the data of, say, headline CPI, core CPI, and food CPI over the last, say, 4 years or 5 years, you will find that the mean, the standard deviation measures, if you look into them, you will find that the standard deviation of core CPI and that of the headline CPI are nicely aligned, while that of the food CPI is significantly higher. So this clearly shows that the core CPI actually, core CPI has the inflationary expectations argument which the others gave, that has been nicely contained by the RBI in terms of ensuring that both both stay lower, and that impacts the headline inflation. So in my part, I think headline inflation should be always targeted in terms of if you're doing inflation targeting. But one small point which I want to mention, I think, and we have been saying this for repeatedly, is that, and I think the government is already doing it, looking into the CPI measured more holistically now. The point which Ila made, that in terms of the core inflation, which is a more mere indicator, is a more profuse indicator of demand, is correct. But if I make a comparison with countries like in UK, whereby the interest sensitive part, like for example EMI payments, are a part of the these countries like UK, is absent in a country like India. So sometimes it's difficult to measure what is the extent of demand. So I think over a point of time, there has to be an appreciation of these small methodological issues. But in my sense, I agree with the fact that headline is a better option than targeting core, simply because of the fact that food CPI, it's always important that food CPI doesn't get generalized into the core CPI through the channels we have mentioned.
Thanks. Yeah. Anybody from audience? Yeah. Can this lady get the microphone, please? Anybody from other side, just raise your hand so that you can get the microphone fast.
Hello.
Yeah. After that.
Hi, my name is Deepthi Jetwani.
Can you talk a bit louder?
Yes. The entire conversation today was if we should remove vegetables and grains from the CPI that is monitored by RBI. Now, even though the RBI doesn't have a direct control on commodity prices, the government and the RBI work together. As per Maslow's hierarchy of needs, it's roti, kapda, or makan. Both of these institutions need to work together to monitor these prices. If the RBI moves to remove, no longer monitoring the price of food, would we be removing the checks and balances from the system, giving RBI more freedom with the way they move with interest rates, and that would in turn harm the economy? Sorry for the long question, but that's all. Thanks.
I could not exactly follow what she said, but Ila, I think you understood, so please you answer.
So
Can this gentleman get the microphone? Yeah, please.
I want to respond by saying that there is a reason why central banks were given the mandate of targeting inflation. And that is that it is not that at every point of time, the government, especially an elected government, can target inflation. There are many times when actually the government either wants to do fiscal expansion or in some cases give higher MRPs to farmers, higher prices for procurement to farmers because of a particular state election, and so forth. So the reason why, if you look at the monetary policy literature, which, so going back the last 30 years, you'll find that it was political cycles which actually led to this, that it led to the understanding that, look, government cannot always target inflation, and therefore create an institute, give that mandate to the central bank to target inflation. And in some ways, that's kind of what is playing out, that yes, while the government does want lower prices and more welfare and so on, but sometimes, whether it is fiscal expansion or whether it is specific food procurement prices, where the government has its own reasons not to be, where it is unable to fulfill the role of targeting inflation. And that's why it's given to the central bank, which is given this instrument.
Thanks, Ila. Yeah, this gentleman, please.
Yeah. Good afternoon to the panel. My name is Neville. I have a question to the panel that with Trump returning to office, he is expected to influence the Fed's policy. He is supposed to be more interfering kind. So will it change the policy of the Fed, as Trump is expected to be pro-growth, low interest, and it will increase inflationary risk in the future in a way that is also expected that Fed may go less aggressive on interest rate cut? Will it in any way change RBI's rate cut policy, delay possibly?
Sabinan, your bank is US bank, so you better answer this.
Look, I don't know whether you got a chance to see midnight Jerome Powell's press conference. So this question was asked to him, and he gave a very curt response in that, saying that if Trump wants him to resign, he will not resign, because that much independence that Fed has got. So I don't think that as such the government there can put pressure on Fed to do certain things. But the second part of your question is what the Fed will have to deal with, which is its own response function to Trump's policies. So if hypothetically Trump is raising tariffs and those tariffs turn out to be more inflationary for US, then Fed does not have a choice but to respond to it. As I was saying that if this happens, then this will be a common inflationary trend across the world. So most central bankers in other countries will probably not have a choice but to respond. And this is also connected to the fact that these tariffs are likely to make dollar also stronger. So if dollar gets stronger, if other countries don't hike, then their currencies will get weaker, the point that Sachin was mentioning. So that beggar thy neighbor policy, in some sense, everyone doing the same thing, that can continue to some extent. RBI could also be caught in it. But I think the main issue to track would be that, are we going to enter a slow inflation period going back to the period of great moderation of 40 years of 2% inflation? Or are we, because of many reasons, tariff is one of them, there are many other reasons, because of which our natural inflation rate is, let's say, 100 basis points higher than what it used to be. That in itself will determine what the terminal rate of interest for Fed is going to be. That will determine how much rest of the countries will also respond.
When you was talking about you meant US, right? The 2%. That's the US target 2%. Yeah. I think it came down to 2.1 now, right? Last was 2.1. I'm just thinking.
Right now it's low, but what the Trump tariff will do to it, that's what we're predicting.
So we have exhausted our time, but just one sentence each probably this time, though. It's all of us, you said that it's not Fed, it's food. That's primarily most of you, but there are other implications also. So starting from Sachidanand and all, so when do you expect, you are the economist, you have you know better than anybody else, when do we expect Reserve Bank of India to bite the bullet? I mean, last policy, they changed the stance, and then subsequently RBI governor has been talking about changing the stance doesn't mean anything, that we are rushing to rate cut. He was talking about inflation rising, so on and so forth. But just tell us, when do you expect the cut, and in this cycle, where would the rate stand ultimately? Just one sentence each.
I would say first quarter of next calendar year.
That's February.
By then,
that's February.
Yeah. And okay.
And sorry, and where do you see the rate?
I think it is going to be very, very shallow. Like I said, there are multiple things that have changed. Being cognizant of that, it could be very, very shallow, 25 to 50 in the entire cycle.
So at best, it can go down to 6% from 6.5, first rate cut in February.
Yes.
My answer depends on if the Fed cuts. If the Fed cuts, then yes, I agree. If the Fed stops cutting and indicates it's not going to cut because of the policies,
then it will be further delayed.
It will be further delayed.
Fed next meeting is December, mid-December, after the RBI policy.
Or when it comes to February or April or whenever the policy.
Okay. Aditi?
Feb 2025 or later.
Feb cut 25 basis point.
The earliest rate cut could be in February of 2025 or later, and at max 50 basis points.
Soumya?
Before I answer, just one. Look at Fed,
Please.
follow food. So this is the mantra now. And in my sense, I think...
Look at Fed, follow food. Okay.
Yes.
Okay.
So that's...
Look at Fed, follow food.
So in my sense, I think the rate cut cycle could be a little delayed. I'm not seeing it in 24, 25 maybe by April or February, at most 25 basis points. So overall 50.
Not too different. I think Aditi phrased it well, February or later. That max 50 basis points. But our US guys, for what it's worth, they think that the December rate cut could more likely to be 50 basis point by Fed. And that will continue next year as well.
Okay, so that's the end of it. And I would pick up what Soumya said, that it's not Fed versus food. It's look at Fed and follow food, right? All of you agree with that? No. Thank you, Ila does not agree. So give them a big hand. We have come to the end of it. Thank you. Thank you all.
Thank you, panel members, for that incisive conversation. Can I request Mr. Tamal Bandyopadhyay to present our panel members with memento? Ladies and gentlemen, following this conversation, we are going to be having a very interesting conversation in and around the topic of Indian equities in the emerging market landscape. So I'd request you to please stay back in the hall for the next session. This session, on the other hand, was inundated with a lot of practical insights, starting with the aspect of that there's a debate on whether we need to bother about food inflation when it comes to monetary policy, because at the end of the day, the central bank does not have any direct control over food prices. One of the reasons food was chosen to be the part of the basket when the RBI was given the mandate of targeting inflation was because that's what the consumers relate to. When it was studied at that time, it was found that almost every one of the 30 countries that had moved to inflation targeting was looking at the CPI. So it's not about ignoring food inflation, but about recognizing the limits of central bank's control over it. I think a very interesting premise and topic to be discussing here today. Thank you so much, panel members. Ladies and gentlemen, with India's growth story, its evolving market structure, and the growing appetite for Indian companies in global portfolios, the country's equities are rapidly becoming a key focus for institutional as well as retail investors alike. As India continues to emerge as a powerhouse in the global economy, its equity markets are gaining a lot of mainstream attention, not just from domestic investors, but also from global players as well. In this fireside chat, ladies and gentlemen, we are going to deep dive into the fascinating topic of Indian equities in the emerging market landscape and actually discuss how the Indian stocks are positioned in the world of shifting economic dynamics. For this really astute conversation, we have among us Ms. Devina Mehra, Founder, Chairperson, Managing Director at First Global, and joining Ms. Mehra on stage for this fireside chat, I'd like to call on stage Mr. A.K. Bhattacharya, Editorial Director at Business Standard.
A very good evening to everyone. We have about half an hour with us, and what we have, the person we have with us today is a markets guru, if I may say, one who grew up in Lucknow, but spread her wings across the world, and runs one of the most successful PMSs apart from many other things in First Global. Welcome to Business Standard BFSI Insight Summit and agreeing to be part of this fireside conversation. You, if I may say, you are the only lady participant in a fireside conversation at this summit. So, so let me start the discussion with you on the Indian equity markets. What's your overall take? I mean, what's really happening? A lot of people say that, oh, this is a market that is in a bubble zone till recently. Then people started saying, oh, the premium is too high. US elections have happened. So can you put the Indian equity market in an overall context to start with, given the fact that it is seen as an expensive market, that there are geopolitical tensions all around, US elections have just had, you have a Fed in the US who said that the US president cannot sack me, he has cut the rates, he does not know how will the next rate cut happen. So there are uncertainties and also there are certainties. So in that context, how do you see the Indian equity markets evolving, Devina?
Thank you, Business Standard, for having me. And I must say, and congratulations on your Golden Jubilee.
Thank you.
And I must say, Business Standard has been my favorite pink paper for several decades.
Okay, thank you.
Not because I'm speaking here, but that's the truth. And I wish I was not the only woman. I mean, I've been this only woman in too many places, too many times, right from the beginning of my career when I was the only woman in the entire Citibank investment bank.
Wow.
And so it's not good that so many years later, I'm still only woman here and there. Coming back to what you who have asked me, actually my stance has not changed much over the last quarters and months. In fact, I tweeted recently that a lot of fund managers suddenly seem to have found chinks in the Indian macroeconomy, whereas the data has not changed. The data was exactly what it has been, and which I've been pointing out the chinks for a while. But having said that, coming back to the markets, you have to step back, and I'm a very data-driven person, and look at the data. And if you look at the data, we all have in our minds that the Indian market gives you in equities something like 15.5% return, because that has been the return since, let us say, Sensex started, so 40 odd years. But equities are inherently volatile. We know this in theory, but in practice, we forget. And they are not volatile just on a month-to-month or year-to-year basis. The variations are very high on even a very long-term basis. So I'll give you an example.
Sure.
I said this 15% odd, but if you look at 2010 to 20, that decade we compounded just over 8.5%. So we got only fixed deposit returns for a whole decade. And that doesn't capture the difference really. It is like in 2011, if you had put in 100 rupees, in 10 years you would have got 230 rupees.
That's right.
Whereas in 1980, if you had put in 100 rupees, in 10 years you would have got 700 rupees.
Yeah.
So this below par performance is what created the room for the bull run we have seen since the COVID lows. And we are, if you look at the large cap mainstream indices, we are still not above the trend line. So the risk of a sustained crash is when you are far above the trend line. So my stance for the last couple of quarters has been that yes, you will see a correction, but I don't see a sustained crash. And corrections always, when it's going on, it seems like the worst thing in the world. But I was looking at last 16, 18 years data. Nearly every year you've had a double-digit correction. We've still not at double digits yet.
Yeah.
So barring, I think, 2 years, almost every year you've had a double-digit correction. So that's the nature of equity markets. That's the animal. And when you have below par performance is when you get that big boost. So if you go back in history, 1994 to 2003 is the only 9-year period in Sensex history where the net returns were zero. 9 years. And 2003 to 7, then the market went up 6 times. As part of an overall emerging market move, emerging market index itself.
Where all boats were climbing.
Yes, so I mean so you in equity markets you have to be patient, but when things are a little uncertain, it doesn't make sense to get out of the market. All of us understand the risk of being invested, that you can lose some money, but there's also a risk to not being invested. So you have to manage with risk controls, but being out of the market also has its risk. So this again, over 40 years, if you look at, if you miss out on 10 best days, you would say 40 years, 10 days, how much would it matter? But it takes away 2/3 of your returns, 2/3.
That's right.
And if you miss out on 30 best days, this is 10 best days, so if you miss out on 30 best days, which is less than a day a year, you miss out on 90% of the returns.
Okay.
So if your 100 rupees had become 80,000, now it will be below 8,000. That's the kind of difference. So that's why, and most of these sharp up move days come when there is uncertainty, when there is fear. They don't come in the middle of a bull run. The only ever time they came in the middle of a bull run was the Harshad Mehta Teji, because that was a rigged market. In a normal market, it hasn't happened even once that you get these sharp up moves. But having said all of that, one other thing which I have been warning about is that there are enough areas in the market where there is froth. So those are areas you have to be careful. So whether it is the IPO frenzy where everybody is thinking it's a lottery, I just buy and I flip out. I mean, the STEBI data showed that more than majority of the people just flip out within a week of listing. And then there is like small cap, micro cap. Not that all small cap and micro caps are bad, but when this kind of mad run comes, the good, bad, and the ugly, everything goes up. And people forget, and I said, don't forget this, that of all the companies that have ever been listed in India, more than half have gone to zero. They no longer trade. I mean, there are only 4,000 odd companies that trade in the markets. In the 90s, there were years when there were 1,200 listings and 1,300 listings. So they have all disappeared into the wild blue yonder.
Okay.
So we have, like in our PMS, for instance, we've remained invested, but we have got out of a lot of these frothy areas. And even though we knew in the short term it would hurt performance, we've reduced anything below 5,000 crore market cap. Normally we used to have 14-15% of our PMSs there. We went down to 5-6%. So yes, sure, in the short term it hurts you. But we always manage for risk first, because investing is a loser's game.
Okay.
So those of you who have never read this, just Google The Loser's Game. It's a 1970s article by Charles Ellis. It's a mind-opening article that everything in the world is a winner's game or a loser's game, and how you play the game depends on what kind of game it is. And investing is now a loser's game. So the first objective is not to lose. Not to lose big money. I mean, you will always lose. Equity is a risk asset, so be prepared for some losses, but don't lose big money.
Okay, this is a new message that you are getting, I mean, I don't want to name them, but we had another panel on markets participants, and we got the impression that equities need not necessarily be a loser's game. Now you are bringing in a new perspective, but along with that you are also bringing in this new index of sort, which is a sustainability index. Now from a sustainability point of view, how do you see the Indian market in terms of how far is it towards the top of the unsustainability, or how closer is it to the sustainability? Where do you see it from a sustainability point of view, and what are the factors that contribute to the sustainability and which detract from the sustainability? Could you like to?
Yeah, so one thing, of course, as I said, if you look at in context of the historical returns, we are not very far ahead. If you look at people like to look at PE. PE is a very crude measure. And I don't like to look at market PE, but if you look at sector-wise PE, because see, the composition of the indices have changed so much. People don't realize that. There was a time there was no financial stock or bank in the Sensex, and now that's the largest weight. Or there was a time when there were so many PSUs in the Sensex and Nifty. There was, ONGC, BPCL, HPCL, IOC, BHEL, VSNL, MTNL. Then there was a time people forgot that PSUs existed. So, but if you look at sectorally, yes, we are not at very low ends of the PE, but we are not at the extreme end either. So that's one part of it. And India has always been an expensive market. I mean, you mentioned at the beginning in the opening remarks, yes, India has always been an expensive market. But I don't think we are in really dangerous category, provided you choose carefully. I mean, there have been, as I said, enough areas where there's been froth. I mean, I always say it's, and only half flippantly, that the rule of thumb to identify which are the frothy areas in the market is look at where the thematic funds and schemes are being launched. It is almost always the peak of that theme. I mean, people, the layperson thinks that all these funds are launching, whatever it is, defense, PSU, industrial, that means they see great potential in this. No, they say great potential of gathering assets. That is all.
That's right.
And normally you launch that fund because it, by the time the retail guy has heard of it, most of that cycle is past. But then that guy has FOMO, that my friend has made money in this, so I must get onto this bandwagon, so it's easy to gather assets. I mean, to my mind, it is a type of mis-selling. I always think that you must always think of whether the investor is going to make money, not what is going to make fees for you. I'm like against that kind of thinking, but that is what drives most of these thematic fund launches.
Okay.
So, and that's, as I said, a good thumb rule to decide where there is froth.
Yeah, but, before we end the external sector scenario building, one question, you talked about the US. Maybe you can speak a little more on the US and its influence on the Indian markets. And can you also let us into this thing of the China factor? How much of a China factor is important and as investors should be wary about? People keep talking about, oh, China mein stimulus ho gaya, paisa bahar chala gaya. How do you look at both the US and China through different prisms or the same prism? Can you let us in into that?
First of all, for the Indian market, if I look at, I mean, this is a question I get asked all the time in TV interviews, that where do you think or how much do you think the FII flows will be, the foreign portfolio investor flows will be? And my question is always that, have you looked at the data whether there is any correlation, let alone causation, whether there's any correlation between the FII flows and what happens to Indian markets? And I've seen it from the beginning. In fact, the reason why I started this business exactly 31 years ago was
congratulations.
Thank you. So October is when I completed 31 years, and the one main reason was Dr. Manmohan Singh's budget, which opened the market to foreign portfolio investors.
Okay.
That was the immediate trigger. And I said, now the market will professionalize, because before that, professional research did not exist as a discipline in India. But
and you were in Lucknow at that time?
No, I was here. I was working for Citibank.
Okay.
So from Lucknow, I went to IIM Ahmedabad. Then I came to Citi. I said, I was in Citi. I joined Citi Investment Bank, and then I was in the corporate bank at the time. And so, but the point being, at that time, one did monitor FII flows coming in. And at that time, this was a new slew of money. It did not exist earlier.
That's right.
Domestic mutual funds practically did not exist. Retail participation was far lower. So what would you have said? That this new billions of dollars are coming in, it will just take the market to God knows what heights. But what really happened? I just told you, 1994, which is
2003.
There was no return.
No
the
return.
market had already gone up before the
So
FII.
here's a warning for you guys.
So I no longer monitor FII flows from the market point of view. Of course, they have an implication for the balance of payment and external account. That's different. But I always say, I remember this school teacher of mine, I'm a maths teacher, and I always, she just passed away last month, and I always, whenever anybody praised me later in life, I would always send a silent thanks to her. And she always used to say that every step you must see that whether this step implies the next step.
Okay.
And here you are making an assumption that, yes, of course, if FII money comes in, market will go up, but have you even checked whether that happens? It doesn't happen. So there is no correlation between, and so this time, of course, last month it was coincidental that, yes, FIIs took out money. And so, I mean, the explanations are, I would say, always made up in a sense.
Okay.
I was reading this book, very well-known book called Business Adventures. And both Bill Gates and Warren Buffett have talked often as one of the best books ever. Now, this talks about a series of various business stories, essentially, in the US from 1930s to 1960s, and the pattern really repeats. So you will see, someday when the market has suddenly crashed, there are very good explanations as to why this happened. Next day the market zooms up, there are equally good explanations as to why that happened. So equity markets, you have to take the long view. And always, you have a good equity allocation, but no man, this time, sometimes people ask me that I'm young and I have a good job, so should I put 100% in equity? No, you should never put 100% in equities either, because, you might lose your job, you might want to study further, you might have an emergency, you want to put a down payment on a house. Basically, there can be unexpected outflows. So don't put 100% in equity, but whatever is your equity allocation, don't change it too often. There are only some outlier times when you see that there is an imminent crash. And this is we are on record on Twitter on March 2, 2020, saying this time something strange is happening and we are going totally risk averse.
Yeah.
So we went, whatever, we bought hedges, we went into cash, both in India PMS as well as our global funds. And in that COVID crash, when everybody lost 30 to 40%, we lost only 8 to 10%. But in 3 weeks, we also made a call saying time to be back in after that vertical fall.
So China and US, how big are a factor?
So that's why I'm saying, so, why are you trying to gauge that? Because you're trying to estimate how much will be the foreign portfolio investing flow. So that was why, in that context, I had given this answer. China factor, I think where it will be important is what happens to the Chinese economy is important for commodity demand and prices.
Okay.
So I would, rather than the markets, I think that's the more relevant thing, because the construction in China has been the big driver of so many things, including steel demand, for instance, for decades. And they have a structural issue now because the population is shrinking. So it is not as if that stimulus, say, if those many housing units are not required, then how will that help? Chinese market, again, is a different thing. Now, China is, again, a very good example of a disconnect between the macroeconomics and the markets. Now, Chinese market made a high in 2007. Since then, the Chinese GDP has roughly gone 7 times, and the market has still not reached that high.
Yeah.
So the disconnect can be as stark as that. And it is not India versus China, because remember, China is a very large component, the largest component of the emerging market index. So if China goes up, actually the emerging markets begin to look more attractive. And again, you can just as well give the logic that because of that, more money will come into emerging markets and come to India. So as I said, whatever happens, you can find a very good explanation. There's a book called Everything is Obvious Once You Know the Answer. So that's...
So are you saying that the bull run for India is over? A lot of people say that a bull run normally runs for 5 years, and India has run a bull run for quite some time, more than 5 years now. So are we seeing an end to the bull run, or how do you see the bull run sort of shaping itself in the coming
I'd like to answer in 2 stages. One is the time frame you have. As I said, it can be that I'm not saying the market will not go down from here. Obviously, it can go down.
Yeah.
But for the large cap or mainstream stocks, I do not see it as a sustained crash. So, 1-2 year basis, I'm still positive.
Okay.
However, a lot of the stocks that have done well, which is particularly, as I said, the frothy areas, the small cap, micro cap, many of those stocks never come back. Even now, while the market was not down in double digits, there was a long list of stocks circulating on social media which were down 30, 40, 50%, even more. So, and I also, there's this data like 2008-9, if you look at the small cap index, it fell almost 80%, 78% to be exact. And then it took 8 years to come to that level. But that's also theoretical that it took 8 years. That index changes 18-20% every year. So in 8 years, it's a completely different index. So those stocks that fell actually never came back. Then 2016 to 18 was another mad bull run in small caps.
Okay.
It fell another 2/3 after that. And I said, don't forget your school mathematics that if something falls 2/3, it triples, you're still at zero. So all the small cap managers who until recently were saying, I have given 50% return and 60% return in 3 years, if you go back 5-6 years, the picture looks very different because they lost 90% of the client's money. I said, if you're down 80%, then you compound 50% for 3 years, you're still down 25-30% from the top. So, people don't do the math, they don't think about what is, and as I said, those stocks, you cannot manage the risk.
That's right.
Because the stop losses don't work. When they fall like a stone. And you cannot hedge. Like for example, if we have some uncertainty, we hedge our PMS portfolio. But the only liquid hedge is a Nifty put, which Nifty doesn't move along with these small caps.
Okay.
So be very careful on that side because there are no exits when those stocks fall.
Okay, the message is that you have to be careful.
Yes.
At this point, it probably is the right time to enter into your take on the IPOs market. India's IPOs market is booming. There's issues after issue, and yet when they are listing, many of them are causing some disappointment. What is your take on IPOs, and how do you think investors should negotiate this IPO surge?
So, this IPOs, when they are in fashion when there is an IPO frenzy, it is very difficult to do anything sensible there, because if any business is good and is priced sensibly, you are unlikely to get any allotment at all. And as I said, people were not even making a call on whether they are investing in a company. You think this is a lottery process of some sort. And the SEBI data showed that majority of the individuals, not the funds, but the individuals flip out within a week.
Yeah.
So that's always dangerous territory. And so we don't even look at that. And always remember that IPOs are how coveted an IPO is, how much oversubscription there is not a good indication of what the future of that company is. You know, DLF was a very coveted
classic example.
And never came back to that level. Reliance Power, another classic example.
Which brought about the...
Yeah, exactly. So, that was like everybody wanted in. So, and on the other hand, recently in another, was watching a podcast and somebody was talking about, parents and grandparents investing, and he said maybe somebody's parent was lucky enough to get an allotment in the Infosys IPO. So I told that journalist that, do you know that the Infosys IPO was undersubscribed? Right. It devolved on the underwriters. And it was eventually those underwriters which made a lot of money. And I'm being prominent among them. Yeah. So that was an undersubscribed IPO. So nobody was lucky enough to get allotment. So that whenever there is a frenzy in something, it is very difficult to get anything sensible there, because IPO they would be sensibly priced good IPOs, but then you are unlikely to get a allotment there.
That's right. Which brings me to the question of regulation. Is there something that you find not up to the mark or catching up with what is really happening, whether in the IPO market or in the overall capital market? What is your take on the level of regulation, and are we somewhere where it is an ideal position, or is there something that the gap remains? Could you let us into your assessment of the regulation?
I think the regulator is doing a fine job. I don't see a gap there, and they have even been warning where they see things going wrong. And of course, they're now changing in the F&O market, which I think, of course, required a change. If you look at the derivatives
tough
market.
Steps, tough steps have been
But
taken.
I think those were required, because if you look at the data, not only is it that 93% of the people lose, but if you look at who are the 93% and who are the 7%, the 7% is the big money. It is the foreign portfolio investors. It is what they call, basically proprietors, which means, again, large players. And the people losing are the individuals. And within individuals also, if you see, the younger people lose more, the less educated lose more, the people with incomes below 5 lakhs, which is less than 40,000 a month, just about 40,000 a month, lose more. So it is all the unsophisticated people who are losing, and the sophisticated investors are making money in the FNA. That's in short the SEBI data. If you parse it out, that is what it is. So that's, so the SEBI is, I think, doing what it can. People also have to have some sense. If you look at that, a lovely book of John Kenneth Galbraith on a short history of financial euphoria, and he says that every time a bubble bursts, you look for villains and you want to hang the villains, whatever it is, the broker or banker or whatever, depending on the nature of the financial bubble. But he said the people who are not blamed and probably should be blamed are also the common speculator, because you were greedy, you wanted this quick money. In this whole boom, I had people coming to me and saying, why are you being so conservative? Why do you manage for risk first? I want to be aggressive. I want to take high risk. I said, with high risk, only thing that is certain is high losses, high returns are not certain. Don't think that high risk means you'll get high returns.
So you are a very conservative investor.
Always risk management first. That's why I said investing is a loser's game. You win if you don't lose. So first, you will lose, you will have some interim losses, but you should not have big losses on your capital which cripple you.
Okay, before we invite some questions from the floor, let me ask you this question. It's a personal question. You run a PMS, which I understand depends a lot, hell of a lot, on artificial intelligence. Now, it raises many questions. One, the role of technology, imminent role of technology, you cannot stop that. And yet, what would be the future like with such rapid spread of artificial intelligence, even in managing PMS. What is your perspective, and why do you do it, and what do you think is the direction going forward?
Okay, so we use AI and machine learning not because it is available or it is fashionable. It is because what is required in the market has changed. The analogy I give is that you all know India's national game is hockey. So why is it hockey if we haven't, we have only started getting bronze medals after 40 years. So why is it hockey? It is hockey because from 1928 to the 70s, India and later on India and Pakistan dominated hockey. Dominated to the extent there were 2 Olympics where India did not cede a single goal all through.
That's
from
right.
the beginning till the end. So what changed in the 1970s? Hero se zero kaise ban gaye? So, what happened was that the playing field changed literally. From grass you went to AstroTurf, the skill set required change. So this superb stick work of Major Dhyan Chand didn't work anymore. What worked was you had to be very fit, very fast, which Indians were not that good at. So similar thing has happened in investing.
And the rules of the game itself.
Right.
The penalty corner goes,
right.
everything
And the same thing
changed.
has happened in tennis also.
Tennis also, yeah.
So I mean, in the interest of time, I will not give that example. But so if you look at investing, for example, something fundamental has changed there too. 25 years ago, the edge was an information edge. You go and meet companies, you get some differential information, and I love doing that. I was just, I met somebody from a steel company this morning, a client, and I was telling him that, I have seen your plant, I have seen half a dozen other steel companies' plants. I have gone to Renukut to see, Hindalco's aluminum plant. I have taken overnight trains to see cement plants, and I loved all of that. But now the rules have changed, the game has changed. Now information arbitrage is not the thing. 1990s, let alone smaller companies, a Tata company, a Tata Steel or a Tata Motors, you write a negative report, they won't call you for the next quarterly meet. But now by law, all data is there on the website. All of you can access it. So now the data is available, the brightest people are in the market. So what is the edge? The edge is who can analyze this masses of data well, without bias, without noise, because human judgment brings noise and the bias. So if you read Daniel Kahneman, he clearly says in any business of judgment, system will always outperform human being, even in things like judicial decisions. So that being the case, that's what we're trying to do. But see, a lot of people just use the word AI. I say, like, sometimes people ask me, do quant methods work? I said, if I ask you, are financial models made in Excel good or bad? You'd say it's an absurd question. Excel is just a tool. It depends on what you put in there. And I said, AI, ML are also tools. It depends on what you do with it. And we use an extremely rigorous system, but we do not use a black box system. So anything the ranking goes up or down, we can always drill down and see what factors have changed, what is driving this. And you need the market expertise besides the tech expertise.
And you think this will spread fast?
See, spread will be all kinds of quality. Quality is the question. Even when I was doing human research, this is very few people really have, Ashokji, go into the depth, want to really understand what's going on. That's my driving force. My driving force is learning. That I must understand, I must learn. So that AI ML ka label many people will put, but just as an Excel sheet, what are you putting in there? How much thought is going there? How much rigor is going there? I mean, we've been using this human plus machine moniker for a while, and I saw 2 funds or schemes being launched with man plus machine. Ek to human ko man kar diya, a man with machine. I said, you can't think of
that itself is problematic.
I said, 3-word title you can't think of. Then you're going to do that rigor of my quant team is extremely rigorous on every step. So, that's even data cleaning takes up 60-70% of the work. But the point is that because you're still using 1990s methods is why a lot of the fund managers do not outperform.
And regulation is all right. Regulatory clarity is not there.
I don't think there's a problem.
There's not a problem. If there are any questions, please identify yourself and please ask a question.
Good evening, Ms. Mehra. Good evening, Mr. Bhattacharya. My name is Siddharth. Lovely session. Thank you very much. My question has to do with international equity markets opening up to retail investors here in India. Right now, you can invest in American stocks, Hang Seng stocks, etc. Right? And sometimes when I think through this, I'm like the MAFANG companies, for example, they're sort of owning the mantle on cloud deployment, AI, and it looks like they have a good job good prospects as far as the future is concerned. What would be your rule of thumb of sorts when a retail investor such as myself has to make a decision on, okay, time to look beyond the Indian equity markets now? What would be some of those rule of thumbs now that the other markets are so much more accessible to the retail investor?
Rule of thumb.
Rule of thumb is difficult to give, but one thing I would say, definitely do look at global investing. When I started my career, the dollar was 12 rupees. There's been an 85% depreciation in the course of less than a career. So any long-term financial planning you cannot do without looking at global investing. But global is not just the US, it is not just the 5 stocks that you know. And because this is a cause for me, because I think Indians do not look globally, and because we have been global for 25 years, and we were not just the first Indian, we were the first Asian firm to go global. We have a product that invests in all geographies, all asset classes, that actually starts at $10,000, that's 8.5 lakh rupees. Normally, you would not get access to that kind of product for less than $1 million. So that's like my contribution to this, because asset allocation changes, geographies change. I just told you that 2003 to 7, emerging markets went up 4 times. During that time, US was an absolute laggard. Now, 12, 13 years, US has done very well, but that will not last forever. Last 10 years, I was looking at that if you had put $100 in emerging markets, it would have become 150. In the developed market, it became 260. So that's been the gap. So sometime again, that cycle will turn.
That's right.
So you can't get locked in, and I'm repeating, US is not the world. So
That's right. Very good point. US is not the world.
Yeah.
Hello, ma'am.
Yeah,
My name is
go ahead.
Bhavik. And I have a question. You spoke about how to identify fraud sectors, and you gave a lot of good insights. My question is, what are the 2 top attractive sectors for you at this valuation where we stand at?
See, we do a base 0 reallocation every quarter, because we don't say that we know for 5 years what's going to do well. As of now, where we are overweight, health and pharma, auto components, IT, and lately we have added in chemicals and FMCG. A sector that we were overweight for 3 years, we are for the first time underweight, which is capital goods, industrial machinery. So we entered far before the human fund managers did, which mostly they entered in 2023. We entered in October 21, but now for the first time we are underweight there. So broadly, that's where our PMS is currently.
Okay. Thank you. I think we cannot, already Ridhima is standing there looking at me. So, but I cannot let you go without asking these 2 quick questions and very short answers.
Right.
The gentleman there asked you about what are the sectors you must look at.
Right.
Can I ask you, what are the sectors that you must avoid?
I told you that we, for the first, I mean, I'm not saying avoid, but we are underweight capital goods, industrial machinery. We are almost always underweight banks and finance. I am always, somebody told me, Madam, aapka to takiya kalam hai, that I am a nervous investor in banks and lenders.
And my second question is, any domestic issue that bothers you?
As far as the economy is concerned, many.
Many.
Okay. Yeah.
Okay.
Starting with whether we will lose out on our demographic dividend because we cannot find jobs for our people. And ultimately that drives a lot of other things like consumption and so on.
That probably also explains your overall conservative approach to the stock market. Thank you very much for being so candid and so careful. And please give her a big hand. And you don't get market experts to be so frank and yet express their views.
I mean, many times people tell me that you are so honest, and I say it never occurs to me to say anything other than what I really think.
Yeah.
You know?
Thank you. Give it back to Ridhima. Yeah.
All right. Thank you so much. Can we give a huge round of applause for Ms. Mehra? And can I request Mr. A.K. Bhattacharya to present Ms. Mehra with a memento? All right, ladies and gentlemen, while we got some sound advice on investing, I think my big takeaway is getting the book Winning the Loser's Game by Charles Ellis. And I really like the phrase that ma'am used, that you will always lose some in equities, but don't lose big money. And don't put 100% in equities. You need a cushion for unexpected expenses like job loss or down payments. Set your equity allocation, but don't change it too often. And another interesting phrase that she used was, any business of judgment, system will outperform the human being. The next phraseology which really resonated with me is the fact that she said, US is not the world. And always do risk management first. That's why investing is a loser's game. You win if you don't lose. So first you will lose. You will have some interim losses, but you should not have big losses on your capital. I think very pertinent, very applicable. At this point, I'd like to remind all of you that in a few moments from now, our finale session is going to unfold on this very stage. And this finale session is actually in the form of a fireside chat with Mr. K.V. Kamath and Mr. Tamal Bandyopadhyay. So I would request all the audiences to please stay back in this room. You cannot afford to lose this conversation and not witness this conversation, which is going to be filled with candor and a lot of insights. Mr. K.V. Kamath, I don't think so, needs any introduction, considering he's a legend in the space of not just BFSI, but entire finance sector. Also known as a prolific CEO guru who has given a lot of, I would say, impeccable CXOs to the financial sectors. So I'd request you all to please get settled down so that we can have a seamless start to our finale session here at the 3rd edition of India's biggest BFSI summit called the Business Standard BFSI Insight Summit 2024. I request you all to please settle down, and can we give it up for Mr. K.V. Kamath, who makes his way. Ladies and gentlemen, at this point, we have arrived at the culmination of our journey, and we are very honored to be joined today by a leader who has not only shaped the landscape of Indian banking, but has also been an epic trailblazer in driving India's financial ecosystem towards greater inclusion and innovation. He's led a distinguished career spanning more than 5 decades, and has been steering some of India's largest financial institutions through periods of significant transformation. He's had been at the helm of key institutions like ICICI Bank, where he served as the managing director and later as the chairman, and under his leadership, ICICI metamorphosed into one of the most prominent banks in the country, pioneering numerous innovations in the Indian banking sector, including retail banking and financial inclusion. His visionary approach played a key role in making it a global brand recognized for its digital-first mindset and robust growth strategy. But most importantly, he's always touted as a prolific CEO, guru, mentor, who has not created a bevy of followers, but might I say, he's created a whole generation of leaders for the financial sector. Ladies and gentlemen, can we give the biggest round of applause for Mr. K.V. Kamath, the non-executive chairman of Jio Financial Services. And Mr. Kamath, can I request you to please join us on stage on the dais? Thank you so much, sir. At this juncture, can I invite on stage Mr. Shailesh Dobhal, editor of Business Standard, for introductory remarks.
Thank you, Ridhima. Good evening once again, everyone. On behalf of Business Standard, a very warm welcome to Mr. K.V. Kamath, the non-executive chairman of Jio Financial Services, on this 3rd and closing day of the Business Standard BFSI Insight Summit. Mrs. Kamath doesn't, need an introduction to such an audience, but nonetheless, I'll do it. Mr. Kamath is a mechanical engineer and has completed his post-graduation in business administration from the Indian Institute of Management, Ahmedabad. He started his career in finance in 1971 at ICICI. It was not the bank that point of time. In 1988, he moved to the Asian Development Bank and spent several years in Southeast Asia before returning to ICICI as its managing director and CEO in 1996. And post its merger into ICICI Bank was a managing director and CEO of the ICICI Bank. Under his leadership, ICICI Bank transformed itself into a diversified, technology-driven financial services group across banking, insurance, and asset management in India and in a global presence. He retired as managing director and CEO in 2009 and continued as chairman of ICICI Bank till 2015. In 2015, he was appointed as the first president of the new development bank set up by the BRICS countries, from where he retired in 2020. He also served as the chairman of Infosys until recently, till last month, he was also the chairman of NAFED from its inception. Mr. Kamath was awarded the Padam Bhushan, one of India's highest civilian honors, in 2008. Many thanks, Mr. Kamath, for agreeing to be with us on this ultimate day of BS Insight Summit. May I now invite my colleague Tamal Bandyopadhyay, consulting editor of Business Standard, to please come up on stage and start the fireside chat with Mr. Kamath. Over to you, Tamal. Thank you so much.
So, last day, last show, Kundapur Bhaman Kamath. 1996 you took over. I know you for quite long, sir, so, but it's not a stage for personal story. So I will quickly get on to my business. You are the BRICS Bank chairman, and a lot of things are happening. I'm not talking about US elections, I'm talking about China was a part of BRICS as we speak, that in media now, the news flowing that the huge stimulus package second time and all. And everybody in India, apart from US, the second thing, particularly from the market point of view, discussion is about China. So tell me, you have the experience because you headed BRICS Bank. So tell us at this point of time, what's happening in the US and China, or what's the kind of impact you think on Indian economy?
Thank you, Tamal. I can give my perspective on what I think is happening in China. I have not been to China for the last 4 years. My own assessment is that their growth, accelerated growth period, where they transformed themselves, was from the year 2000 to 2015. And thereafter, it's natural that growth slowed down. So I would guess that what they're now trying to do is to stabilize growth at a new peg, as it were, from a double digit to maybe they're looking at a 5% or so. And if they anticipate that growth would be below that level, I think they're trying to support it. And that's what we would see in the stimulus that they have just given. Because to all intent, with an 18 trillion economy, even if you grow at 5%, that's a large addition to growth. So they are on their path, and they run it differently from what we do. They have been on a very low interest base for a very long period of time. So deposit rates are around 2.5%, lending rates 4.5%. So they have their arithmetic, as it were, to grow. And I would think that they will grow at 4.5%, 5% without too much trouble. The US is new president, and we'll have to wait and watch what is the policy change. The markets in the US have given it a cheer. So let's see what follows.
Mr. Kamath, as Shailesh said, till recently you were the chairman of NAFED, is the India's first, I would not put first because IDFC was a earlier experiment, 1997 budget spoke about that, but NAFED is the newest animal for infrastructure financing, and you saw it from very close quarters since its inception. I think 2021 Nirmala Sitharaman budget spoke about NAFED, that's how we got in. Raj Kiran is heading as an MD and all. So tell us that this infrastructure financing, what's happening there? I mean, we don't, banks would continue to do, or you need an institution like NAFED and others, they can take care of that. What's the demand supply gap? Because bulk of the NPAs that happened in the last decade, 2014-15, which Raghuram Rajan started cleaning up with the asset quality review, AQR, was banks' exposure to infrastructure.
Yeah, no, let me put that in context. It was actually, if you look at, there were three pioneer institutions going back 75 years, and that is IDBI, IFC, and ICICI. And we had to metamorphose into a bank because at that point in time, our access to funding was blocked. So we had no access to funding. So we became a bank.
Initially, you had that soft loan kind of government.
It's not a soft loan. It was a government guaranteed.
Yes.
You could issue a government guaranteed bond, which was eligible as an SLR security.
Yes.
So banks would put money into us. So basically, it was the appraising expertise of these three institutions which was put forth. But then you had a situation of newer banks being experimented, infrastructure banks being experimented with. But those again came about at a time when funding was not available. Cut to today, infrastructure is going to be the key driver of our economy for quite some years. And you have a situation where banks, commercial banks, are lending 10 and 15-year money for infrastructure, where their own liability profile is 1 year. So you take 1 year money and try to wrap it as 15-year money, somebody is going to hurt sometime. And then you reprice it every 3 months. So you had a very unstable
asset liability mismatches.
So from that point of view, the government's idea of setting up NAPFID was absolutely timely and absolutely correct. The one major change has happened between 96 and now is you have got a robust insurance and pension fund industry, which has needs for long-term deployment of cash. So there's a capital market process through which this can be borrowed, and that's what NAPFID would do. I would think that NAPFID will grow in scale, and there will be more such banks coming up to lend, because I think banks are not the optimal choice for long-term lending of 10 and 15 years for infrastructure. They can take shorter maturities, but the longer maturities would probably left to what I call the market process.
Mr. Kamath, the last 3 days we have been talking about whether it's Reserve Bank of India governor or chief economic advisor, government of India, whether the banks, the other side of banks' balance sheet, the left side, we're talking about the deposits, the so-called, credit deposit ratio, pretty high, RBI is concerned and all. And the related part is this, the growing financialization, like the savers are actually turning investors. So you have seen, not too many people have seen the banking industry and overall Indian economy, financial sector as closely as you through different roles. So what happening? You are seeing a structural shift in the entire financial architecture?
Yeah, I think it's a slow shift, and there are a few more elements to it. Please. One is technology. So you have technology, greater access, and a better understanding of what opportunities are there. I think this is what is making this financialization of savings. And Tamal, that had to happen because a saver would like to have a better, higher rate of interest or a higher earning on his financial assets than what is at present. And earlier on, that opportunity was not there because that saver, I'm talking of, let us say, below the affluent category, the mass affluent category, would find it difficult to actually access these products. With technology, access to these products has become simple. And with SIP, it became even simpler. And now if SIP size, the amounts on the SIP are brought down even further, you will see a further boost. And add to that something like MF Central, which anybody who can use a WhatsApp basically will be able to see what has happened to his investments periodically. Otherwise, he would have had no ability to look up what exactly is happening to his investments. So it stayed in a bank. So I think the financialization of savings has been propelled by technology, development on technology. However, That's only one side of it. You were asking, is there a shift in deployment? We should also, I think, reckon what the Reserve Bank governor in particular has been talking about the risks in terms of operating in markets in a way that you ought not to be. That is, you have lay people getting into the F&O side. And on one side, you had the SEBI chairperson say that that's 90% of the people have lost money. And the back of the envelope calculation will show you that that amount is more than 150,000 crores, 1.5 lakh crores, maybe probably 1.7 lakhs if you gross it up properly.
In the F&O, the losses individuals suffered.
Yeah, and there are X number of parties who had the skills to operate in this market who have made the money. But so who are the people who have lost it and where did that money come from? That has come from the unsecured loan market. And that is why I think the Reserve Bank of India is right to caution on unsecured lending and end use of money that is borrowed from providers of funding. Because if you then loosely use it, it is going to not come back to you. And that's the situation just now. Because you have monies which have been put into or lost in the F&O market. So financialization is good, but I would think rash activities are not good. And that is what the red flag is being raised by both regulators.
So you are one of them who believe that money is getting to the stock market, all this personal loan, unsecured loan, etc. Because RBI, I asked the same question to RBI governor, and he said that Reserve Bank of India had undertaken a study, but the sample size is not that big, and he did not want to reveal much. But he said that RBI is keeping a close tab. It has done a study, something. But you are seeing that it's happening actually, money leaving the banking system and getting into the markets through this unsecured personal loans?
Tamal, let me ask a question. If hypothetical question, if people are borrowing at 20-25% and the lender says that my NIM is 10%, which means that the lender is prepared to lose that money. And tell me which business or which activity that I as a lay consumer can do which will allow me to cover a 20-25% funding cost and then make money and then repay it. I can't think of something as a banker. So given to me, this is primarily going into some sort of speculative activity or some sort of consumption which it would be for me a little difficult to understand that you will borrow at 25-30% and consume. So it is going to some activity which ought not to have been. So while anecdotally you do not know where it has been burnt, but the fact that you have looked at and the number, this number that I mentioned, 1.5 lakh crores, is what I got my colleagues to run. They ran the numbers and that's the number that they came up with. So at least that amount of money has been burnt, as it were.
At least 1.5 lakh crore, 1.5 trillion people have lost money in stock market, and bulk of it has come to them
unsecured,
in the form of personal loan, unsecured personal loan, or the entire money.
I would think entire money.
Entire money, 1.5 or 1.7 trillion, you are saying, lost in the market has come through this route. So Reserve Bank of India actually has done the right thing by raising that.
Absolutely right. Absolutely right in raising a cautionary flag 6 months back on unsecured lending, 25 bips hike in risk weightage, and cautioning the lenders. And cautioning the lenders to to determine what is the end use before you lend. So this, I think the Reserve Bank has put very clearly, and I would commend the Reserve Bank for doing this, because this is just about time that we get control of this.
And how do you see Reserve Bank of India's latest action? Because you are praising RBI, which not too many are this thing that about RBI's clamp down on personal loan, unsecured loan. What about RBI's clamp down on NBFCs? That 4 NBFCs
I would think
cease and desist order.
It is in the same order, I mean the same vein. Because if the Reserve Bank doesn't do it now in an environment which is changing, because here again there is technology at play. There are several things at play, and the regulator is taking action, understanding what is happening with use of technology, with the laxity in certain processes, and the consequences of that, which could be very difficult for a regulator to then, in a way, address. They are taking, I would say, proactive action.
Taking this conversation forward, Mr. Kamath, do you see crisis is a very strong word, but what's your comfort level as far as the NBFC sector is concerned? Because we are hearing contradictory thing that most of them are good, only few rotten apple are there. That's one point of view, and RBI has overreacted. Another point of view, no, actually some problem is brewing in the NBFC sector, and which RBI has been talking about, the push factor. The loans are not giving to the deserving people. Actually, they are flooded with money. Banks are giving money to NBFCs, and NBFCs are flooding money. They are encouraging over leveraging, and there are people who have taken 6, 7, 8, 10 loans, credit bureau, etc. exist, but doesn't make much of sense. It's a kind of mess. So what do you see in the NBFC sector?
Let me put that in context, and we can then say, action, as I said, I believe what action has been taken is absolutely warranted. I asked one of the credit scoring companies about 6 months back or 7 months back, a casual question. The CEO was with me. I said, at what score are fintechs lending? The score indicators was 550. 550, whereas a typical banker would say 750, maybe 700. So he saw the shock on my face, and he said, each borrower has 5 loans. And he didn't stop there, and he says they're still looking for more loans. So to a banker, what does this mean? That the borrower took the first loan, he couldn't repay it, he took a second loan to meet maybe interest payments, he took a third loan to repay installment, he's taking a fourth loan to do something else. So this is a pyramid that is being built. And just about then was when Reserve Bank, I heard, Reserve Bank said, raise the risk weightage and put out a cautionary flag. So they were right in time when they would have also heard from the market that this is what is happening and their own sources. Now don't ask me where is this debt sitting. The good news is, this could be there somewhere across the system. The good news is, I think the banks are at this point in time healthier than ever. So if you look at this last quarter's numbers, if you look at the top 4 banks, I think the ROEs are between 16, 17% to 20%, almost 20%. Unheard of. I have not seen ROEs of 20% in banking. So banks are running a very healthy book. So I don't think there is any systemic worry that I would have at all. But systemic caution that the Reserve Bank has expressed is entirely warranted.
So the mischief is being played by the loan apps. They are the primary mischief makers, you are saying?
Yeah. So I would think that I would use a word, and I would use it very with responsibility. You can abuse technology. So I think there is some sort of abuse of technology that is happening, and as a result of which, there is laxity in the whole process of lending.
Okay. Mr. Kamath, that's taking forward what we started talking about, the financialization, savers turning investors, banks are not getting deposits, because I am aware of certain people who used to keep good money in savings bank account. Now they're shifting it to arbitrage funds. They're saying that no, the tax advantages there and liquidity is as good as almost this thing. So in this kind of scenario, do we see a structural shift like the developed markets happening that like is the developed market scenario, whether corporates will have to borrow money from the market, banking is not the only source. Is it the kind of thing you are seeing?
Tamal, that is already happening. See, we have a robust capital market today, and companies are starting to access funds. Now, we may say, where will the differentiation bifurcation happen? As I see, long-term capital needs of a corporate, if they cannot be met by their own cash accruals, and increasingly most corporates can meet it by cash accruals, they will then access the market to raise a bond. That would be the most efficient way to do it, of the right maturity, so that they don't carry a mismatch. So I see that happening in a big way. The second thing that we need to reckon is the outcomes of creating InvITs and REITs, so that what otherwise was being funded by the banking system, today somebody would have borrowed, but the next round, it is now coming through the InvIT process and through a capital market process, where the capital market is actually funding this activity. And that is to common good. If you look at a good example would be NHAI. I think the InvITs that they have created is, to me, it paves the way for very many things to stabilize a business, to have cash, throw up cash, and then get that business into an InvIT, and it becomes self-financing in a way, so that your next round of funding can be done through cash that was released from the InvIT process. So to me, there are excellent, I think, developments in that area, and the capital market will be a strong pillar in support of development parallel to the banking system.
Well, I mean, talking about corporate India and REIT and InvIT and all, so we are going through the earnings season, almost coming to an end. How do you see the corporate performance? Because we have been talking about, there is pressure, and that's a reflection also in the stock market, FDI outflow, FII outflow continuously.
Yeah. See, I would not be too worried about the FII outflow. These are, I would leave it to the market experts to talk about that. I would be looking at corporate earnings as the key, and ultimately the market is a function of how efficiently your constituents are functioning. So in that context, if I look at current quarter's numbers, and I now do it as a hobby, it's not my profession anymore. What is it? Out of 1,500 companies which have listed, out of the 4,000 companies which say one of the people track and report on a continuous basis, see top line growth of around 8%, bottom line virtually flat, 1 or 2%. So that, I think, indicates that there is some pressure on the system, which I hope gets resolved.
Coming back to the bank's health, is there anything, the stress that we are discussing about, is it confined to NBFCs, or you see the stress in banking sector also? Because what we understand is this, this stress of unsecured loan, it has affected banking sectors too, but particularly the private banks are pretty fast to write off loans, so it doesn't get infected in their bad asset number, etc. But the best time of the banking system, I think that cycle is changing.
Yeah.
Do you think that way?
I can't comment on whether that pain is felt by whom.
Because you did say about a year back that what banking system in India now you see is the best ever in the past 50 years.
Yeah, I will still say that. So that's the reason I can't say whether I'm yet seeing the pain that you're describing. Probably it is there, but I will put it in a larger context. Any lending activity goes through cycles. So there has to be a cycle, and there will be pain at some point in time in that cycle, whether through retail or the corporate side. But as of now, if I look at this quarter's numbers, I am not seeing that, whichever way I analyze it. Because you can look at the credit losses by looking at the provisioning number. I am not seeing a jump in provisioning, a significant jump in provisioning of banks. I have not analyzed the NBFCs. So I think the banking sector, I would still say that it is as good as it has been, probably the best it has been over 50 years. I have tracked.
You don't see new cycle changing?
I don't see that just now.
You are a great believer in data, right? Every time in our conversation you said that this is the new, I don't want to use the cliche that data is the new oil, etc. But you think that every business, particularly the banking and finance business, will be started being data driven. But the other side is the fraud and everything else, and the data privacy. Recently we heard about one insurance company's data leaking, data being sold, etc. So, and then the act on data is still, we have been waiting for quite some time. So what do you see in this entire data space?
There are two questions that you have asked. One is on fraud, and the second is on data privacy. I will separate those two.
Yes. Because you have been continuously saying that every action, credit action, has to be data driven.
Yeah, so if you look at fraud, really, just now what we are seeing is technology driven fraud. We call it cyber crime, but to me it is technology driven fraud. So how does that happen for a bank? It happens for a bank to a bank when the bank is unable to understand what could the fraudster do using technology. So there's a learning curve. Now, will you be ever ahead of that? You have to get ahead of that to survive. And this has been, I've seen that not now, even from the days of credit cards, when we first got into it, there is a set of fraudsters who will try to game the system.
But it's reached such a level where our Prime Minister is talking about in Man Ki Baat, talking about the frauds.
Yeah, so to me it's a serious issue. And collectively the system, the technology-driven players, whether banks or others, will need to figure out, will need to get on top of how to contain fraud. It's not going to take long. It will happen, because I think it is reaching a level where people now will have to apply their mind how to resolve this. So that will happen. Your second point was on what?
Using data to the bank's advantage.
Data. You see,
for
there
credit.
again, there's something very. I see something which is which will be corrected. Today, if you look at particularly for certain products, for core banking products, deposits and the like, there is data with the banks. But then you go to products which are third-party driven. I well know that 25 years back, we originated the third-party structure because we did not have access to banks. So we had third-party distributors who did this. But today it has come to a situation where distributors are controlling data. And the institution which is actually in business is not controlling data. So to me, that also, now with technology coming to the fore, a correction has to be done, where people who are in business should make sure that they have access to their own data. Otherwise, they are in jeopardy.
A little back and forth. So you are saying that the bank's health is pretty good. There is no concern. Good times will continue. As we speak, State Bank of India's just earnings announcement, and it's pretty good and all. The government-owned banking system has gone through consolidation. Now we have, I think, including State Bank of India, 11 public sector banks and all. So there have been talks, and various economists and even an ex-central banker also has written thing that this is the right time for government actually to encash, because at the end of the day, government has no business to be in running businesses. So why not government take the opportunity and divest thing? So do you believe in that this is the right time for the government? I mean, not as we speak, because the past 3 weeks market is in a different mode, but yes, the right kind of valuation, public sector banking, public sector banks, and why not start the divestment?
Tamal, throughout my career, I have never commented on policy matters, and I don't want to start commenting on policy matters now. So it's for the government to take a policy decision on this. If somebody asks me, I'll say the banks are in great shape, and they can now stand on their own feet. That's all I can say, which is the truth. State Bank of India, I just did the numbers, 18,000 crore profit into 4, and then we gross it up for next year. We are looking at almost a 20% ROE, 20% ROE, and several other banks. I call them, they are an engine which is firing on all cylinders, and a perpetual cycle engine in engineering terms. It doesn't need to slow down at all, and doesn't need anything else. It doesn't need any other fuel. It is generating enough fuel to grow at whatever pace it wants to set. So I don't think the banking system today can stand on its own. It's a policy decision that the government has to take.
And the Finance Ministry also in the budget speech spoke about privatization, about 2 banks. IDBI privatization we have been hearing past 2 years. So any comment on that? I mean,
as I said, I won't comment on policy. I congratulate the banks, but both public and private sector, and public sector in particular, for their exemplary performance.
We are coming to an end, but just a couple of more questions. Mr. Kamath, that AI and ML, now everybody talks about that, how we ride on that, and that's a great time. But there's a lot of caution also. Reserve Bank of India governor recently said that if we don't use them rightly, it can even destabilize, it can create problem with the financial sector stability. So what is your take on user AI and ML?
Yeah, I think we have seen what are the dangers of using technology. The ability to, we used fraud as an example. But if, with rampant use of AI, which is going to be there, so we can't stop it. I will only put it this way that the players in the system, banks or others, will need to be up on it to make sure that they know how to tackle this. So the burden goes up on the people who could be at the receiving end if they don't tone up their own act.
Finally, there are a lot of talks that how technology is changing banking. So do you think we have reached a situation, or we are very close to a situation where a techie can run a bank, we don't need the bankers to run a bank anymore?
I'm a techie, no?
Huh?
I'm a techie. How can I answer that question?
No, tell me. What do you think?
I'm a techie.
Yes.
So how can I answer that question?
So techie can, techie can
the
run a
answer
bank.
is given. No, I'll put it this differently. A banker has to understand banking, and it is just not only technology. I was joking. It is, you have to understand the regulatory context. You have to understand the legal context. You have to take a 360-degree view. But I will say this, and I'm saying this in several of, when I'm asked to speak on several things, I end by saying that today the CEO will also have to be a technology architect. If he is not, I don't think he's going to succeed. So for the good of the institution, he will have to be a technology architect.
So knowledge of technology is essential, but it does not necessarily mean a techie can run a bank.
Knowledge and understanding and a willingness to learn and make sure that his organization puts it in. He need not be a techie himself.
No, are you saying the same thing which Aditya Puri says that, well, I can have a Mercedes, but I don't necessarily need to know how to drive. I can have a right driver. So banker always can
this
say...
one, driving doesn't work. See, this is a game where in technology, it's a game where, particularly at this point in time, where there is evolution in technology, unless the CEO is willing to take a stand and say, my neck is on the line, nothing is going to happen. So you can't say that my driver is going to drive, his neck is on the line.
You also need to...
You will have to say, my neck is on the line, now do it.
Okay.
That's the only way you can do it.
Thank you, Mr. Kamath. Just last question, and the absolutely choice is yours whether you would like to answer or not. I think all of us are eagerly waiting for Geofinance, what's going to happen, when it actually take off, or has it already taken off, we don't know. If you want to say anything, sir, it's completely your choice.
You should ask the CEO, he will tell you. He will tell you, you should speak to him. Thank you.
So you'll not say, thank you. Okay, give him a big hand, please. Okay. Thank you, sir.
I think intense, engaging, and it's candid best. On this note, can I request Mr. Shivendra Gupta, MD and CEO at Business Standard, to present Mr. Kamath with a memento. Can we give Mr. Kamath a big round of applause? And I request Tamal sir also to be on stage. And I'd also request Mr. Shailesh Dobal, editor of Business Standard, to render the closing note.
Thank you, Ridhima. I know I don't want to hold anyone anymore. 3 days. It's been 3 days of insightful discussions, deliberations with some of the biggest names in the financial sector world, from the RBI governor, IRDA chairman, RBI deputy governor, the chief economic advisor, SEBI's whole-time member, chairman of country's biggest bank, NBFCs, leaders from fintech, banking, insurance, leading economists, market gurus like we have Ms. Mehra with us, financial sector stalwarts like Mr. Kamath, holding forth at the BFSI Insight Summit. In all, we had over 100 speakers these last 3 days, over 33 sessions. We had a special session on technology and artificial intelligence, essentially the industry speaking to itself, how these are changing the financial sector landscape. This year, we also unveiled 2 new reports at the summit, the BS Everest Tech Report and the BS Knight Frank Report on Housing Finance. And in a record of sorts, we had over 4,000 visitors visit the BFSI Insight Summit and over 60 exhibitors these days. Hope you enjoyed your presence here and found the deliberations interesting and thought-provoking. All good things must end, and so is the BFSI Insight Summit 2004 ending. We hope to be back with a much better and bigger Business Standard BFSI Insight Summit 2025. Thank you very much. Thank you.